Good morning, everybody, and good morning, everybody here in Paris and joining from wherever you are through Zoom. Welcome to this public consultation meeting. The purpose of today's meeting is to collect your feedback on the crypto-asset reporting framework, the proposed crypto-asset reporting framework, and on the proposed changes to the common reporting standards. We have a lot on our plate, so I would suggest that we start immediately, and we will start by two introductory sessions. We will first have some introductory words by John Nash. John Nash is joining us remotely from New Zealand, and he is the co-chair of Working Party 10. And then we will also have some introductory words from Keith Lawson. Keith has been for many years and still is today the chair of the Business Advisory Group to Working Party 10, and he is joining us remotely from Washington. On that note, I will pass the floor to John Nash.
Thank you, Philip. Welcome everyone to this public consultation meeting on the crypto-asset reporting framework that we've come to know and love as the CARF, and the first comprehensive review of the Common Reporting Standard, the CRS. Bonjour to those attending in person at the OECD Conference Centre in Paris. It's so good to see some degree of a return to normality. The OECD has received approximately 80 separate comments totaling nearly 600 pages from industry and other stakeholders, and over 400 people have registered to attend today's event. We are very grateful for the high level of engagement shown on both the CARF and the CRS review. Of course, it is crucial that the concerns raised by stakeholders are taken into account in finalising the proposals. The purpose of this meeting is therefore to highlight the key issues that merit further consideration at the level of Working Party 10. With this in mind, the panel discussions will focus on several issues on which the bulk of the public consultation input was received. However, this certainly does not mean that any other items not raised today have been forgotten. Based on the input received, Working Party 10 will reconvene during the Northern Hemisphere summer months to refine the proposals, with the aim of presenting the CARF and CRS again to the Indonesian presidency of the G20 during the fourth quarter of this calendar year. Now, just to further set the scene for today, let me give you some brief context of the work we have been carrying out on the CRS and the CARF. I'll start with the CRS. Since it was adopted in 2014, around 100 jurisdictions have exchanged information on taxpayers' offshore financial assets. In 2020, the latest year that we have statistics for, information on more than 75 million financial accounts worldwide, covering total assets of around 9 trillion euro, was exchanged automatically. Financial markets have continued to evolve in the last few years, giving rise to new financial products and intermediaries. The OECD therefore commenced the first comprehensive review of the CRS with the aim of expanding its scope to capture such products that are functionally equivalent to traditional accounts that were already in scope of the CRS, while also improving the operation of the CRS based on the experience of both governments and business. As part of this process, Working Party 10 has received input from 26 jurisdictions, via the Global Forum Automatic Exchange of Information peers and the Forum on Tax Administration, as well as the Business Advisory Group, and we have sought input from the broader public as part of the consultation process. As for the CARF, there are two key tax policy issues surrounding crypto assets. First, the substantive tax rules to determine what income, wealth, and transactions are subject to tax. And second, information reporting and exchange of information rules to support the effective taxation of relevant crypto asset related income and wealth. While today's meeting will focus on addressing the tax transparency issues raised by the emergence of crypto assets, there is other important work also going on at the level of Working Party 2 to analyse the substantive tax treatment of transactions involving crypto assets and to make recommendations in that respect. This work has resulted in the Taxing Virtual Currencies report from the OECD G20 Inclusive Framework on BEPS, covering 50 jurisdictions. This was welcomed by the G20 in October 2020, and many countries are developing domestic tax rules and guidance on the treatment of crypto assets. Work will continue at the level of Working Party 2 to reflect on relevant developments since the 2020 report, in particular the emergence over the last 2 years of non-fungible tokens, or NFTs, as well as at the level of the OECD Forum on Tax Administration's JITSIC network to address the administrative and practical challenges raised by the emergence of crypto assets. However, today we will be focusing on the transparency and information reporting related aspects of the crypto taxation landscape, which are of course crucial given the globalized and highly mobile nature of the crypto market, in order to ensure that countries can effectively apply their domestic tax rules related to crypto. As such, the ambition of the CARF is to provide a multilateral and global framework that will equip tax administrations with sufficient information to carry out their tax compliance activities, while also trying to keep the business aspect of the rules, the impact of those rules on business, as limited as possible. Now, in terms of the structure of today's public consultation meeting, we will hold 4 separate thematic panel discussions. The first 2 panels will be on the CRS amendments, one on the changes to the scope, and in particular, e-money and the treatment of charities, and then one on the changes to the reporting and due diligence requirements, as well as covering transitional issues. After a 1-hour break, and depending where you are in the world, that might be for breakfast, lunch, or dinner, we will have 2 panels on the CARF. Again, one on scope, focusing on crypto assets and intermediaries, and then one on the reporting and due diligence rules. Each panel discussion will be moderated by a member of the OECD Secretariat team, who will introduce the panelists and the topics to be covered by the panel, and then summarise the key input received during the public consultation. For each of the topics discussed by the panel, a government delegate from Working Party 10 will first set out the relevant proposals and the state of play at the level of Working Party 10. This will be followed by a set of initial reactions from the other panelists in order to then open the discussion in the panel. Of course, please feel free to get actively involved in the discussion on each topic, The moderator will let us know if time is up. Finally, my co-chair, Monica Bhatia, will close the day with some concluding remarks. Once again, just want to reiterate, thank you so much for attending today. We very much value your input on these matters. Keith, I will now pass the baton to you as chair of the Working Party 10 Business Advisory Group to give a business perspective on the consultation and the day ahead of us. Over to you, Keith.
Thank you, John, and thank you for reminding me that it's the middle of the night here in Washington with breakfast coming in a few hours. So I now know how you feel with the WP10 discussions that we have with you that go into the middle of the night and later in New Zealand. Anyway, thank you so much, John, and to the OECD Secretariat and to Working Party 10 for the opportunity for business to meet with you today to discuss the CRS amendments and the CARF. I mean, as you know, from long working with business at OECD, we have strong support for tax compliance measures that reflect appropriately the relative costs and the benefits of each proposed requirement, both to governments and to business. Just a few points that I want to raise, because you really should be hearing from the experts today and not so much from me. First, the steps that are required for business to implement the CARF and the CRS amendments will require substantial and complex changes to existing business processes. And you'll hear more from the experts about how much time they need, whether it's 2 years or 3 years or even longer, to implement some of the proposed changes. Second, for the government's objectives to be achieved, carefully crafted and phased implementation timeframes must be provided. And there are different factors that you will hear from business about different types of assets and uses, incremental benefits of expanding due diligence and reporting requirements, and relative difficulties of modifying existing and building new operational infrastructure to achieve the objectives of governments here. The times that will be required for phased implementation will vary, and you'll hear more about that. And with respect to the CARF, as you'll hear from the experts in the crypto space, that the reporting information about customers holding crypto assets is significantly easier than some of the other information that's being sought. Third, a key to successful implementation will be ease of administration for both business and governments. And with respect to financial institutions that are subject to both the CRS and the CARF, administrability will be enhanced if the applicable requirements are the same and are applied consistently, both for the CRS and for the CARF. And with respect to the CARF rules themselves, they should be applied consistently with government's actual application of the FATF's recommendations. And I'm quite certain you'll hear more about the extent to which those recommendations are, in fact, applied consistently by governments. Fourth, the CARF and the CRS should be applied with neutrality amongst technologies and in a manner aligned with local law requirements. Fifth, any proposed requirements that respect innovation and competition in the crypto space should be scrutinized closely given the impact on this marketplace. And I believe you'll hear about a CARF sandbox proposal in that regard. Sixth, care should be taken to ensure that activities are not pushed to jurisdictions that do not adopt the CARF or that do so inadequately. Seventh, as recommended by the OECD in the 2020 report that John mentioned, governments or countries should publish detailed guidance regarding the tax treatment of acquiring, holding, and disposing of crypto assets. Eighth, and I believe you mentioned this also, or maybe you didn't, John, crypto assets have implications for both direct and indirect taxation. The VAT issues are very important to the Business Advisory Group, and I'm sure you'll hear more about that issue as well. Ninth, this is my personal issue, John, given my financial institution background. We have serious reservations about benefits to the governments of the proposed expansion of the reporting requirements in Section 1 vis-a-vis the costs and other burdens imposed on business. And for this one, I actually wish I was in Paris. Anyway, but I am quite confident you'll hear more from the business people about that as well. The increased visibility and understanding that the governments anticipate as provided in the public consultation document from this additional information, our view is of limited value due to a wide range of factors that you will hear about. 10th, it's early in the morning, the substantive difficulties that continue to arise from differences in how jurisdictions adopt the common reporting standard create difficulties for business. 11th, we urge additional efforts by governments to educate taxpayers. One of the things that I heard consistently from the business folks was that the difficulties of them being effectively placed in the position of trying to provide tax advice, which they do not do to customers, or at least try to help them to understand their reporting responsibilities. And finally, we consider it useful for the OECD and the governments to evaluate the use of a permission blockchain technologies and infrastructure for providing and exchanging information for tax purposes. And with that, I will turn it back, I guess, to the Secretariat to begin the first panel, which I guess we'll actually start a little bit early. I was surprised that we were only 5 minutes late starting. This meeting, John, is not being run on OECD time, as near as I can tell. So.
Thanks, Keith. And I think it's easier to be a night owl than a early bird, personally. But thanks for all those introductory comments. We will obviously try to address as much as we can in that regard. And I will turn over to the Secretariat. I think over to you, Philip or Arta.
Thank you, John, and thank you, Keith. And I think with that we can start our panel discussions. But before doing so, this is for us the first time we do a hybrid consultation meeting, so we'll try to go a bit over the practicalities. In front of you, you see the agenda for today. As John mentioned, we will have 4 panel sessions. We have tried to group the key issues that have come across in the consultation, in the comments received, into these 4 panels. In the morning, we will have 2 panels relating to the CRS. The first panel will be from 10:30 to 11:45, and we'll deal with, we'll cover scope-related issues or changes to the common reporting standard, and that will be followed by, after a short break, by a panel session from 12 until 1:30. Where we will have the second panel dealing with changes to the reporting and due diligence procedures of the Common Reporting Standard. Then we will break for lunch for an hour, and this afternoon we will have 2 sessions that relate to the cryto-asset reporting framework, and here again we have broken it down in a first panel that will take place from 2:30 till 4:15, that will deal with scope-related matters of the CARF proposal, and a second session panel that will deal with the due diligence and the reporting requirements, and that will take place from 4:30 until 6:15, after which we will have some concluding remarks and we will close this day. Now, very practically speaking, as John already mentioned, how we will do these panels. We will have each panel moderated by somebody from the Secretariat team, and there will also be a working party delegate, 10 delegate always in each panel. So we will the moderator will start by explaining what are the topics that will be covered in the panel, and will summarize the comments that we have received on each of these topics. And then we will ask the government delegates to explain the proposals that are in the consultation paper, and that will then be followed by some initial reactions of the other panel members, and then there will be the opportunity for you all to intervene. And the way we intend to organize this, taking into account that we have people in the room here and people that are participating through Zoom, is that if you are in the room, you just raise your hand. If you are participating through Zoom, we propose that during the discussions of the panel, if there are questions or interventions you want to make, you use the chat function on Zoom to submit your question or your comment, and we will then try to consolidate that here in our back office and try to accommodate as much as possible your questions and requests for interventions. So we will not do the sticking up of the hands through Zoom. So the Zoom participants, please use the chat function and do not wait until the very end. I would recommend to submit your questions so that we can do the necessary ordering of the questions received. I think on that note, we can start with the first panel. I would like to ask Arthur to take my place.
Brilliant. So yes, welcome once again to everyone joining virtually as well as those in person to panel 1 on future-proofing the scope of the CRS. So my name's Arthur Olszewski. I'm a tax policy advisor at the OECD Center for Tax Policy and Administration, as well as a member of the Working Party 10 Secretariat. And I'll be moderating the discussion as part of this panel. So hopefully, in an ideal world, you'll hear as little of me as possible and as most of the discussants as we can. So indeed, I'll first kick off by discussing by introducing our discussants, and indeed we'll start with Corinna Hetke, the regional lead EMEA for client tax information at Standard Chartered Bank. We then have Andreas Knobel, the beneficial ownership lead researcher at Tax Justice Network. We also have with us David Pitaro, a director at the Italian Ministry of Finance and also delegate of Italy to Working Party 10. We then have Taher Sabri, the chief executive of the Electronic Money Association. And last but not least, Hanna Zurmats, the enabling environment manager at Philanthropy Europe Association. So again, I thank all of the panelists very much for joining us and for lending their expertise to make this discussion today possible. Now, turning to the format of the panel, some of these things Philip has already discussed, but I'll very briefly go through them again. So as part of this panel, we'll have 3 thematic areas that we'll discuss, which reflect really the bulk of the feedback that we received during the public consultation when it comes to the scope of the CRS. So on each topic, I'll first summarize the kind of key takeaways from the public consultation, and then David, as the delegate of Working Party 10, will then set out the relevant proposals and state of play at WP10, and then of course followed by an interactive, hopefully, and then lively discussion within the panel. Now, time permitting, after each thematic discussion, we will then turn to questions from the audience, and in this respect, we'll give priority to questions that we've received in advance. And then for those of you who are joining virtually via the Zoom call, you can already send your questions if you already have an idea of what you'd like to intervene on to the host during the call. In terms of the substance, I think on the scope of the CRS, really the changes, I'd say they go in 2 different directions. So on the one hand, we're expanding the coverage of the CRS to cover newly emerging types of products, so these digital financial assets. And on the other hand, we're kind of taking a step back and rethinking the CRS in order to calibrate it, to focus it on areas of particular risk. Now, with that background in mind, as you can see on the slides, we have 3 thematic areas that we'll cover. And so firstly, that's the coverage of digital money products, in particular specified electronic money products, which I'll refer to as CEMPs, and central bank digital currencies. We then have the treatment of charities that are investment entities. And then finally, we'll move on to other questions of scope, including the use of CRS data to ensure that the CRS is future-proof and that it delivers its intended compliance outcomes. So with that background in mind, we do have a lot to cover in the 75 minutes allotted, so we'll dive straight into our first topic, which is, as I said, the coverage of digital money products. By way of a very brief background, of course, you'll be aware the proposal, it foresees the inclusion of such products, in particular SEMPs and CBDCs. In terms of the public consultation input, which we received primarily on specified e-money products, so in general, there was broad support for the definition. It was mentioned that the definition is well aligned with other definitions adopted for regulatory purposes. At the same time, there were some comments highlighting the need to perhaps tweak the definition a little bit to include in its scope multi-currency accounts as well as e-savings accounts, and to also clearly exclude closed-loop style e-money products. There was also very strong support expressed for a threshold. A lot of reasons were cited in this respect, so including the primary use case of e-money as a payment product rather than to store money over time, the desire to continue using simplified due diligence by providers of such products, of course the need and the priority to promote financial inclusion and to exclude low-income earners, unbanked, asylum seekers, these kind of circumstances, as well as, of course, the overarching need for a proportional approach where the tax compliance objectives are met without overburdening businesses and consumers. Equally, there were some dissenting views on the threshold, given the complexity of monitoring over time. And finally, in terms of the quantum of a threshold, I think views were converging at around the USD $10,000 mark, subject to the CRS aggregation rules. With that short introduction, I would like to now turn to our WP10 delegate, David, and kind of ask him to explain the proposal in respect of SEMPs in the CRS, and also to kind of outline the outstanding considerations at the level of WP10 in this respect.
Thank you, Arthur. Good morning, good afternoon, good evening to everyone who's following online. I want to thank the Secretariat for having invited me to this panel on the revision of the CRS. And I'll try to keep it short to give more space to the other panelists, but just to give you the general rationale of what has been done at the level of the WP10. Since the CRS was adopted in 2014, the treatment of e-money and e-money providers has been a point of very frequent discussion at the level of the WP10. There was broad agreement on the fact that e-money products, that they have the capacity of storing value over time, they do not fluctuate in value, and they can be considered functionally similar to traditional depository accounts. So discussion went on whether this e-money were already embedded in the CRS, as some countries implemented CRS domestically to include e-money already. Some others thought they would need a CRS 2.0, which is what we are trying to do now. And the idea is to provide a similar treatment between traditional bank accounts and functioning equivalent digital money product. So we can ensure that there is consistent reporting outcomes and a level playing field. The proposal defines the e-money products as being characterized by 5 criteria, which I'll mention very briefly. One is that they have to be a digital representation of a single fiat currency, so no basket of currency, which would bring us to a totally different world, probably leaning on the other project, the CARF project, but not on the e-money. The other requirement is the e-money is issued on receipt of funds for the purposes of making payment transaction. This has to be taken very with a very open view with this issuing the e-money, because it's just to make the e-money available. So the issuing has to be considered as a very broad way to make this e-money available to the customers, and is used for the purpose of making payment transaction. It has to represent by claim on the issuer to obtain currency denominated in the same currency where that is the e-money is representing. So if it's e-money in dollar, your claim is in dollar. If it's in euro, your claim is in euro. And what the intermediary is keeping on hold as a guarantee for your money is not related to what you are claiming for. It's always the denominated currency you have been issued with e-money. The other one is that this e-money should be accepted by any natural legal person. So if this is meant to circulate in a restricted circle, so just the issuer or a number of providers of the issuers providing services or good, that is not what we are considering as e-money, because that wouldn't circulate and would be accepted as e-money should. The fourth, maybe the most important one, is by virtue of regulatory requirement to which the issuer is subject, it is redeemable at any time at par value for the same fiat currency upon request of the holder of the product. So many things and many concepts here. One is that you have to have the possibility to redeem it at par at any time. So $1 for $1. And it has to be something that is provided for by a regulatory requirement. So it's not just enough to be in the white paper, the contract you sign when you receive the money, because that's between you and the depository institution or the financial intermediary, with the way we want to call it. It has to be imposed by someone else. So it's a little bit going beyond what a contractual agreement is saying. These are the 5 requirements. In order to include e-money, 2 things were to be done. One is to widen the scope of depository institution definition, and the other one was to widen the scope of depository account definition, which both are contained into the proposal for the revision of the CRS. And at the same time, 2 categories of excluded account have been added or have been proposed to be added. One is, and probably the most debated in the WP10, that one regarding the excluded accounts for having a de minimis amount being deposited or being transiting into the account, because discussion have been very thorough about this. And the other one is a kind of instrument that solely facilitate a fund transfer pursuant to instruction of the client, but it cannot be used to store values. So it's something like you use it for a transitional period, which can be 30 days, 60 days, 1 day, and then it is meant just to be instrumental to a transfer of fund, but there is no store value in there. The other point I want you to be aware of, that discussion on de minimis amount was very interesting and lively during the WP10 meetings. There were delegates that were very much worried about possibility of fragmentation if the threshold was too high. Others were very much inclined to provide financial inclusions, especially in those areas where e-money is very much used for payment at distance, and so we shouldn't prevent as citizens from using this very powerful instrument. Others were just thinking about the aggregation rules. Are they enough what if I fragment all my accounts? So this was a very lively conversation. And I think in this and during this meeting, we can receive a lot of interesting and valuable input to try to find and strike the right balance. So I think with this, I just give it back to Arthur.
Perfect. Thank you very much, David. So I think I'll just turn it immediately over to Tyre and Corinna. So, you know, David mentioned that the threshold is really the key kind of discussion point at the level of WP10. So perhaps it would be useful to start with, you know, what do you consider the key reasons for introducing a threshold for SEMPs?
Thank you, Arthur. Thank you to the Secretariat for inviting me. And for the BAG colleagues who've helped form some of our thinking. If it would be okay for me just to recap a little bit about e-money, and I'd like to distinguish e-money from the product which it's most commonly compared to, which is bank accounts. So we have bank accounts, we're familiar with bank accounts, and they act as our center of life, essentially. We put our money in them on a monthly basis, we make our payments out and so on. E-money, on the other hand, has a specific purpose almost all the time. In other words, it's very rare to find an e-money product, although there are some products like that, and we can deal with them separately. Generally speaking, e-money products serve a particular purpose. It may be that they're used to make payments online. And maybe they're used to make payments online for digital goods and services. Maybe they are prepaid cards, and those prepaid cards have a specific purpose. Maybe they are for traveling. Perhaps they are for transport. Perhaps they are in order to give to a parent to give to a child, etc. They've always got a specific business proposition, user proposition behind them. If they didn't, they would usually fail because they would be in competition with all debit cards and all credit cards, and they just couldn't succeed. So I think it's a common trait to find them being very specific, and I think already that mitigates some of the tax risk that's associated with them. The second attribute to mention about them is that because of their nature and because they tend to be lower value, generally speaking, they tend to rely on a frictionless introduction of the user, of the customer, into the system. So if I go online and I want to apply for this particular payment product, usually they will try to make my journey as easy as possible. They will ask me for a certain amount of information, and then they will do some checks behind the scenes in order to make sure I am who I say I am, and things carry on. This is also risk-based. In other words, the greater the functionality and the value of the product which I'm applying for, the more engagement there is between the payment service provider and their potential customer. The more checks, the more information that's collected, and so on. This risk-based approach is important because it has another quid pro quo, which is that by being able to lower what you ask for and what you check on a customer where the risk is low, you can then send your resources, put your resources in the area where the risk is higher. So the risk-based approach helps us do two things. It helps us to bring in customers where the risk justifies it, as frictionless as possible, and at the same time allows us to put that resource in the area where we think it's justified. And another and related attribute to this is that we use this idea of simplified customer due diligence in most cases. In other words, we say if you're, oops, I'm not sure if it's me or, so we will say to a customer, we will look at a customer, we'll look at their location, we will look at what they have available in terms of the ability to demonstrate and their identity. And we will collect the information necessary to meet our obligations, but they'll be different in different circumstances, and they may not always be conventional, right? So we may collect information about their geographic location through our interaction with them. We may rely on information that's been collected by the bank with which they have a relationship, and so on. This idea of simplified due diligence is enshrined in the FATF and means that we are not always collecting as much data at the outset as you would expect to collect if you were to collect data for CRS. So remember CRS: name, address, date and place of birth, country of residence, tax, country of tax residence, TIN. More information than you would collect, and certainly if you then went on to say, well, I also want you to go through some kind of self-certification, much more than you would, than a customer looking for one of these products would actually be expected to give, or would be willing to give for that matter. So these are the reasons why we distinguish these products from bank accounts. I and my colleagues and industry, generally speaking, and I'm sure you hear from others, are convinced that there are some products that justify and that would add value when reported to tax authorities. By the same token, we are convinced that the majority of the products, in fact, the overwhelming majority of those products, will add very little value. And reaching an arrangement where we can avoid, I'll give you an example. In Europe, we estimate something in the region of 500 million account holders. 500 million. I did a very quick calculation last night. If we added 2 minutes to the process of somebody signing up, we are talking about 2,000 years of engagement, right? So 2 minutes for 500 accounts. Each one, it's about 2,000 years of human time that would be devoted to putting in this additional information. It needs to be justified. If there is a justification, by all means. So, where do we go from here? And I realize I've spoken a little bit more than perhaps I have time for. We think a threshold would be a very good idea. We have asked for a threshold in the region of about $10,000 in order to allow for a lot of these things to be done. Are we wedded to this number? Is this, number some kind of magic number? No, it's not. But it does have resonance in other areas of anti-money laundering legislation, and there are higher numbers in the CRS already. It is important that we do not create friction at take-up for these products. There are, and you will hear from my colleagues, there are good reasons for the general population, but there are even better reasons for financial inclusion. And financial inclusion isn't just in developing countries, it's actually in developed countries too. A lot of the cheapest, best deals are always available online, making it possible for people to access these products and services online is really important. We have, and finally, we have also identified 2 or 3 areas where we think exclusion is, in their entirety, is a reasonable approach. One of these is money transfer type products. These are excluded already. There's no sheltering. Another one is what are called limited network products. So you can only buy things in a shopping mall. You can only buy things from a particular branded set of outlets, etc. And the third one is financial inclusion. And again, I will leave that for my colleague Corinna to talk to you about that. I think I'll stop here. Thank you.
Brilliant. Thank you very much, Saad. So we have heard a lot of additional reasoning on why SEMPs potentially merit some kind of level of exclusion. And indeed, I think it would be useful to hear from Corinna what she considers that amount to be. You mentioned 10,000, but I think at the level of WP10, as David has already mentioned, this was a very challenging discussion. So any kind of additional specific reasons you could give us on particularly that amount, both yourself and Corinna would, I think, be helpful in advancing the discussions at WP10. So I hand it back to Corinna.
Yeah, thank you very much, Secretariat and Working Party 10, having the opportunity to speak at this moment. And I work for Standard Chartered Bank. I don't know who knows Standard Chartered Bank, and we have a completely different footprint to many other big banks. We have our, in particular, business in emerging and developing markets, and therefore I'm leading the African, Middle East region, and of course also Europe, so I've got quite good oversight what we're offering there. In particular, in these markets in Africa, we use e-wallets. Is one of our basic mass market retail products. And in this instance, we use those because in these areas, and I think we have to change our perspective in this, for this, looking at this, in order to look at this, what it means, a risk of tax evasion. These clients or potential clients live in rural areas with not having infrastructure or even the means to have access to traditional bank accounts. So in these markets, these e-wallets, we know everyone more or less holds a mobile phone, yeah? It's much more likely to hold a mobile phone than anything else. And therefore, these products are specifically tailored for this domestic mass market. And when you think of, for them, it's the proportions, so they're always capped, they're always very limited. And in our what we offer, of course, is always in local currency. And you also have to bear this in mind, because if it's offered in local currency, the amount set is also according to the economy and also then to the local currency. So when we think of setting a threshold and it's set in the standard itself, we always talk about euros or US dollars. Looking at these exchange rates then, they are much more volatile. And so we have to make sure that when we make a decision on those, that it really works for many years, so that it's really kind of future-proof, and we don't have to think every year again. Because if we, as a bank, have to make a decision, these products are suddenly in scope year after year or out of scope, we would never make such a decision on saying, okay, on a risk approach, saying, oh, well, we would exclude them. On the other side, as Thea already has said, you had to throw resources into monitoring processes and potential reporting processes, which is really more or less, we could say, really wasted money. Because when CRS went live, for example, in Ghana and Nigeria over the last years, and Kenya is a country where we are in, which is just about to go live, we investigated our accounts, our account holders for foreign indicias, the existing ones. And there we found out that only 0.01 or 0.3% of the overall account numbers had any foreign indicia. And if you think of this, you can see this is only for the domestic market. So they've got specific limits of that these must be citizens in this country, for example. Because it's digital, yeah, the easy thing with it is you try to open the wallet, and then if you suddenly you always have to show an ID, some sort of that, and selfie and all these things, so minimum due diligence. And then if there is kind of anticipation that there are foreign indicia, then you cannot continue this onboarding process. So the person would not be able to access this product. So it would be then, the person would be then directed via our other channels, and then we would do additional checks. So it's not possible to open such an e-wallet for a person who has foreign indicia. And looking at it, and coming back to the threshold, what we see across our markets that depending on where we are, and also, of course, depending on the exact parameter of these wallets, we have got sometimes wallets of an equivalent of 2,000 US dollars or 4,000. We're offering also e-savings accounts they've got around 3,500. It's always depending on the jurisdiction you are in. So you cannot say, okay, that's the number. Yeah, you have to consider or take everything into the equation here to find a very reasonable approach to this. And also then, so it's also then safe in other means. And also you have to look at this, okay, how is the product tailored? How is it designed? And it is very easy for such a product to be designed to say, okay, well, you've got foreign indicia, you can't just onboard this product because it's so, for the domestic market, they are resident there and they are not necessarily for that purpose evading any taxes. You wouldn't report them anyway under CRS. So why would you conduct all the due diligence for all the reasons Thea has already explained and highlighted? Why would you implement something which is simply not necessary? And we've also, for example, seen when CRS went live, when we've got tax authorities which are not as advanced maybe, and also the public is not as aware about definitions or terms like tax residency. They don't understand this term. What is this? What is a TIN? They come suddenly with questions, or can I provide my student ID? Can I provide my whatever ID? So they have not the concept of what is a TIN. Even we see this sometimes under CRS in the UK, when, a national insurance number is not a TIN. No, not of course, not. But it is an identifier. And so for them, they would rather abort the onboarding process because they can't respond to this, because it's simply not familiar. And I think we must be very open for this. And we also want that CRS is adopted by more jurisdictions, in particular also jurisdictions which are emerging and developing. And so in this regard, it is so important that we have a really strict threshold, but which is also reasonable. So we also would support a 10K threshold, which has been discussed before, but also then maybe have some additional, which is on an aggregate basis, yeah, but also then something like, okay, for each wallet, because it's aggregate, yeah, then have an additional threshold for each wallet. So the person could have multiple wallets, but they must not be above 10K. We set the lower threshold of 5K, and also then maybe including something like, okay, if a person can link an e-wallet to a traditional bank account, which is sometimes possible. Mostly not. It's simply not possible.
Thank you to both panelists, and probably there is a question I wanted to ask to one or both of them, and is about the idea of relying on a risk-based approach for these accounts. Because the reason behind the fact that we went straight to the threshold, the amount for exclusion, was the idea that a risk-based approach, which is known in some other areas, AML, it is based on fact and circumstances that might not be relevant for tax purposes. And the point is that with the due diligence, it's like, pass me the metaphor, it's like a glazed cake. You assume that it's sweet, but you have to bite it to know whether it is sweet or not. You get to taste it to see whether this is really raw risk or not. So the question is, how do you see an exclusion that works with a different due diligence procedure for tax purposes? Do you see like sort of a approach step by step? If you pass step 1, then you go to step 2, and what would be the elements of the steps and the requirements to be met in order to go ahead and go with the pros, with the ones that should be, duly examined. Thank you.
So may I respond to this? So it's a really good point. So on further features of these e-wallets, because they come not with only with the cap itself, they have got also further very stringent limits. And one of the limits they have is really, for example, that cross-border transactions are really hugely restricted. It's not possible to just make a transfer outside. And so therefore, and if a person wants to initiate such a transfer, it's then also directed outside the kind of automatic cycle of making a transaction, and then is guided into, or it leads into some manual intervention. And of course, at this stage, you are able to intervene and ask the relevant question. Also, what we've got a tier system, and so saying, okay, if I hold a wallet, which is not, where it's not possible to have a traditional bank account in addition, it has a very low limit, that then the due diligence is lower, and also, of course, what you can do with this wallet is much more limited. When it comes to the second tier, for example, then we've got a more enhanced due diligence procedure. We would also then ask for residence in these instances, yeah, still to have the confirmation. Whether we necessarily ask then for the TIN, because that's, from our perspective, the most trickiest part to obtain a valid TIN. And we all know when it comes to the exchange, eventually, for tax authorities, it's so key that they receive a TIN, because if they only have even a date of birth or something like this, it's not enough. So, and therefore, it should be avoided. It should be really ascertained first whether this person is really a reportable person per se under CRS. And in this regard, we would really go along these lines.
Can I? If I could add a little bit. So certainly when I mentioned the risk-based approach, I was referring to the anti-money laundering side. So the risk-based approach would look at customer risk, maybe channel risk, geographic risk, as indicators for how much due diligence and the extent of the due diligence that would be done. Now, with tax, I can see that the risk is to do with the amount. Perhaps it's to do with the country. Maybe a particular country might suggest a greater risk. But I'm not suggesting that, or at least I wasn't in the presentation suggesting that a risk-based approach would apply to tax. Rather, I was saying if we allow the tax requirements to trump, to take precedence over the AML requirements, we end up negating the risk-based approach, because we would not be able to apply a lower level of CDD, maybe simplified due diligence, if we had to actually do full CDD in order to meet the requirements of tax. So what we're really looking for is a balance. We're trying to say how much, at what level are the tax authorities really concerned, how high can we go, in order to give us space within which to continue to apply simplified due diligence, because otherwise we are removing the freedom to do simplified due diligence, which is so important for these types of services. That's really the space that we're trying to find.
Thank you, Tad. And just perhaps one quick question before we turn to the audience for any additional questions. So would a threshold of 10,000 in all cases allow you to continue to apply simplified due diligence and be successful in excluding all of these financial inclusion products? In other words, would you need any other criteria apart from that 10,000, or would that 10,000, if that were the threshold, be sufficient for your purposes?
So we arrived at the 10,000 as an all-inclusive limit. So it is high for a lot of products. It's not so high for certain specific products. And we would love to enter into some kind of meaningful discussion with member states. Unfortunately, the way the discussions take place it's quite binary, not binary, it's quite, I won't say dysfunctional, but maybe that's not fair. We can present our views, and then the working party obviously will form its own views without our involvement. But we would be very happy to enter into more detailed discussions on this. But this is really the highest common denominator that we could find.
Yes, I would say for us, we always have, for certain accounts, for example, which you can limit to a traditional bank account, we have got internal policies, and I think this should also be reflected. So I think I think there's a strong argument for saying, okay, if I can link it to a traditional bank account, then there should be some restrictions.
Just roll it up this month and then go back.
Otherwise, it is the case that if we also exclude, you'd mentioned it, these closed loop e-wallets have these specific criteria as well. I think then we should be able to manage within this kind of framework to have the right framework in order to have it future-proof.
Perfect. Thank you very much, Corinna. And now I'd like to turn to one, maybe two questions from the pre-registered questions. So firstly, if I could give the floor to Nicholas Reinhardt from A4 Consulting.
Yes, sorry, is that live? This one? Sorry, yeah, I'm not here as A4 Consulting. I'm here actually as EPIF, the European Payment Institutions Federation. And we worked very, very closely with Thea on the submission, and a big thank you to him for bringing us all together into one position. I share obviously everything he has said, but maybe two or three, rather than questions, just comments on some of the things that have been said. One, Corinna, you made the point about setting thresholds into cultural settings. And it's very interesting because from a European, purely EU, European perspective, we actually were pushing for a 15,000 euro threshold, so a bit higher than the consensus we ultimately ended up in for the 10,000 US dollars. Why the slightly higher threshold? Because it was actually aligned with the simplified customer due diligence requirements under anti-money laundering. So it speaks totally to Thea's point that within the European legislation, that would allow us to do the screening for tax purposes and anti-money laundering purposes at the same time. And it speaks a little bit to the cultural setting that in the European context, maybe a slightly higher threshold might make sense. But we also recognize level playing field issues, we recognize comparability, and therefore, you know, we would prefer 15,000 euros, but we can live with 10,000 US dollars. The point that is more important is the point that you made, David, which I really appreciated, which is that you're trying to differentiate between money stored for purposes potentially of tax evasion and money used to make a transfer, recognizing the unique nature of an e-money product as a payment product. And that is why we have been pushing for a second leg to the threshold, which we haven't really talked about. So it's not just the 10,000 US dollar threshold, but we need to find a proxy by which to measure whether this is used for transfer purposes or for storage purposes. And you made that point very well, I think, in your introductory comments about 30 days or 60 days. We love 60 days, but actually I think 30 days is a pragmatic approach. So within a 30-day period, you cannot have over 10,000 US dollar in your account on a continuous basis. But there might be situations where you have a higher amount for a day or two as you want to make one transfer, or you collect money to make one transfer. So it's very functional. I think that's a very, very important point, and it's a unique element of the e-money products to allow you to store money for a short time to make a particular payment. And then the final one I wanted to make is on the risk-based approach. I entirely agree with Thea. It's really the link to AML. But one point I always like to make when it comes to risk-based approaches is ultimately, whatever rules you establish at the OECD and that are followed by your members doesn't preclude the industry from also being diligent themselves. If they see something, some behavior that seems abnormal, whether it meets the OECD rules or doesn't meet the OECD rules, it is still in the obligation of that company to act and be responsible. And for that we have a supervisory process, the supervisor of the regulated entity. So I think it is important to recognize that the risk-based approach goes both ways. It also puts an onus on the industry to, in a way, self-control itself. Thank you very much.
Thank you very much, Mr. Reinhardt. Unfortunately, we're running out of time, so I will just give the floor to one more question. Mr. Joshua Odens of Holland and Knight, and if we could do it in 1 minute, I'd be greatly appreciated. Thank you.
Thank you very much, Arthur, and thank you for the opportunity to talk with you about money transfer and the proposed changes to the CRS. So I'm here on behalf of Western Union. When BIAC met with Working Party 10 last year to begin discussing changes to the CRS, there was agreement that money transfer in and of itself does not present a tax risk that should result in reporting under the CRS. And last year through BIAC, we submitted comments. We recommended that an institution that completes money transfers pursuant to instructions from customers, whose customers provide the funds to the institution with the intent to have those funds transmitted, should not be treated as an FI. And then also the money transfer itself should not be treated as an account. And so looking at the comments, looking at the proposed changes to the CRS, we recommend two changes. First, we believe that an entity that engages solely in money transfer should continue to be treated as an NFE. Second, the proposed CRS rule should not mandate a time restriction for the return of the wire transfer. And just to set the stage, in a money transfer transaction, the person sending funds is referred to you as the sender or the customer, and the person receiving the funds is the receiver. In a typical cross-border transaction, a fee is charged for the funds transfer, and an additional fee is charged for any currency conversion. So we agree that if funds are intended to be a money transfer, then the sender or customer has not created a financial account. And if the receiver just picks up the funds, the receiver has not created a financial account. So we think that that an entity that solely engages in money transfer should continue to be treated as an NFE. Treating such an entity as an FI will cause confusion. Under FATCA, such an entity is not an FI, and there will be an entity classification mismatch between CRS and FATCA. And second, some jurisdictions will expect account reporting if a money transfer for a money transfer entity. And an entity that engages in no activities outside of money transfer will not have accounts, and this will create confusion and administrative burdens for both tax authorities and business. Second, we also think the time limitation for mandating the refund of a money transfer should be removed. The draft changes to CRS have a 60-day rule. The timeline that a receiver has to pick up the funds may be dictated by the business terms and by local law, jurisdictional law in many cases. The local law achievement timeline and business terms vary across the globe and by institution. Many jurisdictions have prescribed timelines in which an unclaimed money transfer is cheats to the government if not refunded to the sender or picked up by the receiver. Money transfer companies have controls in place to manage the multiple jurisdiction requirements as to due diligence, timing, and reporting. In other jurisdictions, an unclaimed money transfer becomes the property of the money transfer entity if not refunded to the sender or picked up by the receiver. And if the sender stops the transfer or requests a refund, then the money transfer entity may retain the transfer fees, including the currency conversion fee. Also, the money transfer entity may assess periodic fees in the event the funds are left with the money transfer entity after a specified period of time. And so that leads us to two questions. The first is why is there a desire to include a money transfer entity that does nothing more as an FI, and what is the policy concern? And then second, why do the proposed changes to the CRS specify a 60-day threshold for refunds?
Thank you very much, Joshua, for that intervention and those questions. Unfortunately, we do not have time to address them at this point, but we will certainly take them back to WP10 with the aim of coming up with our final proposal. I would also acknowledge finally comments from GSM, and we understand that those comments as being in support of the 10,000 threshold. Now, with sincere apologies for cutting this subject slightly short, I will now move on to the next block of our panel. If there are any other indeed outstanding questions or comments, the it's possible also, of course, to continue to engage with the Secretariat on this issue, and we invite everyone who hasn't had a chance to perhaps ask a question to do that following the meeting. Now, turning to the second topic, so the treatment of charities. There are investment entities at a very high level. We have a broad IE definition, which means that some charities essentially that may be active NFEs are still within the scope of an investment entity definition, because we don't exclude nonprofit entities from the IE definition. Now, the public consultation, it showed strong support for a carve-out for genuine charities that are investment entities, and as a result are reporting in respect of their recipients of grants. At the same time, I think at the level of the Working Party 10, there have been some concerns about extending the carve-out from the IE definition to cover, all nonprofit entities described in the active NFE definition. And I think so there we have these two arguments, and so I think the task of the panel, will be to reconcile these two positions, perhaps with finding some kind of technical solution that can satisfy these avoidance concerns, while ensuring indeed that genuine charities, they're not subject to burdensome and perhaps reporting requirements that may not be aligned with the purpose of the CRS. So in the first instance, again, I'll hand to David, and with this task in mind, could you please kind of elaborate on, the status of charities under the CRS currently, and the state of play in discussing and exclusion for certain charities at WP10?
Thank you, Arthur. And regarding this topic of charities and how we can avoid that some charities are caught into the financial institution definition, while they would better not to be caught without having the risk of having some charities which are not supposed to be non-reporting, actually non-reporting their accounts. So a bit of again of a balance to strike here. And in terms of where the problem is, as Arthur said, that there is a broad scope of the definition of investment entity, especially those that are so-called A6B investment entities, which are basically investment entities that are there just because their income is primarily attributable to investing, reinvesting, or trading in financial asset, and they are professionally managed, so they are managed by some other financial institution. At the time, this A6B was there to avoid that you would claim to be someone which is not a financial institution, while de facto you were doing the financial institution. So it was a factual test to pass to avoid the idea that with the introduction of the CRS, some institutions would name themselves with another definition, not being caught by the standard. So that was de facto definition of investment entity, A6B. Having said that, it has also been recognized within the group that there are some genuine charities that are professionally managed trust or similar legal arrangements, and they are concerned that they are currently considered reporting financial institution. So they are currently required to report on their beneficiaries, so the ones that maybe are benefiting from the charity. So sometimes it's a large number of people, and probably the people that shouldn't be reported because they are getting the charity. So it's not exactly tax investigation territory there. Against this background, the WP10 was considering further carve-out for genuine charities, and some technical work has been done. But we also acknowledge that an exclusion of this kind exists under the FATCA and was not included in the CRS because there is no, at the time in 2014, there was no experience whether this FATCA exclusion was working properly or not, or was too generous, was too strict. So it was not brought on board at the time. But at this point, many delegates have expressed concern to include a mere carve-out of charities from the scope of investment entities. This could lead abuse of the carve-out because that would turn into self-declaration. So you just say, I am, you declare it, you put in a form, and that's it. And the kind of charities we have are of very different types depending from country to country. And so we need some appropriate visibility or monitoring by tax administration if whether these conditions are met. So basically, we have to set conditions that can be ascertained, can be monitored by the tax administration in a possible viable manner. And also, I would add that also for financial institutions, they have to run the due diligence, also the front line there. They have to run the reasonableness test on the declaration being made by their customers. I mean, there are things there that bring towards the path of having something easy to apply, but also can be monitored, can be objectively assessed, also by not only by tax administration, but also by those intermediaries who run due diligence on the accounts held by these charities. So a bit of a mission impossible here, but we hope that we can really find very valuable input and suggestions to have objective criteria from those who are really invested in this field and know more. Thank you.
Perfect. Thank you, David. And that leaves me in a perfect position to ask a follow-up question to Hannah. So, as David explains, the main challenge really is defining criteria for an exclusion that can be objectively determined to identify the charities that, that are the genuine charities that we do want to carve out. So are there any procedures currently in place domestically that we could rely on to identify such charities?
Thank you. Thank you very much for inviting me here to represent the philanthropy foundation sector. I come here from the European philanthropy sector, but we have been liaising very closely also with WINGS, with the global network of grantmaker support organizations, and including also the Council on Foundations in the US. So this issue of genuinely public benefit foundations potentially being caught into the common reporting standard by the fact that they do have the majority of their income based on their asset allocation and then have their assets externally managed. If they have their assets internally managed, they would not be falling under the common reporting standard. This is indeed an administrative burden, and we very much welcome indeed that the OECD is discussing and reviewing how a carve-out could be designed to ensure that the genuinely charitable organization can be excluded and that additional requirements are potentially put in place there. We are talking here really about a significant sector, and putting those public benefit organizations under additional reporting requirements would mean that there's less money indeed for the public good. At the moment, there's a strong demand on our sector. We are already under tight due diligence and reporting requirements, and hence additional burdens would really be will have to be avoided. What the implication is indeed that those organizations considered as financial institutions would have to do reporting on grant recipients. They are in occasions several thousands of grant recipients of public benefit foundations. The criteria, indeed, we argue that public benefit organizations are under tight regulation supervision according to many jurisdictions. And where globally this is not the case, of course, these criteria would need to be fulfilled, and those jurisdictions would potentially fall out of the system. Hence, we need to agree on criteria. Here, the regulation that we have been mapping in a European perspective, also to some extent at the global perspective, is indeed talking about a sector that is for the public benefit. the assets are dedicated to the public benefit. They cannot be revoked. They cannot revert back into private interests. Also, in case of dissolution, those assets will need to revert back to public benefit. They are governed by a board, and they have a tax-exempt status. And the tax-exempt status have tight and clear criteria. And there has also been some OECD mapping recently on the tax requirements. And I would like to refer to that study and our study as well for some of these requirements. In addition, these entities generally are registered. And that can also be a criteria. If they are formally registered, either in a company register, foundation authority register, that could be a criteria. They are then also monitored by supervisory authorities. They could be financial authorities, specific foundation supervisory authorities. Here the systems do vary, but we sense that in many countries you have a system of check and balances which include financial authority. If they want to have a tax-exempt status, they need to do annual reporting, they need to get their status approved, and there are tight requirements for that, and this is checked regularly. The additional argument, indeed, is also that in FACTA there was an exemption for charities, and according to our knowledge, there has not been any evidence or proof that, as David has announced also earlier, that this has not worked well, that there have been cases of abuse. So we consider that the exclusion in the FACTA works properly, and hence would argue that also for the common reporting standard, it's highly recommended to introduce the carve-out. Where we see that there could be reference made to the tax-exempt status of the organization, potentially to the fact that they have to be registered in their own jurisdiction and be under monitoring of some type of authority. Here, it could be, because national laws differ, could be financial authority, could be also foundation supervisory authority, but that could potentially be leading to the fact that you can be sure that indeed only those organizations would be eligible for the carve-out which are truly, genuinely charitable organizations.
Thank you, Hannah. You mentioned that in many jurisdictions there's procedures in place, for example, to verify compliance with the tax-exempt status granted, or registration requirements and ongoing monitoring. And I think indeed in those cases, we could consider an approach where we rely on those types of safeguards. But I'm not sure if that's the case in all jurisdictions. So say, for example, would an exemption that's limited to jurisdictions where those safeguards are in place be sufficient for the charity sector?
Ultimately, it is up to the national level to design the safeguards and to design the national laws. That is indeed in the competence of the country level. And we, from a European perspective, would argue that our mapping revealed in a European context that we do have checks and balances in place. In a global perspective, we can also be sure that there are the majority of countries where this is the case. But if you would include those criteria into the common reporting standard, you would avoid that those countries where you would not have these safeguards in place would then be able to benefit from the safeguard. That is my understanding. And indeed, we would also be happy to further discuss how a wording could potentially be found that would ensure indeed that these safeguards are in place at the national level.
Thank you, Anna. Just a question of more clarification. Is it my understanding you're trying to suggest that we leave it to domestic registers to register charity that have been incorporated, if they have been incorporated, because some of them are not even incorporated, the rules and the requirements to decide whether or not that is a charity. And once we set out the rules for a charity to be CRS exempted, the legislator would automatically or spontaneously incorporate those rules into the requirements to be registered domestically, or is it a different way? Because if we have a set of rules with a definition of what a charity is, and then these rules differ from what has been established at the level of a jurisdiction or many jurisdiction, in order to register, their registration would be irrelevant for the purpose of the CRS. Are you suggesting that they should sort of align to what we are trying to introduce here?
There is already the NPO definition in the Common Reporting Standard, which includes certain criteria and requirements. If that is not considered sufficient and you would like to narrow that down, you could potentially add on this additional criteria of being registered at the domestic level. Yeah.
Okay, perfect. Perhaps maybe before moving on to the next chunk of our discussion, I'd just like to ask one final question. So for charities that currently, that are caught as investment entities, how do they currently, get by with reporting on, the recipients of grants, for example, and how problematic is that?
So some of the larger foundations, they have changed their whole kind of reporting structures with regard to due diligence on their beneficiaries. The problem is also that there is not really a standard software for that or any standard procedure. So it is very complicated, very costly, and specifically when you look at the at the size of the sector, of course, for the medium-sized foundations, it's a high administrative burden that is considered there as in addition to their already existing due diligence procedures, which they have to comply with according to the national laws, including also AML rules, etc. So it seems that that this is an additional different type of due diligence procedures that is very costly. That's our standing from the conversations and the experience with our members on this.
Perfect. Thank you very much, Hannah. Of course, I'll summarize all of these discussions at the very end of the panel, and now I'll turn to the final thematic area. So, other scoping issues, and so really this it's an open-ended item, on any other issues of relevance to discuss to ensure that the scope of the CRS is future-proof and that it delivers its intended compliance outcomes. So, essentially, a wish list for other items on which work could potentially be taken forward. And here, since this is an open item, there's no concrete proposal. I'll just jump in straight into the questions. So for Andres in particular, some of the contributions from Tax Justice Network, they centered around allowing CRS information to be used for non-tax purposes, for example, in a more structured manner, perhaps, as well as requiring countries to publish statistics on AUI. Andres, if you'd like to expand on any of these issues and come up with things that you would consider priority to take forward, that would be appreciated.
Yes, well, thanks a lot for the invitation. So I will refer to three main things that at the Tax Justice Network we really think might be a priority. So one has to do with who participates in the system and what the information is used for. Then on statistics to really monitor the effectiveness. And then lastly, how to make the CRS information also compatible and even create synergies with other transparency movements, especially beneficial ownership transparency happening at the EU, but also all over the world. So first, of course, the benefits of automatic exchanges should be accessible to everyone, and many developing countries are still excluded just because they cannot send information. So the main thing we have been asking for years is that all developing countries are also able to receive information, even if they cannot send it yet. We understand that they would also have to commit and comply with confidentiality requirements, but that should be just as it applies to any other country. There should be no other condition. As long as they meet confidentiality, they should be able to receive the data. Now, speaking about global participation, we have one case of the US. The US has committed to achieving full reciprocity under FATCA IGAs. We're still waiting for the US to deliver on its promises, so that would be great for them to do, or also the US could also join the CRS. We know that that's challenging, so until that happens, we also have a proposal of how to make sure that we can solve this, basically how to get information about the beneficial owners of US accounts. It's similar to a surrogate system, so I would be happy to provide more details if there's any interest in that. And then to the topic of uses of information, I mean, the CRS has caused a lot of investment by authorities, by the private sector. So it would make a lot of sense not to use it only for tax purposes, but also to see the potential also for the money laundering side of things. So we think that just as we have the Punta del Este declaration that calls for more cooperation between tax and AML, either that could be used or a new declaration where all countries really commit and allow that CRS data can also be used for AML purposes and can be shared with FIUs, financial intelligence units, even, I mean, without requiring a prior authorization. If we need to assess the confidentiality of the FIUs, which most likely already comply with Egmont and already share information with Egmont, that would make sense, but it would be great then to start sharing that and using all this great data, especially the balance account, also for AML purposes. And this use for AML means that no country should really be refusing to receive information. Some tax havens are doing that. They can choose that under Annex A. That should be prohibited, or otherwise, these Annex A countries, if they offer golden visas, that should also be considered as a higher risk. So that's the issue on who can access and use this. On statistics, we see that's a great and really significant use of information. It doesn't really compromise any confidentiality. The Bank for International Settlements already publishes very similar statistics, so there's no reason why we couldn't be doing this for the CRS. Until we get all developing countries to access that, basic statistics just provide basic data for excluded countries. Thanks to the statistics published now by Australia and Germany and now Argentina, say authorities from Bolivia can find out how much money all Bolivians have in total in Australian banks or even in Argentinian banks, even though they're not yet party to the CRS. Statistics also help with effectiveness. So Australian statistics showed that millions were held by residents from Antarctica and Bouvet Islands. So that means two options. Either penguins were actually owning accounts in Australian banks, or banks made a mistake in the due diligence. So we now know that thanks to the statistics. They also detect outliers. Just by looking into the statistics published by Germany and Australia, we see a disproportionate high number or high value of account balances by some tax havens. So it's a typical tax havens that always appear there when you calculate total account balance divided by number of accounts. And statistics have really fast effects. After the media in Australia and Germany published these statistics, something's happened. By 2020, no more accounts reported from Antarctica or Bouvet Islands, so clearly banks corrected that. And something similar happened with Germany. So Germany had reported that Jersey was a top destination for German money, even surpassing Switzerland. Now, after these reports, money, our account balances in Jersey went down by 98%. So now, thanks to statistics, we could really hold authorities to account, and they could investigate where this $178 billion euro left Jersey and where it went, or if it's actually Germans now abusing golden visas from other countries so as to pretend to be residents somewhere else. Now, of course, to have really useful statistics, we need the wider approach. That is, it would be ideal for all countries not just to collect information on all non-residents, but also to send this information to local authorities. This way, local authorities could publish statistics about all residents, not only just participating countries. And that is precisely what Australia and Argentina have done. In contrast, Germany only published statistics about some 60 countries that were participating back then. And now the last point has to do with beneficial ownership. So there's been a lot of improvements, especially in the European Union, but really all over the world now, where countries are required to establish beneficial ownership registries. The FATF has this year reformed Recommendation 24, so we will be expecting really all countries to set up these beneficial ownership registries. Now the CRS data can have a great synergies and really greatly complement these BO registries so as to verify the data or to complement it when the BO registries don't really have the data yet. So not only is it necessary to be using CRS data for AML purposes, but also to ask for controlling persons to be reported also in the case of active NFEs. So currently it's only for passive NFEs. The hope would be that active NFEs will also have to report this information. We don't expect this to create any more burden on banks because, after all, they already have the data, because for AML purposes, they have to collect beneficial owners for all account holders, so they basically have it. The idea is for them just to be sharing it now. So I think those are our main options. I would be happy to give more details, but yeah, thanks a lot for the opportunity of our wish list.
Perfect. Thank you. Yeah, it's not quite yet time for Christmas, but we've got David from... Yes, it's not yet time for Christmas, but we have David from WP10 who can indeed perhaps give his perspective on this laundry list and to what extent work could be potentially taken forward on any of these items. So I would hand it over to David.
Thank you, Arthur, and thank you, Andres, for this wish list, which is a very interesting one. There are some on the wish list who are good to have. Some of them are easy to have. Some others are hard to plan to have. I start with the easy one, so we go and climb the mountain as we go. First one, statistical data are very good. They help us in understanding what is functioning, what is not functioning. We don't think the penguins hold current accounts or depository accounts of any kind, so probably we have to understand the weaknesses and of the system and how it can be improved. Statistical data are not always as precise as we would like to be, but surely give us an indication where we really made some big or relevant mistakes, so absolutely. In terms of developing countries having access to this data, you mentioned, and I think you rightly mentioned, that they would have this data only if they have enough. They can grant the confidentiality and data protection requirements are met, which brings us to probably technical assistance, because this entire CRS and exchange of data, not only for the CRS, but in general for automatic exchange of information, is based on reciprocity. And the reason for that is that most of what you do in your country, you spend your money, you ask your tax administration to do things, is not for your own benefit, for the benefit of the receiving jurisdiction. So you hope that you have a payback for that, maybe not, but you think that your counterparty is doing the same effort to help you, because you use in your tax assessment mostly what you collect as data received. So there is basically a do-ut-des system behind it. So reciprocity is a matter. And even going beyond reciprocity, I think that in order to receive the data, you have to have the infrastructure and the skills to maintain confidentiality and data safeguards. Because if there is a breach in the data, it's a complicated event. And this brings me to another point, which is general access to the public. General access to the public is surely interesting. We have to consider that, as well as in the case of a breach where data are out of control of the institution who have been receiving it, may bring unintended consequences. For example, not all people would deal with the data in the same way, so I may want to have some transparency or to know about a certain person for many reasons. And so we have also to imagine more general use of this data, which is not legit in some cases, because knowing who are the wealthy people might be interesting for for good persons, but may be of interest for not very good persons for non-legitimate purposes. So it's a very, very delicate point to have it accessible, to what level of detail, and so it's a big issue to be handled with a lot of care, I guess. But there is some point there to have transparency and to see whether general access is possible. The other one is AML, getting information from tax archives. which is something that has been done regionally in certain geographical areas. In some others, in many others, they rely on the legal infrastructure, which is in many cases the NCAA, or Article 26 of the OECD model, which, you know, legally it says very clearly that whatever you collect for tax purposes, it can only be used for tax purposes unless the standing jurisdiction is authorizing you to do it for other purposes, and that is legit both in the sending jurisdiction and in the receiving jurisdiction. So a lot of safeguards from a legal standpoint. So in order to go beyond that one, we probably have to have these safeguards, work on these safeguards. Some countries have done it geographically, as you mentioned, and you mentioned the Punta del Este Declaration. But this has to be something that if it had to be expanded at a more general level, should have enough legal ground to do so, also to avoid that there are countries that are doing on an unclear legal basis, which is not a desirable outcome. And I think I took too long and stop here. Thank you.
That's all right, David, and thank you. You didn't go through the whole laundry list. I just wanted to perhaps, you know, since we have Corinna here who looks after EMEA, so quite a wide geographical area for CRS issues, to kind of ask her to, you know, to see whether she had anything else to share from a practical perspective in, you know, implementing the CRS, including touching on this this issue raised by Andreas and David in developing countries and what we could learn from that process.
Yes, I'm more than happy to share some insight, because I think it is completely, and times really completely different, the experience we have in these countries. Like, okay, Middle East was also then one of the kind of later adopted jurisdiction, but still rather early. In Africa, it's just starting. But we could see, for example, in these jurisdictions, because the authorities, sometimes they don't even have tax authorities. So it's not very clearly who is responsible. And I think this is something we would really request. So sometimes the central bank, sometimes the Ministry of Finance. So it is not clear. So and this also sometimes means, for example, suddenly we have to submit the same report for one jurisdiction. We generate one report to 3 different authorities, and you have to think, okay, normally what's the intent of all this? It's supposed to be exchanged with other jurisdictions. Why do 3 different authorities, whatever authority then this means in this context, need to obtain this information? Of course, you then have kind of some, well, you could scrutinize it and say, are they maybe profiling certain data they receive for other purposes? It is really not clear. We also then receive compliance requests from those different authorities on our client data. This then may lead to additional information that we suddenly have to provide information on controlling persons for active NFEs, which are reportable, for example. So it is expanded in a completely different way. Suddenly they have a penalty regime, which is, there's a trend to this, we see this, that the customer who provided an incorrect self-certification, then if they do not provide the self-certification, has to pay a penalty, and we have to charge the client this penalty. And also this information has to be reported. When it comes to this additional reporting outside this annual reporting cycle, then we have to provide additional data features, which is not part of the XML. And if it then comes to things, sensitive information, maybe like gender, marital status, occupation, so suddenly you could maybe profile such a person. For what reason do you ask this information? And also, from our experience, so because the authorities are not experienced, sometimes we have got problems that we think in primary legislation, the only sentence more or less in primary legislation is, please collect from the 1st of July a self-certification for every account opening. And that's it. And how this is then implemented, it is really then difficult, because we can't use how, with all the different aspects and due diligence procedures in the first place, every account. So even a government we onboard internally has to provide the self-certification. The government, as a client from us, doesn't want to provide self-certification. And we have to say, well, sorry, you made the law. So we have to follow the law, but you have to understand governments are not reportable. You say, well, we understand, but that's the law. So you find yourself at very, sometimes, situations where it's just really, really difficult then to find a way out. And we see that sometimes there seems to be a lack of, maybe it gets lost in translation, for example, and that the authorities really need more advice, more support when it comes really to the implementation process, that they really know how to do it. Also on the point of, okay, who received the information, whether all development countries should have access to this. From our day-to-day experience, for example, in our wealth management, is these relationship managers really still report, okay, maybe they've got a bit more money in these jurisdictions, but they suddenly vanish. Yeah? And if other authorities would receive this information, for them a tax ID, to provide them a tax ID, and we would report this information to the local tax authority in a developing country, this may have serious implications. And I think we have to protect these people as well. So I think it must be safeguarded in a way which is, maybe for us, it's in Europe here, it is not the question, but it looks so different still in countries, markets like Africa or even Middle East.
Thank you, Corinna, for those very practical and insightful comments based on your extensive experience. And slowly it's time for us to wrap up panel one. Indeed, I would be very unpopular with my colleagues and those joining us in person if I didn't afford some time for a coffee break. So we will take away all of these outputs from the discussion to inform the next steps at the level of WP10 in refining the proposals over the summer. And you'll certainly hear from us in terms of the next steps. So I will leave you with that, and please join us at noon 12 for the second panel on due diligence and reporting under the CRS. Thank you.
Okay, so welcome everyone to our second panel on the CRS due diligence and reporting requirements. Following off of the first panel, which was so punctual, we're starting a few minutes late, so apologies for that, but I hope that you enjoyed the few extra minutes of coffee break or whatever break you had where you are. So just to start off today, I'd like to thank our panelists here who we have to discuss this very interesting set of topics with us. I think just as by way of introduction, we are while we had the first panel that was really looking towards the scope of the CRS and what are some of the revisions to sort of scoping issues, this panel will be looking more at what are the particular proposals with respect to due diligence requirements and reporting requirements that were contained in the public consultation document that was recently circulated. So with that, maybe I will just, I'll start by introducing myself and then the panel. So my name is Colby Mangles. I work at the OECD Secretariat to the Working Party number 10 and have been here for a number of years now and am very much looking forward to the discussions we're going to have today and over the next several months regarding these issues. Then I think I'll just turn to the panel we have today, which I think is a very good sort of overall balance of viewpoints on sort of the key thematic touch points that we should consider with respect to CRS due diligence and reporting requirements. So first off, we have Mr. Henrik Paulander, who is the head of section of the Administrative Tax Cooperation Unit at the European Commission, also a delegate to Working Party number 10. Secondly, we have Mr. Kalle Hirvonen, I hope I pronounced that correctly, okay, who is a head special advisor of the Finnish Tax Administration, also a WP10 delegate. So from there we have very interesting perspectives from both the national, supranational, and WP10 perspectives. And then I'll just turn to our two representatives from the private sector. So first, Mark Yuan, who is Executive Director of Tax at JP Morgan, and Mr. Roger Kaiser, Senior Tax Advisor of the European Banking Federation. So, so with that, we have as I mentioned, a very broad panel representing a variety of interests and views. who I hope will provide a good discussion. So if we can just go to the next slide, I believe, this stage. I don't know if Arthur has the clicker, and I skipped that would have been useful for you to have seen a minute ago when I was reading their names, but hopefully everybody was listening. So here, this is the correct slide for what I'm about to talk about, which are the topics that we would like to consider as part of this panel. And specifically, there's 4 topics. Now, of course, in this area, there are many topics that could be discussed, but we, for interest of time, needed to narrow them down to four areas where we thought, really based on the number of comments received and interest generated by the public consultation process, a discussion in this forum would be of most benefit. So the first area of discussion is with respect to the additional reporting requirements of the CRS. And just by way of introduction, I think that something that we set out in the public consultation document, and that is certainly the case, is that this is really a sort of evolution of the CRS reporting requirements. So when the CRS was finalized in 2014, the reporting requirements were really focused on a number of key elements or key issues that needed to be reported for tax administrations to have the appropriate information. With the benefit of time, since the conclusion of the CRS, there has been further consideration given to what are additional features that could enhance those reporting requirements. Specifically, there are proposals with respect to reporting on the role of controlling persons. So while the CRS currently proposes having a reporting on the controlling persons of entities who are account holders, this proposal would also require the reporting of the role of that person. So is it a beneficiary? Is the person a settler, et cetera? Another reporting requirement is that is proposed is whether an account is a pre-existing account or a new account, so making that distinction. Making a distinction among joint accounts and joint account holders, and actually identifying the type of financial account, because as you may know, there are a number of financial accounts, types of financial accounts that are reported under the CRS, and so one of the areas we're considering is requiring sort of the reporting of whether the account is a depository account, a custodial account, et cetera. Then the second main area of our discussion today will be under the heading of strengthening due diligence requirements for pre-existing accounts. And I think we've sort of framed this topic in this manner because the two proposals really go towards the treatment of pre-existing accounts under the CRS. So the first proposal that is relevant for this discussion would be with respect to information on controlling persons, that this information would be needed to be obtained with respect to both new accounts and pre-existing accounts in line with 2012 FATF recommendations. Currently, there is a distinction in the CRS between needing to apply AML KYC rules with respect to new accounts that is in line with the 2012 FATF recommendations, as opposed to pre-existing accounts that has a more general requirement. The other proposal is not technically a proposal, but more of a question that was asked as part of the public consultation, but was whether or not TINs should be collected for pre-existing accounts, as this information could be beneficial to tax administrations. The third point is with respect to incorporating guidance on citizen-based and residence-based investment schemes into the CRS commentary and the treatment of dual tax residents under the CRS. These two areas are somewhat related, but with respect to the CBI-RBI schemes, the OECD published in 2018 a separate set of guidance on this issue and has provided a series of questions that financial institutions could consider asking when they encounter suspicions of account holder having being resident in a jurisdiction based on one of these schemes. And so this is proposed to be incorporated into the CRS commentary. As well as, in addition, there's a treatment of cases of dual tax residency, whereby it's proposed that dual tax residents would be reported for each jurisdiction where the person is a resident. And finally, the last point that I think is relevant to the consideration of a lot of these topics is the treatment of transitional measures. This is obviously very important because what we are proposing is obviously a change to how financial institutions would need to report this information, collect this information. The current transitional measures that are proposed mirror those that were initially proposed as part of the CRS, so treating accounts that as of the effective date of the revised CRS, those accounts would be treated as pre-existing accounts, and then other accounts after that date would be treated as new accounts. And for the reporting of controlling persons, there is a specific provision to allow a 2-year transition period with respect to that reporting, noting that this is a new type of reporting where we would be expecting the role of the controlling person to be reported. So with that, that's a bit of a long-winded introduction. I think the last point that I'll just touch on, just as a matter of housekeeping perhaps, is that there were a number of comments that were raised as part of the public consultation about the interaction of the CRS due diligence with the proposed due diligence framework of the CARF. That's obviously a very relevant question to be handled, but we would just propose that those issues would be dealt with under the panel this afternoon, panel 4 on the CARF due diligence and reporting requirements. So I would just ask for those in the audience who have specific questions on that, we can hold those off and perhaps until the afternoon. So with that, I think that's a fair introduction. So I think we can go to the next slide, or I'm forgetting how many slides we had in this deck. Or I think actually we just leave this up. That's fine. Okay. So with that, I think I'll just jump in to our first topic then, which is the first bullet on this slide. And that is the proposed reporting requirements. So as Artur, my colleague, so expertly led the discussion previously, I would similarly like to sort of generate a very lively debate amongst our panelists, our participants here. And so with that, what I'll do is just quickly summarize some of the public consultation input that we've received. I have a series of questions to our panelists to try and get their views on things, but I would also recommend our panelists to, if you have a question, if you want to jump in, please do so. Don't wait for me. And similarly, as was done with the last panel, we'll go through one thematic area, and then we will be looking for questions and that we can respond to. So please, either if you're in the room today, keep your questions for the Q&A session. You can raise your hand. If you're participating via Zoom, please just use the chat function to submit your questions, and we will try to get to those as best as we can. So with that, the first reporting requirements topic. So as I mentioned previously, the proposed new reporting requirements include a number of additional elements that would seek to refine the existing CRS reporting requirements. In terms of the input that we received via the public consultation, I think it's fair to say that the majority of comments expressed concerns about what was the specific cost benefit of each of these additional information items that were being proposed. Many of the comments noted that, especially from the private sector, were noting that the information that is proposed to be reported is often not available to financial institutions in an easily searchable format. and that therefore this would require significant implementation costs in order to come up with the appropriate reporting framework. And in that light, I think a lot of comments were requesting further clarity as to why this type of information has been requested. So with that, I think with that sort of context, I think the first question I would like to turn to is with respect to Henrik. Because again, as a sort of both a delegate to the Working Party 10 and also a member of the European Commission, I understand the European Commission has sort of been a proponent for a long period of time of proposing refinements to the reporting requirements in the CRS. I think very shortly after sort of the finalization of the CRS in 2014, there were already significant thoughts considered as to why to propose new reporting requirements. What are sort of the utility of that? So I would just ask you what are some of the sort of policy rationales and ideas behind each of the new reporting requirements?
Thank you, Colby, and thanks for inviting me to Paris and to the OECD. It's very nice to be here. So yes, perhaps a little bit of background to this. As you probably know, we have a directive in the EU, which is called DAC 2. It's the first amendment of the Directive on Administrative Cooperation. We're now working on DAC 8, so we've come quite far from that. But DAC 2 then was adopted in 2014, so very closely after the agreement on the CRS, and it is essentially the same as the CRS. And this is, of course, why it's interesting to talk about these two in the same context. So what happened was when we had adopted the DAC 2 in the EU, we started talking about the implementation of the directive, and there was a discussion organized by the Commission, but with all the member states, where we were looking at things that were perhaps missing or could be improved. So we had a number of meetings in working groups. At that time, it was in around 2015, I think, so already some time ago. And what the Commission then did was to collect the views and the conclusions that came out of these discussions, and to propose a number of amendments to the CRS standard. As I understand, at first, the suggestions were to change the XML schema, but it was realized that that was not the good way to go. You have to change the CRS prior to changing the schema, which makes sense. Just overall, the idea with these amendments were to focus on enhancing the accuracy and completeness of the data exchanged, of increasing the matching rate, so for the tax administrations to have a higher matching rate with a better quality of information, and also to have an indication of the quality of the data received, I mean, as an early indication. And the idea here is actually one to relieve everyone from more work, so there will be less need to reconnect to the reporting entity in order to verify information, because you would have a higher quality information. So here we're talking about 4 different categories, and I think I'll just very briefly touch upon each of those. Keeping in mind that the first thinking around this was then looking at the XML schema and the way they were designed. So the first one is looking at the controlling person types, and member states stated that the information provided under the rules as they are now does not always lead to the identification of the type of controlling persons for pre-existing accounts. So if it would be possible to explicitly state the absence of information as regards the type of controlling person by adding a value unknown to the schema, which would then need to be supported by CRS, when it comes to pre-existing accounts, this would be of a clear benefit. It would ensure a better quality of the information. it would also help to understand ownership and control structures and also allocate the taxable income and wealth. So this would, as we saw, eliminate the ambiguity as to the approach taken and avoid unnecessary follow-ups by the receiving jurisdiction. So this was the idea behind this. And the way we saw it, or the way the people saw it at that time, was that there would not necessarily be any need for additional administrative burden and no additional customer due diligence, because this amendment would actually be based on information that could already be available. So that was the idea behind this one. So I'll move to the next one. And that's on the pre-existing account or new accounts. As you said, Colby, I mean, the due diligence for pre-existing accounts is slightly relaxed as compared to new accounts. So for a correct follow-up to information that you have received, it's necessary to be able to distinguish between these accounts that have been subject to very different standards of customer due diligence. If you're able to distinguish between the pre-existing and the new accounts, it would be possible to make some very simple but very useful validations, such as you would know well, the presence of a TIN and the date of birth in the report for new individual accounts. And it would also be possible to conclude on the absence of an indicator on documented account or dormant account in the case of new accounts. So it would simplify the life of tax administrations. In the absence of this type of information, and that was the sort of rationale behind, or if there is any doubt about the quality of the information received, there would be a need to follow up the exchange of information and to make a manual request to get further information. So introducing this change would again reduce the need to go back to the sending jurisdiction and also to go back to the reporting person. I have as a third category the joint account count or number of account totals. I think you had it as a fourth, but well. So as I understand it, this is meant to remedy the situation where an account has two or more holders. And under the CRS reporting, the reporting entity reports the full value of the account for all the holders. Now, when this is received by the tax administration, it doesn't really reflect the real situation in that jurisdiction, where a number of persons may have each a share of the value of this account. So, once again, it's a matter of quality of information and a way of avoiding to go back and need to ask follow-up questions. The fourth category then is the type of financial account. So what we concluded was that the types of income that are included under the CRS may be reported in the context of different types of accounts. Now, this risks missing the context of the payment, and it risks also making it more difficult for the receiving tax administration to match the income to its domestic tax rules. So the receiving tax administration would only know the type of income earned, but would not know the context in which that income was received. So if you have a rule that allows a sort of cross-check between the type of account and the type of payment, you would bring additional clarity to the context in which the income was received, but you also prevent misreporting of income with regard to this specific account. Another benefit of this would be to have a uniform classification among the different jurisdictions. So that that was, all in all, as you can see, all of these suggested amendments, they aim for the similar type of benefits for the tax administrations. That is, it will allow them to make the matching without the need to go for further requests for information. They would have a more complete, more accurate, more reliable information. And as we understood it, in none of these 4 cases is there a need for the reporting entity to go back to the account holder and ask for the information, for this further information, because they should already have it, actually. And I think with this, I've closed on 4 again.
Thank you very much. I think I just quickly just turn to Kalle. I mean, is there anything else you can add? I mean, based on sort of in light of Henrik's policy rationalities given from your perspective as a domestic tax authority.
Thank you, Colby. Good day, all, and thank you for this invitation to Paris. Yes, just a practical point of view. We have to go back in the way that why we exchange the information and what information may be exchanged. First requirement is, of course, that it's needed for taxation purposes. And the second one is that it's used also effectively in receiving jurisdiction for taxation purposes. And the second one is, to sum up very in 2 points, it means the quality of information and the usability of the information for tax administrations. And when we were thinking of having this common reporting standard 2.0, the starting point was that what additional information we need, or is there some information that we report already that is not needed for taxation purposes or used for taxation purposes. Maybe there was some of the jurisdictions have more ambitious how much further information we would need to go that direction, that it would be more easily to use for taxation purposes. It means that more information of taxable amounts and transactional based information, etc. But we end up having this, I would say, more minor proposals for adding only those that we have identified during these last few years when we have used the information, and also taking into account the Section 9 requirement of effective implementation requirements. Jurisdictions have to make sure that FIs have fulfilled the reporting and due diligence requirements, as you well know. And for those purposes, there are these new categories, as Henrik finally explained. But just to briefly say that the controlling person type naturally gives the additional information for the receiving jurisdiction, what type of controlling person the person is. And of course, that influence on the risk analyzed and effects, and also what risks and what tax interests are deal with that, if any, with that controlling persons. And those differs very much, for example, if it's an ownership control or other beneficiary, or is it just managerial role in that. And that information would improve a lot of that usability of the information, and also give us tools what kind of control measures we take and what kind of reasonable explanation we ask from those controlling persons, if any. Whether the account is pre-existing account or new account, has been very useful information, except for in Finland, where we have already have that information as a possibility to report to tax administration. And it's beneficial for 2 purposes. One, of course, that when we receive information and if we find out that there's mistakes or wrong information, And if we know that it's a new account, then there has to be a mistake by either by the account holder providing false information in or not updated information in their self-certification, meaning that they have not followed the change of circumstances rule, or a financial institution has made a mistake. But with respect of the pre-existing account, there are not that high expectations. It's understandable that there is old information. And that also give us information what kind of feedback do we send to sending jurisdiction and what kind of expectation we have for them to act. And the second one, of course, is that when we control our own FIs, when we audit, the starting point is that we always ask them to inform whether the accounts and what accounts are pre-existing accounts and what are new accounts and which account has self-certification and which doesn't. And then we audit whether those are correct and whether the FI has carried out the due diligence procedure correctly. Joint account, of course, it's the question that we need to know that if it's the account holders own or if there's a joint account with many account holders, and that influence on our expectation and control activities. And keep in mind that in situation where the other account holders is resident in the other jurisdiction, we don't get that information, so we don't necessarily know that it is a joint account at the present day. And the final one is the type of final account, and that, of course, as you well know, it's the account type also influence on the reporting, what income information is reported, and also we get more information whether it is direct or indirect investment of that taxpayer, and that also influence on our risk management and control activities.
Okay. Thank you very much, Kalle. So with that perspective, I think from the public sector, I think I would now like to turn the floor over to Roger and Mark. And I think my question for you is that, having heard what we've just had from both Henrik and Kalle about the benefit of some of this information, from your side from the private sector, what are sort of the most beneficial of these different reporting requirements? What are the least beneficial, and perhaps how does that influence your thinking on the issue? And of course, this question is to both of you, so please feel free to jump in.
Yeah, thank you, Colby, and good afternoon, everyone. I would like to start with a statement. As European banks and as a European Banking Federation representing those banks, I would like to clearly reiterate and confirm the very strong support, our very strong support, to the fight against tax evasion and also to the fight against financial crime. It's very important. We take it very seriously, and we really want it to be effective. And to be effective, we think that the requirements should be proportionate. And so I really appreciate the question on costs and benefits. So allow me to provide some general remarks. I have 4, and to then pass the floor to Mark Huyen, who is much more knowledgeable than me and will provide detailed comments on the proposals. I think we have just discussed the overarching objectives of the common reporting standard, and we absolutely need to keep them in mind and to stick to them. And so, what is the objective of the CRS? I think the CRS aims to provide tax authorities in one jurisdiction with indicators, with alerts about offshore assets that are held by a person who is a resident in this jurisdiction, and also about related income payments. The CRS is not aimed at providing granular information, which would be specific enough to prejudge the tax liability. It's very clear. I think this tax liability has to be established by the tax administration after verification of the data that have been received and after assessment in the light of the domestic tax law. The financial institution abroad, the offshore financial institution, doesn't have this information, cannot do it. So we shouldn't change those rules. And I would say that if we look at the CRS in that way, from that perspective, as a general information system, the CRS works quite well. It has been demonstrated by a number of surveys that have been conducted in a number of jurisdictions. My second point is that it's crucial, vital, to maintain the alignment of the CRS with a number of other frameworks. That's the case of FATCA. And there are a number of issues that should be dealt with in this misalignment between FATCA and CRS. It's not the topic today, but there are reasons to provide for a better alignment. Clearly, we have the AML framework, and it's very important to maintain this alignment, to exploit some synergies, at the same time recognizing the specific purposes of each of the two frameworks. We have the GDPR. Can be a very important issue. The data protection authorities, particularly in the EU, are looking at FATCA, are looking at the Common Reporting Standard, are looking at the EU AML package, and it's a very important aspect that we shouldn't that we should have in our views. I think also we should try to create synergies with those frameworks and with other frameworks. And I think in particular of the withholding tax relief and refund procedures. It's now again on the agenda of the EU Commission. And I think that's an important area where synergies could be created. That was my second point. My third one, and maybe the most critical one for financial institutions, is that banks can only report information that is readily available and readily mapped within the metadata they use. So reporting of incremental information that was not required from day one will be possible, but it will be possible only with considerable effort, because it's very unlikely that this information has been stored in a way that allows easy and automatic retrieval and processing for the purposes of the proposals that are on the table. That's particularly the case with the status, the role of the controlling persons of a passive NFE. So moving to my fourth remark, and I will then end up. Any changes, and I'm repeating myself, any changes in addition to the CRS should be proportionate and should be considered if there is an added value. And we really would recommend that a principle-based approach is adopted, given the objectives of the CRS and the need to stick to those objectives, and recognizing that adding new layers of information may not lead to an improvement of the situation and may not achieve a useful outcome. And I would like to draw a parallel with the AML framework, and particularly the recast of the EU AML framework in the context of the new package. The keywords, the buzzwords are effectiveness, enhancing effectiveness, and we have to reduce the haystack of information, the massive flow of suspicious activities reports that are sent to financial intelligence units. I think in the field of tax reporting, we should start having the same reflection and focus on the number of false positives in order to reduce them. We should focus on the material risk of tax fraud. We should better exploit the existing tools. What about using in the tax field the UBO registers? That's one of my suggestions. Thank you.
That's right, no worries. Thanks, Roger. So, as the other panelists said, I'm delighted to be in Paris once again. It's great to see so many familiar faces. I think on the topic of getting more information, we're sort of in this paradigm where everyone thinks, you know, we really need data, right? We need lots and lots of data, and that's the solution to everything. For me, we do need to question whether or not some of the imprecision that lies in CRS information that tax authorities are getting is as a result of the need for more data, or whether that's just fundamental to the design of the reporting regime. I mean, I don't think anyone here who knows about CRS would disagree that it is, by design, an expansive approach to data, right? You want more information, report all the indicia to me. There are loads of scenarios where there would be double reporting of account values depending on the ownership chain of the assets. These are not by accident, these are by design. And in that context, I do query if tax authorities are fundamentally saying, look, we're getting a lot of information, we're really questioning whether this is actually useful, we can't match it. Or maybe it just isn't useful information and you're just getting it because that's the design of the reporting regime. Maybe there's things that we can do to better analyze the information that you're already getting, to exclude the useless information from the useful, to filter it more. I did listen with interest to Andreas from the last panel talking about what I would call statistical anomalies being published and outliers being published by certain tax authorities. To me, none of that is surprising. That's exactly what happens under CRS, right? If you take an expansive approach to reporting, you will get some results that look odd or different. If someone fat fingers Antarctica into one of their indicia fields and that's never resolved, then yeah, they're reported as a penguin, as he noted. On the specific expansions that have been proposed, first of all, I think what's very important to note is there are certain fields where it's very clear that there's some sort of policy objective that's being sought. So controlling person type is the one that was obviously flagged. You know, talking a little bit about implementation, the one thing I would note for people who might not understand why banks are, you know, saying this could be challenging or time-consuming to do, it is simply because, you know, because it was not required to be a reportable field, then many banks will not have developed operational systems to actually pull out controlling person type. Many banks will simply flag certain people as a controlling person because that's all you need to report, the fact that they're a controlling person. That's a fundamental reason why. Now, undoubtedly, there is social utility in excluding senior managing officials, protectors, possibly trustees as well from settlers, beneficiaries, and actual owners. We understand that, but I think for that category, the fundamental point is we need time to implement this. For other categories, like whether or not it's a new or pre-existing account, whether or not you've gotten a self-certification, I do question whether or not you're just going to receive more noise if you receive all of this additional information. Because, for example, if the fundamental question you're asking is, has a financial institution complied with their due diligence obligations? Well, in many ways, the solution is to audit the compliance of the financial institution. It's not necessarily to receive millions more in terms of data points on that. Just finally, you know, as Roger said, we're very supportive of the fight against tax evasion. We do understand the importance of transparency and reporting of information. Again, to echo the point that he made, you know, CRS in many ways is sort of an indicative regime. I think there are probably, in my view, two main policy benefits to it. Number one, there is probably a genuine number of accounts and persons where you will get useful information and it will give you an ability to risk rate who you audit within your jurisdiction. Secondly, there's, I would think, undoubtedly a halo effect, right? The more the public knows about regimes like the CRS, the more likely people are not going to try and evade their taxes. The more likely people are going to think, well, if I try and do this, I'm going to get caught because I will get reported. Those are the two real benefits. CRS has never been a regime about reporting information that is so accurate or available that you can just insert it into a tax return and go to someone and say, hey, you owe us X amount more tax. That's not the intention. And that's not the intention because that information doesn't exist. I'm sure you would all agree that simply taking financial account level information does not give you the level of detail that is required for an actual tax return. So I think that always needs to be, you know, borne in mind when we're talking about expansion. Certainly appreciate some of the policy reasons why some of these data points are being sought. I think as an industry, you know, the fundamental thing we would want people to reconsider is how many of these data points are just simply good to have that may or may not actually improve things materially, and how many of these are really, really important and are likely to improve the quality of the information for tax authorities and for taxpayers as well. And really, we should focus on that latter category. Thanks.
Great, thank you, Roger and Mark. And I think just in the interest of time, as I don't see any questions here in the room, or actually, yes, I believe it's Andres from Tax Justice Network.
Yeah, thanks a lot. And it was a very interesting panel. But I do have to say that I agree more with the people from the government side, clearly, than from the private sector. And even if you cannot just directly use CRS data for a tax return, it does give you a lot of useful data. I mean, even the balance account, which some countries don't have a wealth tax, but others do have or have an inheritance tax. And again, that is a crucial point for anti-money laundering. So I know that for now it's a bit complicated using CRS data for AML, but at least knowing how much money a person has, even if they don't have to pay any tax on that, you can still assess whether they could justify how they got that money in the first place if they have no declared income. So maybe no tax purpose, but a huge corruption or money laundering thing. So in addition to the points that were mentioned earlier about even if you're going to be able to simply say unknown data because you simply don't know if it's a trustee, a settler, a protector, or what it is, just even having that unknown field will be useful if you have statistics, because then if you have that a bank has 90% of their accounts is like unknown, and while others are doing a much better job, you know already which bank to start auditing or like sanctioning. So I think more piece of information. And just as I think Roger was saying about the synergies between UBO registries, it would actually be great if in the details, at least as long as banks have that, you can provide the details about the ownership. So in most countries in the EU, but in most other countries, when you declare a beneficial owner, you have to declare why they are a beneficial owner. 80% of the votes, 50% of the shares, why that is. So if that were also in the CRS, then it would be much easier to verify the data. And so banks are already using UBO registers to report discrepancies. They have to do it based on AMLD5. So I think we'll all benefit, all of you, at some point. I mean, I understand it's more cost, so that's easy for me to say. But in the end, I mean, we are really losing the fight against money laundering and most likely also against tax evasion. So I think there is more to be done. So I would really favor those changes to be implemented. Thanks.
Great, thank you. I think just in the interest of time, we might move to the next discussion topic as it also touches on a lot of the points that were just raised by Andres. And so for the next topic, with regards to due diligence requirements for pre-existing accounts, I think I would just turn it over to Takala and ask for you to just briefly describe what are the benefits to tax administrations with respect to both the requirements on FATF 2012 recommendations, ensuring all accounts are reported in line with those requirements, as well as to ensuring that you receive the TINs for pre-existing accounts.
Thank you, Cody, and thank you for Mark and Roger for those very good comments. I have to say that what we have been trying to balance in WP10 that in discussions and also domestically that we always think about carefully what information additional information we require, and there's expectation always that it's useful for taxation and taking account of that administrative burden, what it causes. An administrative burden it's always a combination of administrative burden, let's say for FIs and for tax administrations, but also for taxpayers. So that's the combination and has to be taken into account. With these new proposed two ones, first I would say about this 10 question for pre-existing accounts. And what we have identified that the quality in general is quite good in this exchange information, and the usability is quite good. So the matching rates, at least in Finland, has been fairly high. But the challenges are dealing with, especially with these pre-existing accounts. And it's understandable to the fact that the due diligence procedure is a bit lighter there. And the challenge is that only what we call strong matching. Strong matching is with TINs, as it says, taxpayers if number, which is unique, and we always can match if we have a correct TIN. And if we miss the TIN, then we have to have other ways of matching that information. And as you can well imagine, that's the key thing with the information that can be identified the taxpayer it's the information is about. So the secondary possibilities are like using names, addresses, date of birth and things like that, but there are some challenges. First, it's different alphabetics, and that means that there's a different forms of written. And the second, jurisdictions like Finland, not all of the world knows Finnish language that well and Finnish names. So the way our names are written, always, not always, but quite often differs, especially with older pre-existing accounts, and same with addresses. So what we call it goes to weaker matching. And that's why the usability of the information gets lower. Let's say in Finland, it's a small jurisdiction, but we receive few 100,000 account information annually from abroad, and total amount of third-party information, it's tens of millions of lines of information. So the matching is crucial, and the TIN is the vital point for that. So that's why we highlight it always with the TIN. And keep in mind that the importance of TIN has been also mentioned in DAC 7, where the jurisdiction have to have all the reasonable measures to obtain TIN. So that's important part. With this FATF 2012 recommendation, that's as we earlier told that it's very important to have the beneficial information. And 2014, we understood that the 2012 recommendation is quite new. So because of that, we understood that it's not necessary always followed yet in many jurisdictions, and it wasn't as a requirement. But now, many years later, we think that it should be, in a way, a minimum standard that way that there's always this beneficial owner, or I would say controlling person information at least the level what is in 2012. And we see it also as a question of level playing field between jurisdictions and also FIs.
Great, thank you, Kala. I think with that, I think the question I would ask, and I think this is maybe more of a question for Mark, but Jose, please feel free to jump in as well. But it's just to provide, from the private sector standpoint, sort of an idea of what would be required in order to bring pre-existing accounts in line with the proposed requirements.
Sure. So on tin, again, I mean, it's very obvious what the social utility is, though I think your example of Scandinavian or Nordic names was a good one. I hadn't thought of that. I'd always thought of, you know, the hypothetical John Smith problem of having, you know, hundreds, thousands, tens of thousands of people with the same name. You know, if there's going to be a clear requirement that's proportionate for financial institutions to use best efforts to obtain TINs from pre-existing account holders, I mean, I don't see any vehement objection to that. I think there are just two things that need to be, you know, flagged that are very important. First of all, account closure and freezing type regimes, in practice, they don't work. And I'll just give you a very simple hypothetical to illustrate the point. You have a very elderly person, your grandmother. Maybe she's been retired for decades, doesn't have a TIN, doesn't need to file a tax return. Are you now telling me that if I can't get a TIN from her, because, you know, account freezing or account closure was one of the suggestions, that I block her bank account so she can't receive her pension, pay for her groceries, pay for her bills? I mean, this is a fundamental issue whenever we start talking about enforcement action for things like non-provision of TIN. There is a tiny, tiny proportion of the total population, I would think, that are genuinely trying to, you know, avoid giving you the TIN so they don't get reported on the CRS. But anytime you bring in measures like that, it's really a sledgehammer and affects everyone in society. And certainly, you know, Roger, you can touch on it, but with FATCA, we've found difficulties in terms of being stuck between some authorities who really want the TIN, and we totally understand that, and other authorities sort of saying, well, you know, you need to be careful about, you know, giving people fair opportunity to have bank accounts as well. On the FATF rules, you know, maybe it's useful for people just to understand what a bank is actually doing for the most part when it does its CRS due diligence. I mean, generally speaking, we are applying the CRS rules as drafted in the relevant jurisdiction. But ultimately, you know, in the absence of a self-certification in particular, what we're reliant on is whatever information the bank has already collected. And for the most part, when you talk about controlling persons, that is the information you've collected under AML KYC. And again, for people, you know, who don't work for banks to understand, you know, this information isn't just like there. I can't just log into my computer and look up anyone I want who has a bank account with JP Morgan for very obvious privacy secrecy reasons. So you know, there are generally segments within the bank that are allowed to access this information. They will pass that information on to the relevant operational people who do the reporting when it comes to CRS reporting. And they are beholden to that information that has been collected, which you assume is going to be compliant with local regulatory requirements. Fundamentally, if we're talking about uplifting standards, again, we have no objection to the uplifting of standards, to synchronizing across the world. You know, as Keith said earlier, one of the jokes we always make is that it's meant to be the common, not the uncommon reporting standard. That's all great. But I'm not sure this is really something for financial institutions, right? Ultimately, it is for the jurisdiction to implement AML rules that are compliant with whatever standard the OECD thinks appropriate, and then for, you know, the requirements to be built that way, i.e., it should be that when a bank goes in to its AML file to fulfill its CRS reporting obligations, the information there is already the information that should be there, right? And that would be driven by local AML law, and it would be driven by, to Roger's point earlier, alignment between AML standards and CRS rules. And you've solved the problem.
If I may add some very brief comments on the tax identification numbers, Mark has referred to FATCA. We have been struggling with the requirement of from FATCA and IGAs to produce a US tax identification number, notably for so-called accidental Americans. I don't know if I should go into the details. It's not. It's a situation that we cannot normally meet in the context of the CRS, but it has been a nightmare. But beyond the case of accidental Americans, we have already also faced many different scenarios of false positives. So I think it's important to understand when we are considering to extend the requirement of tax identification number, that there are a number of legitimate reasons why a customer may not have a tax identification number, or in some cases there is no identification number delivered in certain jurisdictions. And the consequence is that the quality and the quantity of the documentation will not be increased, but what will be increased, I think headaches for financial institutions, costs, burdens. That's very clear. On AML, I'm personally a proponent of alignment of AML and tax reporting, but it must be done with a grain of salt, I would say. And so in this particular case, they are still, how to put it, the AML framework is very fragmented. So we are starting with the FATF recommendations, updated in 2012. For EU banks, the FATF recommendations are translated in EU law, but you know, with AMLD 4, then AMLD 5, then now a recast of the package, which will include a new regulation and a new directive, and that all this has to be transposed in domestic law and regulations. So there are situations in which certain jurisdictions and certain areas where the information will be not available. So what we recommend is that if we want a better alignment, further alignment, okay, but with a prospective approach.
Great. Thank you, Roger. So with that, then I think we can move to the next topic, which is on the integration of CBI RBI guidance. And for this, I think I would just turn it to Kala to ask very quickly to just describe what's the relevance for tax authorities of the information that's contained in CBI RBI guidance, as well as with dual residency account reporting. Thanks.
Thank you, Colby. Yes, what we have identified, not just in Finland or not necessarily in Finland, but globally we have identified that this CBI and RBI and similar schemes has been used for tax evasion and also for circumventing common reporting standard reporting. So what we have identified, in other words, that we have identified that there's a situation, what is in section 9, effective implementation, that jurisdiction have to have rules and procedures in place, and also FIs has to have in place already something for preventing individual use of this kind of schemes. So of course the background is that that the information flows to wrong jurisdiction, not the jurisdiction of resident, but other jurisdiction because of this kind of schemes. And we have identified those, and Global Forum has identified those and published those. And what we feel that way, that it brings more clarity and legal certainty if they are included within the standard and taken into account in each jurisdiction. And there's an expectation that the jurisdiction give guidance what action is expected from financial institutions. with the dual residents, dual tax resident, the challenge is that those are quite complicated treaty questions, and also usually there are high tax interest involved, especially when it's investment income. And now when we have this present-day common reporting standard, the result has been that it's reported to one jurisdiction, not necessarily always to the jurisdiction or jurisdiction of most interest. And we think that that information would be valuable for tax administrations so that they could monitor that what is the jurisdiction or what are the jurisdictions that have right to tax that income. And at the end of the day, the jurisdictions has to agree among themselves that which jurisdiction have right to tax that income and how to tax that income. And there are possibilities how to get this result. One would burden on a financial institution that they have to validate the correctness of that reported jurisdiction, and that other ones are not relevant. But at least my thinking is that that is job of tax administrations, not the financial institution. It's complicated. So the easiest way what it could be done, that it's reported all the relevant jurisdiction, and I think that's the least administrative burden, both for account holder and also for the FIs.
Great. Thank you, Kala. So yes, and so I guess with that, I would just like to turn to Roger and Mark, and I think just with the interest of time, maybe if you can make just a brief intervention on just explaining why the sort of the challenges for financial institutions in complying with these types of proposed rules, and whether or not there's any lessons that have been learned with respect to already what's been done since the 2018 OECD guidance on CBA, RBI, what experiences have been made by financial institutions.
Yeah, to start with, I mean, this is probably the most challenging one for the reasons that Kalle has outlined. The people within a bank who are onboarding clients, validating self-certifications, they're not per se tax experts. They are, for the most part, operational people. I don't think, I'm heartened to hear that there's no suggestion that banks would somehow, be able to interpret treaty-level rules at the client level in that way. So let's just talk about the multi-jurisdiction one first, and we can talk about CBI, RBI. I mean, for a multi-jurisdiction tax resident client, noting that they're few and far between, if the only requirement is that financial institutions make it clear that the client, the taxpayer, ultimately has to declare all of their jurisdictions of tax residence, I mean, fine. I think most self-certifications are drafted in that way already. The challenge is when it comes to sort of a matter of subjective judgment, when the question is, well, should you put this person on notice that there is some sort of tiebreaker treaty type consideration and that they need to take that into account when they're filling out the self-certification? It's quite simply neither the onboard or in many cases the client are even going to understand what that means, right? I'll use myself as an example. I'm from Australia. If you're from an English-speaking country, you might be able to tell by that accent. But I live in London, right? And when I moved to London, it was shortly before the implementation of CRS, actually. And so when I opened my bank account, I knew as a tax person, I put down UK tax resident, notwithstanding the fact that I'm Australian. If you sort of make a real big song and dance of, oh, you need to be really careful about your jurisdiction of tax residence, these are all the scenarios that might apply, I think what you'll find is people who don't understand tax in my position might just say, you know what, I don't want to get in trouble. Tax is making the news a lot. I'll just put down Australia and UK. And what will that result in? Well, the first problem we talked about. You guys are now getting even more information that's useless to you. So I think it just needs to be treated delicately. But certainly that sort of subjective element of knowledge concerning treaty rules, I think we need to always bear in mind that that's very niche within society, right? Unless we propose to massively increase the number of tax lawyers in the world. And as a tax lawyer, I would still question the social utility of that. I mean, it's going to be a fundamentally difficult thing to explain to the public at large. On CBI, RBI, again, as a bank, we certainly do, particularly for higher value accounts, we certainly bear in mind if people are claiming residency or citizenship in jurisdictions that have been flagged. Again, the problem is sort of introducing that level of subjective, decision-making to an onboarder. Really, things need to be very black and white, and unfortunately, it is sort of at the level of, is this person claiming to be tax resident in one of these jurisdictions, yes or no? And if it's yes, what do you do? And unfortunately, it results in lots of false positives. There are countries in there with material levels of population where people who are born there are being asked these questions, and it's sort of ridiculous. But again, that's sort of the level of operational process you need to pitch this at. The questions themselves, I think a lot of people in the industry at large, not just EBF, but BIAC, UK Finance, a lot of industries have sort of flagged that some of them don't necessarily get you to a definitive answer. So for example, saying, have you spent 90 days in any other jurisdiction? Okay, well, if someone says no, does that mean that's totally fine? If someone says yes, does that mean I've got you? Like, tell me where you're a tax resident? Because obviously the residency rules differ, right? Some rely on days, some rely on concepts of domicile, nexus, social and financial ties. I mean, it's just it's a difficult question for tax people to begin with, let alone lay people and the public. Questions like, do you file a tax return anywhere else? I can totally see where you're getting at, which is, okay, if you're saying you're only tax resident here, but you're in fact filing income tax returns somewhere else, then maybe you're actually tax resident in multiple jurisdictions. But again, it doesn't differentiate between scenarios where someone might file a tax return in a country to, say, reclaim withholding taxes or something like that, and there's clearly no nexus there. So I would just end on this. I think with the questions, they need to be targeted and accurate, but also we don't want to fall into that trap of, like when you get a plane and there's always that question, are you a terrorist? Like, really? Like, the real terrorists aren't saying yes to that question. And if your fundamental concern is there are actual tax evaders out there who are deliberately structuring their affairs, claiming residency in these countries, if they're willing to go that far, I mean, additional questions saying, are you really, really tax resident here? I mean, you can guess what their answer is going to be.
Great, thank you, Mark. And so with that, I think we'd like to turn it to our final topic today, which is respect to the transitional measures that are proposed. And here I think we've heard, a number of indications already from the private sector about the need for sufficient transitional measures in order to adapt to whatever changes are made in the CRS. I think I would just turn it first over perhaps to you, Roger, to sort of describe, are there any particular products that are proposed within the CRS or some of the sort of due diligence requirements that you think are important in considering transitional measures?
Well, my comment will be very general, and I will then turn to Mark for details, as I did for the other questions. I think we have mentioned the difficulties that financial institutions face when there are when there are changes in a reporting and due diligence framework. It's not because the information may be available in one specific sector that it is readily available, and that it can be can be retrieved and processed for specific purposes. So a financial institution which has to comply with new requirements will have to adapt IT systems, procedures, test them, and can only start doing that when this financial institution know all the details of the specifications. So it takes time. If we referred to our experience in the field of the qualified intermediary agreements, I'm referring a lot to the US. So the QIAs and FATCA we would estimate that we need approximately 2 years from the date the new rules are published until the reporting period. So that's my first general point. Well, and I will then, I don't think that we will cover the calf, if I understand well, but then I immediately turn to Mark.
Yeah, sure. Just to reiterate that point, you know, within any large organization, tax authorities are the same. Obviously, you have various cycles along which new technology is developed. That's sort of the reason for the 2 years from the year in which the rules are published. You know, if you publish the rules, you know, let's say hypothetically in December 2022, December 2023, I mean, you're automatically not going to fall within the existing tech cycle. You're going to have to push it out, which I'm sure is a issue that all large organizations deal with. And yeah, look, as a general matter, I think most banks appreciate, the systemically important role we play in financial markets, and we understand why we are a very heavily regulated industry. But the question of proportionality is always important, and to be given enough time to implement these changes. And just one final point on that. I mean, obviously, it's not just, as you guys mentioned earlier, it's not just the financial institutions that need to implement the changes, it's also the tax authorities. So if you're going to make wholesale changes to XML schemas, to the amount of reporting information required or the type of information required, it's not just on the financial institutions to be able to build and do that, it's also on the tax authorities to be able to receive that worldwide. And certainly what we've seen in the past is obviously the shorter the timeline, the more likely some countries may themselves not be able to implement within a reasonable timeline.
Wonderful, thank you, Mark. And I think with that, I just turn over to Henrik to perhaps provide us with perhaps an overview of some of the ideas about what's coming down the pipeline on the EU side. So how do you foresee the implementation of the CRS to proceed within the EU, and what sort of timeframes do you foresee as part of that process?
Thanks, Colby. Yeah, as I mentioned earlier, we're now working on the so-called DAC 8, which is planned to contain both the elements, similar elements to the CAF, and then the updates to the CRS. The planned launch of this proposal is for end of September, perhaps early October, but around that time. So there, obviously, usually we try to stick as closely as possible to what is agreed here in the OECD in order not to make life more difficult for anyone, basically, stakeholders, tax administrations, and ourselves. But of course, sometimes there is a reason to do something slightly differently because the EU is in a particular position with special requirements. Now, when it comes to timelines, then you can see what the latest one was DAC 7, which is more or less corresponding to model rules. It was adopted in March 21 and supposed to start to be applied in early 2024. So that's close to 3 years. But of course, the problem for banks and financial institutions is that you don't start when the directive is adopted. You need to have all the other work done as well. Now, that takes a little bit of time for us. We work closely with the OECD when we can to try to achieve something in common so that there are not two parallel systems or schema or so on. This, I think, is beneficial for everyone. It should reduce time for implementation and also costs, obviously. What we can see with DAC 7 now, I think, is there will be, around 18 months before you need to have everything up and running. When it comes to then DAC 8, we have sort of two tracks, you can say. You have the CRS updates, and then you have the parallel track to the CAF. So for the CRS updates, I would say that we are most likely to align with the CRS, I can't really say what the deadlines will be at this point in time, but that would make sense. For the crypto parts, for the CAF part, I think that we are a little bit more flexible in the EU. We will see how the timing looks, but I mean, usually we have 2 years or a little bit more. That's what we usually have. In order to take into account also the development of the various IT elements and so on and so forth. Yeah, I hope that corresponds to more or less what you wanted to know.
Wonderful, and thank you, Henrik, and thank you to all the panelists. I think at this stage we have a few more minutes, and I just to note that looking through some of the questions that we had received previously that were submitted prior to this meeting, there was one question that was submitted by ING. So I guess I would just see if ING is available to intervene. I believe it was a question with respect to the CBI RBI guidance.
Yeah, thank you so much for giving me the opportunity to respond. I am Mehmet Konukseven. I am the Global Lead Customer Tax Compliance for Wholesale Banking within ING. And maybe in general, with regard to due diligence, it is our experience that the majority of the cases can be handled with relatively low effort, while it's a kind of minority of cases that take up the majority of the time. And it's when you have for example, invalid self-certification where you need follow-up inquiries and deliberations that take a lot of time. In this light, I'd like to touch upon the CBI RBI guidance that is intended to be made part of the CRS commentary. We strongly believe more guidance is needed for an effective implementation here. There is currently a set of questions proposed, but I think a little guidance on how to proceed with the answers, as stated also before. Tax residence determination normally is a matter that is difficult and settled by the likes of tax lawyers, tax inspectors, and even courts. There's always a matter of subjectivity involved, and it usually requires a level of expert tax knowledge as well as a thorough investigation of facts and circumstances. So one we believe is outside the typical scope of what can be expected of a financial institution. So then we also refer to comment number 6 that we made in our comment letter. Another point we'd like to make is with regard to dealing with invalid self-certifications. For example, following a change in circumstance, so not necessarily referring to new customers. You might have a situation where examination of that new self-certification followed upon a change of circumstance has an inconsistency requiring follow-up. That follow-up might not always lead to kind of the required or expected result in resolving the situation. So now you're dealing with a situation where you have a document that is a written statement from the customer that is unresolved, and you have to make a decision on how to deal with that with regard to reporting. Do you ignore that information and use, for example, the rules for pre-existing due diligence, as one of the proposals would be? Or do you say, well, I also take into account this written statement and treat it as maybe an extra indicia in regard to reporting? Final point I'd like to make is with regard to controlling persons. We see here that there are inconsistencies with regard to even regulations. I mean, the translation of the FATF recommendations, for example, to the AML directive, and from the AML directive to local law, and local law to interpretations made by financial institutions, lead to a variation in interpretation of controlling person. Also on the side of the customers and even authorities, there is a distinction and a difference sometimes in opinion on who is regarded to be that controlling person. Those disagreements often lead to kind of a blocker or even a kind of a slowing down of the onboarding and due diligence process. There was a comment made on potentially expanding the scope to active NFEs. Well, I think that will lead to even more kind of slowing down of the process and significantly increasing the amount of cases that need manual attention, and also will lead to a lot of disagreements. So I would not support that kind of proposal. I'd like to stick with that. We have made a number of comments. If we can elaborate on those, we will be happy to do that. Thank you for the opportunity.
Wonderful, thank you very much, ING. So I think with that, I think we've come to the end of the time today we have for this panel. I think I would just like to thank each of the panelists here for participating for this discussion. Very in depth and very interesting, I think, for both sides to hear. Thank you also to the participants who have fielded questions. Just as a summary, I think we've heard a lot of different issues from both sides, both in terms of the benefits potentially of having this information, what it could mean for tax administrations in the sense of being able to verify and understand data better. But then I think the private sector has also very well set out sort of its concerns about applying these rules in practice. And I guess just as a final word of conclusion, these are obviously thoughts that we will continue to take back, I think, in our work over the coming months as we continue forward with the finalization of these amendments to the CRS. So with that, I think I would conclude this panel and note that we are now taking a 1-hour break for lunch. So we'll pause now and reconvene here in 1 hour's time. Thank you.
Hello again, and welcome again. I hope you enjoyed your lunch, for those of you who had lunch here in the conference center. We will now start with the third panel discussion on the crypto-asset reporting framework. This panel will cover scope-related issues in connection with the proposed crypto-assets reporting framework, or CARF. And this is also a novelty for us, because this will be the first time that we not only have a virtual meeting, but also have a hybrid meeting, but also have a hybrid panel. So some of us are sitting here. I present to you, to my left, James Gillespie. James is policy advisor at the HM Treasury in the United Kingdom, and he has been the lead person implementing the FATF recommendations on virtual assets in the United Kingdom. I have to my right here Lisa Zarlenga. She's a partner at Steptoe & Johnson, and she is here to represent the Chamber of Digital Commerce. And then we have two remote participants. We have Erica Neyenhuis. She is senior counsel at the US Treasury at the Office of Tax Policy, and she is also a delegate for the United States in Working Party 10. And last but not least, we have Lawrence Zlatkin from, he's Vice President Tax at Coinbase. Welcome, everybody. So I don't know who has the doofer for the, yes, very good, then we can move to the next slide. So as I mentioned, what we will be discussing in this panel session are scope-related issues, and we have tried to distill really the priority issues that have been identified out of the comments that we have received. And we have distilled out of that three key topics: the definition of crypto assets, the intermediaries and scope of the CARF, how they are defined, and the nexus rules that determine in which jurisdiction an intermediary has due diligence and reporting obligations. We will do it slightly different in this panel from the other panels, because in the sense that there has been a lot of focus in the work we've done on the CARF to align what we are doing with the FATF recommendations. For various reasons, we want to make sure that as much as possible intermediaries with reporting obligations are already the ones that are in scope of the FATF recommendations, so that there are synergies there, and to make sure that they can also deliver quality data. And that's why what we would like to do is follow a slightly different sequence, and to, on each of these three topics, first have a presentation from the AML approach. How has this been approached? How have these definitions been approached in the AML world? And then Erica will present the approach of Working Party 10. What is the definition in the Working Party 10 proposal? And then this will be followed by some first reactions from the other panelists from the business community. And then we will hopefully have an interactive discussion and also input from the audience. Let me start with the definition of crypto assets. And here, in summary, I think the comment that we have received that has come back all over through the comments is that we have defined crypto assets too broadly, and there have been various variations on this theme. We have heard comments that the scope is not aligned to the FATF recommendation, and that results in situations where intermediaries may not be subject to AML KYC procedures and have reporting obligations under the CARF. Another comment that we have come across regularly is that it covers crypto or assets that are illiquid, of low value, and therefore should be of limited interest to tax administrations from a tax compliance point of view. Also highlighting that by adding illiquid assets in scope, it makes the due diligence and reporting harder, because it makes it harder to put a fair market value on those assets. And then more specifically, we also have heard with respect to non-fungible tokens that we should reconsider including those in scope, because they're only partially in scope of the FATF, and it's still a very emerging type of asset with different use cases in full evolution. And perhaps last, which relates more to the assets that are excluded from crypto assets, we have received many comments suggesting that we should remove from the scope the stable coins, and on the basis of the rationale that on stable coins there are no meaningful capital gains to be realized, and therefore they should not be relevant for purposes of the CARF. These are, in a nutshell, the main comments that we have received on the definition of crypto assets. But perhaps I should ask James first to tell us a bit what has been the approach in the FATF recommendations to define virtual assets, the equivalent of our crypto assets in the CARF. And I would also be very interested to hear your views or the approach that you have taken when you implemented these recommendations into domestic UK domestic legislation.
Thank you, Philip. So I'm first of all really happy to be here. It's always interesting to see how other areas of policy are approaching these questions. We're looking at something that's really innovative and setting up new approaches to govern an area of technology which is rapidly evolving. So it's really great to be able to talk about some of these issues and try to see how the best way is to approach how to define things like virtual assets and crypto assets. As I'll go on to explain, even the question of defining a virtual asset and a crypto asset is fairly complicated. Starting with the FATF definition, what you really need here is an asset which is digitally traded or transferred, and capable of being used for a payment or investment purpose. So this is an incredibly broad definition which doesn't specifically require cryptographically secured technology, and potentially covers a very broad range of assets. One point I think to make out here is that whether or not the virtual asset has value in and of itself is really important from a FATF perspective. We can imagine all sorts of computer files or digital products which might represent the fact that there exists value somewhere else. So the simplest example is probably a digital bank statement, which shows that you have money in an account, but doesn't have value in and of itself. But for something to be a virtual asset in and of itself, and therefore fall within the scope of the FATF standards, it needs to be not just a representation, but be of value itself. So in this sort of situation, it's the fact that someone owns this particular asset and then transfers it, which, and with that transfer, the underlying value is transferred. That's what makes something fall within scope. So we're not talking about other kinds of digital files. I think the way in which this is particularly relevant is if we're thinking about something like a bond or a security, which is also an asset, whether or not that is a virtual asset as well, will be down to whether or not that digital representation itself constitutes that security. So when it's transferred, the security and the rights which constitute that security are transferred as well. This also potentially includes some kinds of what will be referred to as e-money under European and UK law. Not all kinds of e-money, but where you have something which is of value and is used for those payment services and maybe purchased and then sold for fiat currency, then you may well be looking at something which falls within the scope of the definition of a virtual asset. So this is a really broad definition. That's the main thing, I think, to take away from the FATF guidance. In terms of the UK, we've taken a much narrower approach, partly because we already cover e-money in a different area of anti-money laundering regulation. But we've basically gone for something that's a lot more similar to the OECD definition, which is a digital representation of value which is capable of being stored, traded electronically, and is secured via distributed ledger technology. So this is specifically referring really to blockchain assets. That decision really was taken partly because, as I said, we already cover some of these broader category of virtual assets elsewhere, but because there are specific issues around crypto assets and the blockchain which need to be treated separately and not just with the same set of regulations as other kinds of virtual asset. So with that, I will hand back to Philip.
Thank you, James. Thank you, James. It looks like your approach in the domestic implementation has not been so different from what ended up in the CARF so far. Maybe I could ask Erica if you could explain a bit what has been the approach that has been followed to define crypto assets in Working Party 10 and how that differs from what we have heard about the FATF definition of virtual assets.
So thank you. Just I'm happy to inaugurate the first hybrid panel, at least the hybrid portion of it. I wish I could be there with you, but I hope that this works well for all of us. The CARF definition of a crypto asset, which I'm going to focus on the relevant crypto assets, narrows that scope somewhat, but I'll just focus on the general definition of crypto asset. Should sound fairly familiar given what James has just said. It's a digital representation of value. It's one that relies on cryptographically secured distributed ledger to validate and secure transactions. That's the core of the definition. As a means of future-proofing, there is also a reference to other similar technologies, but the core concept is very similar, I think, to what James has described as the UK approach to implementing FATF. It is also a broad definition, which takes into account the special risks to tax administration and to tax compliance that cryptographically secured assets that are transferred on a blockchain pose. I think that it's important, however, in thinking about the practical scope of the definition, to take into account that the only persons that are required to report information under CARF are those that carry out or assist taxpayers to effect exchanges of crypto assets for fiat currency or the other way around, or exchanges of crypto assets for crypto assets. In practice, therefore, the type of crypto assets that are subject to reporting under the CARF are those that are exchangeable, that are traded, and in that sense, I think are quite similar to the FATF definition. Philip, do you want me at this point to say anything about the closed loop crypto asset definition, or should we stop there?
It's maybe good to already cover that at the same time, yes.
Okay. So there is an exception for what the CARF terms a closed loop crypto asset, which is defined as a crypto asset issued as a means of payment with participating merchants for goods or services that can only be transferred by or to the issuer or participating merchant, and can only be redeemed for fiat by the participating merchant with the issuer. So the concept here is something like an in-game token that can only be transferred within the game and cannot be exchanged for fiat except perhaps by a participating merchant who can do so only with the issuer. We thought that transactions of that kind were unlikely to give rise to taxable gains in many countries, and in any event are a relatively narrow class of assets that are also outside the scope of FATF reporting as we understand it. Well, I'll stop there.
Thank you, Erica. And yes, indeed, in the definition of the CARF of crypto assets in the CARF, we have not taken over in this proposal the reference to payment or the use for payment or investment purposes. The main reason why that was done is because a number of delegates found it a very difficult criterion to apply in practice for a binary reporting system where somebody needs to know, is this asset in scope or out of scope, whether something is being used for investment or payment purposes. Seemed a very blurred and vague criterion, subjective maybe to some extent, and that's why there was a bit more emphasis to apply the filter of who are the intermediaries on which these transactions can take place, to filter out those assets that are not traded on a market. But we have received comments from Lawrence and Lisa and many others that the approach that we have followed is rather broad. And I would like to ask maybe perhaps first Lawrence to share with us what precisely the concerns are with the definition as it stands today.
Well, thank you, Philip, and thank you, everyone. I'm sorry I can't be in Paris, only to enjoy the lunch that you just had and all the fine food and other aspects of Paris that are so great. So I'm sitting here, unfortunately, in the U.S. I think, as I think may have been highlighted by you just now, the expansive definition to the extent that it departs from FATF and therefore includes potentially other assets other than payment and investment is overly broad. I think we've argued for symmetry. I don't know why we should have different rules for FATF and for CARF. It just creates more complexity for people and persons who have to implement these rules. And so the focus on payment and investment, I think, is a sound one. It also reinstates the focus for not only CARF, but for FATF on so-called financial assets. I would argue that crypto assets, which can be very broad, as we all agree, and can include other items that typically have not been subject to reporting. Maybe we will cover them in the future for reporting, and I would leave that for another day. But you know, other assets other than purely financial are, I think, the entire regime, including the regime we have in the U.S., are generally designed for financial assets. And so departing from that and expanding it to include other assets is overly broad. I think the elephant in the room on this one is NFTs, because NFTs non-fungible present an interesting case study for expanding the definitions. For FATF as well, I think potentially NFTs could be covered, again, to the extent they're payment and investment. So I think we argue for symmetry. I would also say that if an asset is already covered under CRS, and there are a number of assets that are digital in nature that could be covered by CRS, and I think you already have panels on this, I think it should be covered by CRS. We don't need it expanded to include CARP. We should again have them symmetrical overall. There should be, CRS should cover the typical ones, securities, e-money, things of that nature. We don't have to cover them under CARP as well. So that's I think, our principal comment, at least with respect to the definition.
Lisa, do you?
Yes, and I am happy to be here today. Thanks for having me. And I do agree with the comments that Lawrence just made. I would add a couple of points. Lawrence talked about aligning this both with CRS and FATF. Erica noted that you guys tried to get to investment assets through the definition of crypto-asset service provider that facilitates the exchanges. We had recommended in our comments, I guess, a little bit more direct way, and that's to adopt a proxy for what might be a financial or investment asset as a crypto asset that's actively traded on an established market, which I think achieves the same goal, but gets there maybe in a bit more direct way. The definition itself, there's some commentary on the definition, that digital assets that don't represent value, where there's no digital representation of value, are excluded. And I think, we've heard that from the prior comments. So that would exclude things like, records of activities, records of materials, kind of like supply chain tokens that follow products through the supply chain, or designations of ownership, or say professional licenses that are done by token. But the commentary explicitly says that many other types of tokens are included, such as rights of membership, rights of property, other rights such as securities or derivatives, and as Lawrence mentioned, non-fungible tokens that represent, say, collectibles or property or games, and that also represent, say, physical assets or financial documents. So it's a very broad definition of crypto asset. And I think the other thing that, in addition to parity with CRS and FATF, we would also suggest, tech neutrality. In other words, there are a lot of assets that are covered here that, if they were physical assets, would not be subject to tax information reporting. And we would suggest that's especially true with the NFTs. But just because they're digital doesn't necessarily mean they should be reported for tax purposes, and trying to achieve more parity among the asset classes that are currently reported. And with respect to closed loop crypto assets, Erica mentioned that that's supposed to cover things like gaming tokens. And I think there might be a technical glitch in the definition itself. It does not appear to cover tokens that are exchangeable between users of the platform, only tokens that are exchangeable back to the participating merchant. And we think by broadening that way, you actually do cover, say, gaming tokens that might be exchanged between users of a game and other closed loop assets. One other thing I would say in terms of alignment with CRS is that Lawrence kind of alluded to this in terms of assets that would otherwise be covered as financial assets under CRS should be covered only by CRS and not by CARF and CRS. I would suggest that the financial institutions that are covered by CRS also report under CRS and not under CARF with respect to those assets. There's a sort of anti-duplication rule in the amended CRS that suggests that financial intermediaries that report an asset under CARF then don't have to report under CRS. And I think we would suggest that that be reversed. And if it's reported under CRS, it doesn't also have to be reported under CARF, and that you achieve parity in that way.
Well, I think just to, on that point, we endorse that completely. Thank you for mentioning it, Lisa. One thing that I think is evident is that and I know you're going to have a separate panel on reporting rules, but the reporting rules for CARF are different than the more limited rules that we would argue are applicable for CRS. And therefore, the more expansive nature of these rules doesn't support tech neutrality. Moreover, it expands the reporting mechanisms in ways that we don't think are absolutely necessary. I think you can achieve the risk analysis and the ability to identify who the participants are without going into the more extensive aspects of CARF. And so therefore, the assets that would otherwise be covered by CRS, to the extent they're not covered by CARF, arguably are subject to these more expansive rules. And we would argue that's inappropriate and it doesn't achieve the neutrality we want.
Thank you, Lawrence, and thank you, Lisa. So I hear from you that you are more convinced about approaches to introduce criteria for payment or investment, to the use of the assets for payment or investment purposes, such as done in the FATF, or maybe even to go for an approach where a filter is applied based on the question whether the assets are actively traded on an established exchange. I don't know, Erica, do you have any questions following the interventions from Lisa and Lawrence?
So yes, thank you for those comments. You covered a number of different issues, and I had questions on several of them. You talked about alignment with FATF. You talked about limiting the scope to financial assets, and you also made a number of other comments relating to alignment with CRS. So I'd like to ask you questions about each of those. Starting with the alignment with FATF, I am curious whether you see whether there are assets that you think would be reportable under CARF that are not treated as virtual assets under FATF, given the broad definition of FATF. And again, I'm referring back here to the fact that only assets that, as a practical matter, that are being exchanged for fiat or for other crypto assets on a platform that facilitates such transactions would be within the scope here. So I'm curious whether your concern is that there are specific types of assets that would not be subject to AML reporting, but would be subject to reporting under FATF, or whether the concern instead is that simply having different definitions is inherently potentially raises issues. So that's sort of question number one. What is there a real world example of something that would fall under CARF but not fall under FATF, taking into account the exchange for fiat and exchange for crypto limitation? And my second question, which is for Lisa, has to do with the actively traded suggestion, but we can come back to that.
Well, the easy answer, I think I covered one already, is non-fungible tokens. So to the extent that they're non-fungible and they're otherwise not used for payment or investment purposes, and again, the term investment can be expanded. You can interpret it very broadly, or you can interpret it more narrowly from a financial sense. But I think many people believe that non-fungible tokens and the exchanges that actually trade them, and there are many, including one that we sponsor, those are not, would not be covered by FATF as well. So to the extent that they're not covered by FATF, they would be covered by CARF. We have different rules and different applications. And again, non-fungible tokens are not, many people think of them in terms of just, as Lisa said, the collectible format. They can be expanded to include other things as well. And the technology will evolve to include that. You can trade, otherwise intermediate. And as I said, there may be other reasons for including those at a future date. There may be other reasons to include them in a separate regime, which really are more tailored to a non-financial asset. But the typical NFT to me is the prime example of one that would not be covered by CRS and by FATF and would be covered by these rules.
Lisa, would you like to add something to that?
I agree with Lawrence that NFTs are probably the big one. There's probably also some low value tokens that may be fungible, including like governance tokens and the like, if they're not actively traded as sort of the proxy we used in our comments, but we don't think would be covered by FATF. I am not a FATF expert, so I would look to James to respond to that. I will also, I guess, respond to Erica's question about actively traded, and I think the question was about well, I think she didn't, yeah, I know what she's going to, okay.
Let us take that after the first question, because I think James also wanted to intervene on the first point on assets that would not be covered by the FATF recommendations and are covered by the CARP.
Thanks, Philip. So I think with FATF and non-fungible tokens, there is, so the FATF guidance is basically that they tend to be collectibles rather than investments, and if it's a collectible, then it's not within the scope of the recommendations. But it's important, I think, at the same time to remember that this is not, this shouldn't be read too formalistically. You have to look at actually how the NFT would be used in practice, and so you've got to look to what actually happens in the market. And I think it's possible to imagine NFTs where you might say that the primary purpose would be for investment and therefore in scope. But I think the basic approach is that they're more analogous to something like art, which is treated separately. In terms of what's in scope of the proposed CARF definition, so in the UK, we have a fairly similar definition, and we've not included entities which issue NFTs in our registration regime. Having said that, it's something which should the market develop in the way as the NFTs become much more about, sort of obviously about investment, that certainly we could revisit. I think in practice, if you think about some of the NFT marketplaces, you can go on to, say, OpenSea, buy an NFT, and as soon as you've bought it, you can click to list it and sell it for a profit. And so there's certainly part of the market which is using it really like a financial instrument, although at the moment that might not be what we'd regard as being the main purpose of the market. So that may not be a very helpful intervention, because I've basically just said it's kind of complicated and you've got to look at the market practice. But I think that that's probably going to remain the case, which is that we don't know yet what the ultimate primary use case of NFTs is going to be. And we probably won't know for a few years. So we've got to try to think about it in a principled way and not get too hung up on the idea that this is called an NFT. But, you know, what underlying that, what is it doing in the market and how are people treating it?
I think we appreciate that and understand that, and therefore we've argued again for more phased implementation of many of these rules, because I think the market is evolving and it changes fairly significantly, and would therefore argue for at least starting for what we know as opposed to what we don't know. And I think, you know, we could spend a lot of time just on NFTs, but I don't know that that's really the expectation or the intention of what CARF was designed for. It should be designed for the more typical assets that are traded on exchanges today, and that are more financial in nature and that otherwise would not have been covered by CRS. That's I think what we would argue for.
So let me ask the question about the actively traded on an established market suggestion that the Chamber of Digital Commerce has made. And my question is, do you have any, details around what those terms mean? How actively traded is active? Is it asset by asset? Is it you're looking to the platform? Could that change from one year to another year? And would but by its terms, would that cover NFTs that are traded on the type of exchange that James just mentioned?
So I think in terms of an actively traded on an established market, I think we'd be looking to something similar, you know, to the definition and for the straddle rules in the U.S. under Section 1092. And generally, you know, you'd be looking to whether there are, you know, easily accessible kind of bid and ask prices, and or whether there's an actual, you know, market where the prices are published. I would say, and Lawrence can probably add to this, that most of your larger exchanges, if tokens are traded on there, will probably be considered actively traded. You know, those exchanges have done the research to make sure that there's probably enough volume to trade and that the market prices are fair. I think when you're talking about maybe newer tokens that don't really have, and we haven't sort of thought through what the level of volume would be, but are kind of a thinly traded token or haven't really been adopted on the larger exchanges, perhaps those might not be considered actively traded for this purpose.
Can I ask you, Lisa, would you find such criteria workable in practice? Because all the criteria here, it makes me think also on the for payment or investment purposes. If you are an individual, an intermediary subject to these rules, I mean, I can see how such rules can work maybe rather easily in the traditional financial sector, where you have a known concept of what is an established exchange and what could be trading volumes on such an exchange. Can this also be put in practice in the crypto world, in your view?
I think it can be put into use. I mean, it may be sort of difficult at first. I think if you go to some established websites like CoinMarketCap, you can see what the trading volume is of some of the larger tokens, and those ones that are already pretty active would probably fall within actively traded. I do think that you're obviously going to have some questions on the cusp for say new tokens that haven't been widely disseminated yet, or say smaller exchanges that may not that may be dealing in those tokens. I do think it's easier than trying to look through to the intent, to an investment intent of the customer. I do think that implementing an actively traded standard would be much more administrable than trying to determine whether it's held for investment purposes.
Well, one of the main benefits of this, realistically, is the ability to report anything at all. So to the extent that there is an asset that's actively traded, there's presumably a price that people would readily agree is the price at which it would be more typically traded in a financial market sense. And so any assets that traded on our exchange or on the principal exchanges, presumably by definition, would be defined as actively traded, and you can establish prices for them. It's a fairly easy way to report. I'm not sure that that's true for certain other assets that could, again, be encompassed by these that are not actively traded and operate more in the nature of an auction or a marketplace where there is no real active trading in and of itself. And so therefore, there's more of a malleable concept of what the value would be and therefore what has to be reported to a government.
And if we were to go the route of the payment or investment language of FATF, how would that be determined? And I appreciate that that's a question in the FATF context, but as Philip said earlier, reporting is kind of binary.
We seem to have lost you for a moment, Erica. But I think we have the gist of the question, which is how would you apply a for payment or investment criterion in a binary system where you need to make up your mind, do I need to report this asset, yes or no?
Well, I don't think this is that hard, but I think again, a symmetry with FATF should be the starting point. If it's good for FATF, it should be good for working party 10 for this definition. I think it's kind of, I think if the asset is actually traded frequently, it has a readily ascertainable fair market value, it's fungible in nature, it presumably is being used as a financial asset and therefore will be covered by payments and investment. So I think you'd actually more readily know what that represents. And I think that's sort of what, I mean, James should speak to this because I think James is probably better equipped to answer how FATF thinks about it. But as he pointed out, it's, you know, it evolves even and probably is subject to different interpretation in the UK than other jurisdictions. But we have no problem, for example, implementing FATF rules at Coinbase.
James, would you have, I mean, because I remember that you mentioned to us that in the UK implementation of the rules, you did not take over for payment or investment purposes. Was there a particular reason why you did that? Was that also because you struggled with the concrete application of this, or were there other reasons for that?
So the answer to this is slightly complicated by the fact that it was the transposition of 5MLD that first brought all of this around. It was that bit of transposing legislation, and although we did go a bit further than 5MLD on crypto assets, that's kind of the context there. I think that the issue with payment and investment purposes is that it's not always going to be clear whether something kind of fulfills that criteria, because at what point, like, many things can be capable of being used in that way, but at what point does market practice get to the point where you actually say that that criterion is fulfilled and that's how you're going to treat the asset? What we've gone for, this idea of digital representation of value, I think gets maybe a bit closer to the underlying issue, which is that you've got something which has sort of an economic value and which can therefore, at least from a money laundering perspective, be used to try to transform that value from something obtained through illicit means to something that looks entirely above board in terms of its origin. So I think it feels to me like a more principled approach. It's maybe focused a bit less on, you know, that question of primarily is it used for this purpose or not, which is, I think it just invites a lot of uncertainty in terms of, you know, how would you know unless there was kind of a law case saying exactly where the line is. Yeah.
Thank you, James. I don't know whether we have Erica back and whether this addresses the question that she raised. It looks like we may have lost her.
Well, it's unfortunate we lost Erica, since I think her views obviously are something we would appreciate. Again, I think the departure, setting up a different regime, would mean basically that we have different rules for FATF than we do for CARF, and that's unfortunate. I think that's not either tech neutral or what we should be doing here. And I don't think we have, you know, while I agree with James that it's more prophylactic, it's interpretive, it's subject to interpretation. Again, you sort of, that's typical for lots of assets and lots of regimes that we have. They're always subject to different. They have gray areas. Not everything is totally binary, and not everything is totally clear. We still manage to go through them, and governments can issue notes or notices or various rules and regulations which can clearly cover what they expect to be included within that regime. So and could expand and define that differently in the future, which I think is perfectly appropriate. I think we should have expansive rules that can be included at a later date as well without being encumbered by specific limitations. So I don't know that that's a problem here. Again, having them different is not helpful in our view.
Thank you.
Yeah, and I would just add the, you know, again, a push for our proxy of actively traded. I do think that that is an easier way to determine whether something is an investment asset or not.
I see we have also a flag up here in the room. David?
Thank you. It appears from the discussion here that the two keywords are actively and established. And everything seems to boil down to the fact that what is actively traded is the level of trading, because what we are providing in the CAF is that if there is an exchange that is involved, so there is an operator that is involved, then it's reported. If there isn't, it isn't reported. So it means that if a token, is a crypto asset, is in the hand of an exchange, is exchangeable by definition. So if it's not covered by the CARF. So is it exchangeable, so it should be reported? Or are we thinking about a level of activity beyond which has to be reported? Or if it's a stall, so it's just randomly traded, we don't report it, because at the moment, if you have been tradable in a platform and you're actually not traded, you are within the scope, but you're not reported. And if you are traded, then you are reported. So we're trying to fix here a level of activity, so 100 transaction, 200 transaction, 1,000 transaction. Is it per transaction? Is it per amount of value? Because different crypto assets may have different relevance depending on the strict or the large circle where they circulate. The other question is established. And in established, are we thinking about having a list of intermediaries, in this case platforms, that have to be monitored to see whether this trading takes place within the list of intermediaries? How do we make this list? Should be a domestic list, or because there may be intermediaries which are not well established, well known, big, but they're still doing the trading activity. So established market in this context, what do you envisage established market? Creating new list, and if you're not on the list, you're not on the market. And even if you trade, this is not trading in an established market. Is it just a matter of practicalities here? Thank you.
Lisa?
So I guess I would say that I don't think you would have any necessarily minimal, you wouldn't have a list of exchanges. If you have a token and you know you can go to Coinbase or Binance or Kraken or any of these exchanges and convert it or exchange it, that would seem to me to be an established market. If the prices are known and available, you can go to the exchange, you can see the price for the token. I think what we're concerned about is, the definition as it stands now is if you can exchange the token. You can exchange any token, even if it has, very little value, even if it represents a physical piece of property in terms of, like we were talking about the NFTs. Anything can be exchanged with somebody. If you find somebody who's willing to take it off your hands, you can exchange it. We're trying to get to a level of activity where you can say, go online, find the price for it, and decide whether to sell it or not. I think that's what, I don't know exactly how you would define that in terms of whether you have to have a minimal level of volume or something like that, but that's what we're trying to get at is there's kind of an advertised price, you can go and sell it for that price, like you would most other marketplaces.
I see that, or I don't see, but I hear that Erica is back online. I don't know, and Erica, whether you have any follow-up questions for Lawrence or Lisa on this particular point?
Yeah, I'm very sorry. My link first froze, and after a few minutes, I could see the people were talking, but I couldn't hear, so I dropped and re-entered. So I'm afraid I have missed everything from a point where I was asking a question about how one would determine whether an asset is held for payment or investment. I don't want people to have to repeat themselves. So perhaps someone could later fill me in, and we could move to another question, which was whether reporting should be limited to digital versions of financial assets. But Philip, if you think we shouldn't move on yet, that's fine too. Just let me know.
No, I think we should probably go on because we are already well beyond the time slot that we had foreseen for this particular topic. But please, Erica, go ahead.
So let me perhaps combine then my questions relating to alignment with financial assets and coordination with CRS, because those are clearly somewhat linked. The suggestion, the recommendation that the CARF be limited to reporting on financial type assets because other types of assets, say art, are not currently subject to similar reporting, suggests to me, but perhaps this is wrong, that the commenters don't believe that there are additional risks to tax compliance from the digital nature of the type of assets we are talking about. And I was hoping to hear from the commenters whether that assumption is true, that is to say, whether the thinking here is that there are no additional risks to tax administration, in which case I would ask for an explanation of that, or whether you would be willing to admit that there may be additional risks, but still believe that those are issues that should be left for another day. And if so, again, the question is, why is that the right answer?
Well, there's a lot to unpack in what you've asked, and I appreciate that. To start off, I think we should try to be practical, just in terms of the way this industry is evolving. It's a relatively new industry. It doesn't really have the bulk or the heft of 100 years of backbone to implement these types of rules in any event. So we're talking about a relatively nascent industry. So as a practical aspect, to expand it and make it more more robust, if you will, and to cover other assets that aren't even covered by FATF, and requiring that therefore we establish different regimes where we may, for certain assets, apply AML KYC from a FATF perspective, but apply CARF instead. All these are just additional burdens. I think we should, which I think go beyond the scope of what this should be. I'm not saying it shouldn't be something we do in the future. I would just argue for symmetry. There's no reason why regulators shouldn't correspond with each other and reach the same conclusions. Typically, these rules have been designed for financial assets. And so the regimes we have in place, including in the US, for example, basis reporting, transaction reporting, they're all designed in a world of financial assets. They're not designed for other worlds, and other worlds have different rules, and we can expand and include them at a later date, and if that's necessary, but they don't include, they are tailored more to the circumstances of non-financial assets. And so I just think we should do this in stages, perhaps. We shouldn't have rules that depart and therefore create different systemic challenges from implementation, and should cover what we know as opposed to what we don't know and how this is typically designed.
Erica, would you like to add something to that, or?
Well, I will observe that CRS and FATCA were new when they started. There was, they created regimes of a kind that didn't exist before. So I'm not sure the fact that something is new is necessarily a reason not to do it. But obviously there are practical concerns with alignment with AML reporting that are quite significant and should be taken into account. On the question of coordination with CRS, I have a couple of questions. One is if we were to draw the line that you're suggesting that crypto assets that are more like financial assets should be subject to CRS reporting in the first place, or perhaps CRS reporting only CRS reporting. A couple of questions. One, is it clear how one draws those lines? For example, in the case of stablecoins, would it matter whether it is a collateral-backed stablecoin or an algorithmic stablecoin? Would we find ourselves drawing new lines that may or may not be difficult to draw? And secondly, would we, if we adopted the approach that you've suggested where CRS takes primacy, would the result be less reporting than what is contemplated under CARF, or is it just a matter of which entities are doing the reporting? And in particular, what I have in mind here is that the CRS requires custodial entities to report, but would not cover the non-custodial entities that the CARF, as in its current form, would require to report. So the questions have to do with line drawing and with whether information currently contemplated to be subject to reporting would be lost.
So first, I apologize if I was confusing about the way I described newness. I didn't mean to suggest that these are not new and that we can't implement new regimes. Obviously, I think we can. So I agree with you on that. I'm just saying that the institutions that are subject to or were subject to CRS reporting are typically more robust and have more history of establishing systems and being able to build on that than this more nascent, technologically advanced, but relatively new industry. So it's just simply a practical aspect of who we're dealing with, because we're not dealing with the major institutions that we all know. I could name some of them, but as opposed to that, institutions that are generally less than 10 years old. We are one of the oldest, and we've been around for 10 years. So, so that was my principal point for that. I do think, and this is a comment I think will be made on the next panel, the reporting required for CARF is more extensive. It's different, as you know, because you intended it, I think, that way, than it is for CRS. So, and I'm not so sure why we have to or why we would do that differently. I would argue for this is an argument I've been making repeatedly, ask for the information that's really helpful that will get you what you need. Asking for more is not necessarily better because, again, governments have to digest more information, build systems themselves to understand and interpret, apply risk parameters to that. I think it should be limited in scope to what you actually need to identify levels of risk, to identify the taxpayers, and then impose burdens on them to demonstrate why they did or did not report adequately. Going beyond that and getting reams of information that could be transaction-based, could define, cover aspects of, for example, in the CARF for retail transactions, what individuals actually do, could potentially be viewed by most taxpayers as invasive of privacy. These are just aspects of CARF that go beyond the nature of what CRS does. So I would say if you're going to, and therefore, if as well, if you have them covered by both, then we've now expanded the CARF definition to certain securities derivatives. Again, the ones that may not represent pure CRS type assets, but more extensive reporting that would be necessary for those. And again, I don't know why this industry or this new technology should have different rules and more expansive rules than what we think is adequate for CRS itself.
Yeah, I would just add to that. I agree with that. And our comments also indicated that we thought that CARF should be aligned with CRS in terms of the information that's being reported. Obviously, that's going to be covered on the next panel. But in that sense, if you have basically a crypto asset reporting regime that aligns in the information to be reported with CARF, then you have a little bit less need for that line drawing that Erica referred to. the other thing is if financial institutions are already subject to CRS, imposing an entirely new regime on them, even with respect to assets that are similar, such as like securities tokens or derivatives or stablecoins, as we mentioned, seems to impose additional burdens on them, and they're already subject to a reporting regime that they have implemented. And so with respect to financial institutions and financial assets that fall within those established definitions should be covered by CRS. But I think more broadly, we had proposed applying a CRS regime essentially to crypto assets, which would put less pressure on the drawing of the lines.
I am sure there will be more discussion about that in the next panel. I'm looking at Erica, whether she wants to raise any further questions that relate to the assets and scope, or whether we can proceed with the discussion on the intermediaries and scope. You are on mute, Erica. We didn't hear you.
You're saying there are always more questions, but I think we should move on.
Okay, thank you. So let's move on to the next building stone to define the scope of the CARF, and that is who are the intermediaries that are subject to information reporting. And again, here we have in this work tried to align to the definitions in the FATF recommendations. The main comments that we have received in this area are twofold. One is let's try to not cover or shoehorn decentralized exchanges in the scope of these rules. Leave that for a later stage because it's too difficult to include them right now. And another call that has been made by various commentators is to foresee a kind of a sandbox regime or a transitory regime or a relief regime for smaller startup exchanges, taking into account, as Lawrence already alluded to it, that there are a lot of newcomers and smaller players in this sector. So these are the two main comments that we received. And I'm looking again at James, perhaps, to see a bit how has this been dealt with under FATF.
Thanks, Philip. So at the FATF level, there is a concept, as many of you will know, of a virtual asset service provider, which is necessarily broader than that of a crypto asset service provider, reflecting the broader definition of virtual assets that I mentioned in the last panel. So for something to count as a VASP, or virtual asset service provider, the requirement under FATF is that as a business, it conducts one of or more of 5 types of activity or operations on behalf of another person. So those 5 are exchange of virtual assets for fiat, or vice versa, exchange of one virtual asset for another type of virtual asset, the transfer of virtual assets, the safeguarding or administration of virtual assets, and the participation in and provision of financial services in relation to the issuance of a virtual asset. So in the UK, we've basically implemented this, albeit with slightly different wording. So we have 2 categories, a crypto asset exchange provider and a custodian wallet provider. And the other difference, obviously, is reflecting our narrower approach of only including crypto assets. We don't deal with anything that isn't blockchain secured. So a custodian wallet provider is essentially a business which will store your crypto asset for you, i.e. manage the private keys on your behalf. So you're not personally holding or managing those on your computer. And an exchange is simply a business which will exchange virtual assets for fiat or for another type of virtual asset. So the other 2 requirements worth mentioning are this should be done by way of business. So there is a by way of business test which is looked at by our regulator on a case-by-case basis. But the idea here is to capture organisations which are offering this as a commercial service, not those which are only doing so sort of occasionally on their own behalf, for example. The other factor to mention is that this doesn't include software. So as with FATF, the idea is that you have to be really actively providing a service. You're not simply designing software. Having said that, I think both with UCO and with FATF, just because someone is a software designer doesn't mean they can't also be a VASP and or a crypto-asset service provider. And the key issue there really comes down to whether or not that business is providing some kind of active role in, for example, updating the protocol or actively facilitating transfers of the asset. So, for example, if the software was simply posting bid and offer prices for a particular crypto asset, that's not going to fall within scope. But if there was more of a role in terms of actually facilitating the transfer between two parties, then obviously the detail will be important, but that's when a software provider could also be a VASP in addition to that. So with that, I'll hand back to Philip.
Thank you, James, and I'll ask Erica to tell us how that compares to the CARF definition.
Can you hear me?
Yes, now we can.
Can you hear me?
Yes, we can hear you now, Erica. I think you were frozen for a few seconds, but now we can hear you.
She may not hear us.
Ah.
Yeah, I'm sorry about this. I hope that the connection will remain. But so the definition of a reporting crypto asset service provider in the CARF is any individual or entity, so not just entities, that as a business provides a service effectuating exchange transactions for or on behalf of customers. So I think that broadly sounds quite like the FATF and UK definitions. Can you hear me?
Yes, we can hear you.
Oh, shit. Okay, I'm sorry. I can't tell because my screen keeps freezing. And the definition goes on to say that providing a service of this kind includes not only acting as a counterparty or an intermediary, but also making available trading platform. The consequence of all of this is effectively to say that if there is a person or persons acting either as individuals or as an entity that are regularly as a business facilitating transactions that can give rise to taxable gains, that they ought to be reporting entities. The commentary adds significant glosses to this definition. It does not include persons who are simply validating transfers, for example. It also, unlike FATF and the UK rules, does not include mere custodial wallets that are not involved in effectuating exchanges. It does, the reference to making trading platforms available does refer to decentralized exchanges, but there is a concept there, there's a limiting factor, which I believe is also in FATF, which is that you need to look to someone that is in control of the platform or has significant influence over it, sufficient that they could modify the protocol in order to bring into force the reporting, the diligence and reporting requirements. So that again, it is intended to follow the general concept that persons that are required to apply AML rules under FATF would also be subject to reporting obligations under CARF.
Thank you, Erica. And I believe Lawrence, you were one of the commentators to say that we should, quite explicitly, that we should try to make sure that we do not cover decentralized exchanges at this stage. With what you have heard, both from the from the FATF perspective and from Erica, what would be your comments now on that?
Well, I think we could go down the proverbial rabbit hole in terms of, and suck all the oxygen out of the room in discussing how this applies to DeFi. And I'm not sure how helpful that will be ultimately to the implementation of this whole process. I would start, I think we've argued for, again, phased implementation. We should ideally cover those issues after we have the experience of establishing rules and procedures and protocols for what we actually do know. We do know typically who the exchanges are who are more centralized, what we call CFI in nature, and who can implement systems and have clear definitions of who their customers are, treat themselves as VASs, do AML KYC today, follow the 5th money laundering directive that James referred to. So I think it's a pretty obvious set of institutions or entities. It's a lot harder once you sort of migrate into the world of DeFi, and to the extent that we allow that to sort of inject itself into the process, we're going to be talking about this for a very long time. It's not entirely clear who controls DeFi platforms. They're often software protocols. They're not designed to be controlled by their very nature. They're decentralized in terms of scope. The entities that normally set up the protocols or can adjust them themselves aren't necessarily controlled by various persons, so there's no definition of control. They may not view themselves as having customers. They may not accept consideration today. That is the more typical DeFi platform we have today. And so maybe we should just wait until they sort of fit the parameters more readily. But I think, again, we should focus on what we know and not focus on what we don't know, and develop rules that I think can be developed with a lot of existing history and follow and cover the institutions that we think would more readily lend themselves to this process.
I would just add, our comments suggested a similar thing, that we don't apply it to decentralized platforms at this time. Continue to study them, see, they're quickly evolving, see where they end up. And I would also point out that they, even with all the hype surrounding DeFi and decentralized exchanges, they still represent a pretty small percentage of the transactions out there. So I don't think it will hurt the tax transparency system to wait just a little while and see where they land. But I wanted to ask James a question in terms of, because in your remarks you said basically that you do apply AML KYC to decentralized platforms, or at least they fall within the definition. And I'm curious as to how that works in practice, because there is that notion of control or sufficient influence over a platform that you would be reporting, and how does that apply in practice?
So I think the best way to think about it is not so much as how do we treat decentralized exchanges, but where the line is between something which is merely software and something which goes beyond that, where a service is being actively provided. So, if the decentralized exchange genuinely is just software and you can't really identify any person that is responsible for that, running that in the way that you might with a business, then we wouldn't be, and the FATF wouldn't be considering that as being sort of a virtual asset service provider. But there can be instances where you have software which is updated by a central entity or a person. Potentially, they're also kind of designing aspects of how that works. They might also have some kind of ongoing business relationship as well. So if the users of that platform have entered into some kind of contract, obviously that becomes quite indicative of there being more than just software being provided. And equally, I think when you're looking at anything which involves some kind of control or influence over the assets, again, that seems to be going beyond what just a bit of software would be doing, and is allowing a particular identifiable person to have some control and discretion over how that service is offered. That's a kind of a very long-winded way, I think, of saying that you really need to look at each case on its merits, and if it's just software, then it's not in scope. But if services are being provided where you can identify someone doing things like updating the protocol, maybe having a contract with the users, being able to kick someone off the platform if they breach rules, then it's looking a lot more like that isn't just software. There is something on top of that platform which is being provided.
Can I ask a question, James? When you define it that way, since in many instances, at least in the world of DeFi, there's no clear institution or entity in the way that I think you typically would see, how do you manage through that particular challenge? So we all, I think, probably know that DAOs, or decentralized autonomous organizations, are typically sponsors for much of what exists in DeFi, or variants thereof. And a DAO itself is not incorporated. It's not an organizational entity the way we typically think about it. It is inherently designed to be sort of a governance mechanism, consensus-based. And so no one really controls it. So at least legally, from that perspective, as we understand it. So how does HMT deal with that, or how does FATF deal with that?
So this is a really good point, because I think this goes to the question about what is the right sufficient level of control. And if you've got a decentralized autonomous organization, I don't think it's going to be possible, at least in the great majority of cases, to find an individual with the sufficient level of control over that platform. To sort of quote from the FATF produced virtual asset specific guidance, and they talk there about control or sufficient influence over assets or over aspects of the services protocol. So it's difficult to see in a DAO how you might identify that person, in which case then it's likely they'll fall outside of scope of being a VASP or crypto asset service provider. But obviously each platform's rules may differ, and potentially you could find a situation in which you can identify a single person with sufficient control over the protocol that you could find them within scope. But if it's, for example, a DAO with, the voting is with multiple nodes, and you have the control is really fractionated, then I don't think you can identify any single ones being within scope. And ultimately, it comes down to this idea, I think, of you've got to look at each individual case on its merits and see whether or not it meets that test of any identifiable person having sufficient control over the protocol or over the assets.
I'm looking at Erica to see whether she has any follow-up questions on this.
Yes, I have a few questions. The one has to do with, is the primary concern that we don't know enough? Is it that it's hard to find someone who is in control, or is it a question of kind of practicality? We should. To take Lawrence's, language, we should start with what we know. That will be a lot of work as it is. So kind of I'm trying to reason for suggesting that that CARF should not take on decentralized exchanges right now. So that's one question. The other has to do with kind of level playing field issues. Lisa said that decentralized exchanges are a relatively small part of the ecosystem right now. But my understanding is that they're growing fast. And we all know that this particular area changes very fast, much faster than governments, at least many governments so far, have been able to keep up. If CARF does not address decentralized exchanges, now, is there a risk that a substantial portion of the transactions will be carried out on these exchanges a few years from now, and that we would have missed an opportunity to require reporting of an important part of the ecosystem?
So
well, I would say in response, all of the above. I'm sorry, Lisa.
No, go ahead, Lawrence.
So I would say all of the above, just in terms of the challenges associated with this. And again, it would be easier to focus on what we do know. I think that governments can respond to the extent that this grows in size and becomes a major component beyond what it is today. I would argue that we would probably most likely have responses from individual governments, and CARF itself is not just finite. I assume it can be redefined, or this working group and working party can meet again and discuss the more practical aspects of how it applies in the world. DeFi will have more clarity in terms of how it operates. I would just say, as a practical matter, I just don't even know how to apply these rules. And I think that, again, we could spend a lot of time and suck a lot of oxygen in the room to just focus on how it should be applied to this very nascent aspect, which is probably, at least mostly, estimated to still be in single digits in terms of percentages. I could be wrong. People have different perspectives. So I think we, again, should focus mostly on what we do know rather than what we don't know.
Yeah, I would agree with that. I do see your point about concern that, with the growth of decentralized platforms that, the folks that don't want to comply will sort of start moving their business elsewhere. So I don't think we would propose making that a permanent thing, but just to try to implement the reporting for your more centralized platforms first. I think you're gonna run into probably greater implementation difficulties with decentralized platforms than you will with centralized platforms. Even if they're reporting the same things, just getting because you're going to have to build it into the platform itself. There's not going to be a centralized party doing on-ramping and off-ramping of the customer and collecting the information and sort of that personal contact. And I think once you implement it with the centralized exchanges, where they are kind of getting that personal contact and they're upgrading their systems to actually report the information, you'll probably have lessons learned from that process that can be transferred into the decentralized space. I think it's just going to be difficult at this time, I think, to have those platforms implement reporting. And it might be easier. I know that the commentary suggests if these platforms are already subject to AML KYC, then they would have to report, and perhaps those are the first decentralized platforms to be subject to these rules, the ones that are already doing AML KYC collection, because you have a person presumably that's doing that, and you have that contact with the customer. So that might be the easiest place to start this process.
So I would argue that the technology, and so I think these are really important questions. I just don't know that they should be the focus of CARF itself. As Erica knows, we've actually thought a lot about how this world should apply in the world of DeFi. We're not suggesting that people be allowed to engage in tax avoidance and find shelter in DeFi versus CeFi. That's actually contrary to the interests of our exchange as well. I just think we have to develop more innovative solutions that are not easily defined this way. I think we should try to leverage the technology with identity tokens and establish mechanisms within the software protocols to reincorporate taxpayers into the world of reporting. I just don't know that CARF is the right avenue or vehicle to do that today, and that we should pick up on that over time as we learn more about it.
I think we've probably covered the essentials here on this definition, and I'm not sure how much time we have left to connect. So.
I have a question for, if I may, just on this as well. So if you are a centralized exchange, you otherwise report transactions, but you understand that various customers of yours may go onto DeFi, and you lead them, or at least allow them to migrate in that direction. Do we think that that world is also, because there's a centralized platform, but it's not actually doing the transactions, they're doing them elsewhere on different software protocols, but you've essentially migrated or allowed them to use your platform to migrate to that? Do we think that centralized platform, or the otherwise reporting agent, which again doesn't know what's going on in the world of DeFi, is now a VASP for purposes of FATF. Is that, James, how you would think about it, or is it still sort of an open question?
So that's a really good question. I think it's probably an open question at the moment. There are definitely situations in which, and I think sub-custody of digital assets is an example of this, where effectively, if you're just contracting out a service that you're providing, then I don't think you can then say, oh, well, actually, I'm not providing the service because, well, actually, you've got this contract with your customer and you're simply using this software to fulfill that contract. You can't really get out of your obligations by doing that. I think where it gets more complicated would be where, for example, you have a website which logs you on the basis of, say, a software wallet, like a MetaMask wallet, and when you make sort of a purchase of crypto assets, it's sort of linked via that software wallet. I think that becomes more complicated in that situation, and you're probably, not that you should treat this as like an authoritative opinion, but I would say in many cases you wouldn't be providing the services in that instance, because it's almost as though you're, like there's a plugin which the customer already has, which plugs into your bit of software or your server. It's not a question of you having sort of chosen a provider to provide a service that you're contractually agreeing to provide. I'm not sure if that distinction made sense to you, but I think that that's the closest that we can get at the moment to answering that.
Thank you, James. And I think unless there are any further pressing questions or points on the topic of intermediaries in scope, I'm afraid we'll have to move on to the last topic of this panel, and that relates to the nexus rules. And here there is a particular challenge, because we hear very often that the sector of the crypto sector is very mobile, and it is also less, I would say, or for at least investors in crypto assets are less concerned about whether this business is regulated or not. So the choice of countries where a crypto asset service provider can locate itself is in a way bigger than the number of countries that qualify as a good country for a traditional financial institution. And that has its particular challenges when we develop a crypto asset reporting framework, where we try to avoid that the framework can be easily circumvented by just moving to another country that does not participate in the reporting framework. I'm sure that also in FATF similar concerns exist. So I'm going to ask again James to explain to us how has this been approached for AML purposes?
Thanks for that. So this is a really interesting question, because I think it goes, it's an area where there's a bit of overlap in terms of what we're trying to achieve and the ways in which people might try to get around it. So under FATF, the expectation is that you apply the standards to entities operating within your jurisdiction, so carrying on business, having operations in your jurisdiction. It's not based on where the customers are, although there isn't any prohibition on a country choosing to require that any company offering these services to its citizens should have AML registration. In the UK, we're in an interesting phase at the moment, because for the money laundering regulations, we do apply this territorial criterion of carrying on business in the UK. But from next year, we'll be bringing crypto-asset financial promotions within our financial promotions regime. And the FinProms regime is based on whether or not the promotion is capable of having an effect in the UK. In practice, that means whether it is addressed to UK consumers. The financial promotions regime is a consumer protection regime, and there's clearly a slightly different logic at play here, because when we're thinking about consumer protection, primarily what you're concerned about is protecting people in your country from being misled, whereas with anti-money laundering, you don't really want money laundering to be happening in your country regardless of where the predicate offence took place or regardless of where the criminal is based. So that's sort of more why you've got a different basis of territorial application there. Nevertheless, you do get this issue of, and we know this from investigations by our law enforcement authorities, criminals are very adept at knowing which jurisdictions, and not just jurisdictions, which individual crypto-asset companies have lax KYC controls, or which turn a blind eye either willingly or just because they don't have the expertise to rule breaking and money laundering. And the way in which obviously we try to deal with this is through the FATF and encouraging more countries to increase their monitoring and trying to make sure that countries have the knowledge and expertise with their local supervisors to prevent and detect illicit finance. I'm not a tax expert, so I'm not going to comment on exactly whether tax is more analogous to the money laundering side of things or the consumer protection side of things, but there are clearly two different options you can choose here. Which you go for really depends on what's your objective. You know, if you're trying to protect people within your jurisdiction, then something based on where the service is being provided into may be more appropriate, and would also take into account the fact that different jurisdictions can reasonably differ in terms of how they strike the balance between consumer protection and freedom of contract. But then if you're looking at something like stopping terrorist financing or stopping money laundering, hopefully we all agree that there shouldn't be too much jurisdictional difference on the desire to stop those, and maybe in that situation you're more willing to adopt a slightly different basis of jurisdiction. But food for thought.
That's an interesting, I think, distinction here, and I would think that the tax reporting framework would follow more the logic of money laundering rather than consumer protection. But perhaps, Erica, you could tell us again what the approach has been so far in Working Party 10.
Yeah, so the CARF has proposed a broad definition of nexus in order to address the same kinds of concerns that James was describing. It sets out a hierarchy of nexuses to a country. The idea being if an RCAS falls within one of the criteria that is higher up in the waterfall, then it can just stop there and ignore the lower tiers. So the first will sound familiar to a tax audience, and that is that a CASP is tax resident in a particular jurisdiction. If that jurisdiction is a participating jurisdiction in the framework, then the CASP would report to that jurisdiction. The second is that the CASP is incorporated or organized under the laws of a particular jurisdiction, and also it either has legal personality there, or it is filing an income tax return or an information return reporting its information. To take into account the unusual characteristics that Lawrence alluded to of some platforms, there are two additional nexuses. One is that the entity is managed from a jurisdiction. That is broader than the typical tax criterion of effective management, to reflect the fact that the people managing an entity may be located in multiple jurisdictions, and that there may not be a single place of effective management as we normally think of it. I'm mindful that the employer of one of the people on the panel says that it has no headquarters, and they're not alone in that regard. And then the last of the prongs on the waterfall is an entity with a regular place of business in a jurisdiction. And again, that's intended to reflect the fact that the people running that the entity may have contacts with multiple jurisdictions. One other gloss on this is that if an entity qualifies at the same level, that is, for example, tax residence, if it qualifies in multiple jurisdictions that are participating jurisdictions, then it can effectively choose one of them and then notify that it is reporting in that jurisdiction and not other jurisdictions. So that is intended to be quite a broad scope for Nexus, and we hope that will cover the jurisdictions that are relevant for our purposes.
Thank you, Erica. And indeed, we have gone for a broader nexus than what you see in the CRS, but at the same time, we have not gone as far as also having as a nexus the location where the customers are based. And this is maybe one of the few areas where the comments that we have received went in the other direction, like on assets and intermediaries. The general gist was it is too broad, and here we have received numerous suggestions that we should perhaps consider implementing a remote nexus, so a nexus that is as a default or as a fallback, let's put it that way, in situations where the other more residence type based nexuses are not meeting the objective. I don't know, Lawrence or Lisa, whether you have any comments on these suggestions that were made to consider a remote nexus to avoid slippage and avoid intermediaries moving their activities out of participating jurisdictions to circumvent reporting under the CARF.
This is a tough area, actually. So I endorse efforts to try and encompass within scope entities that engage in the transactions that we think should be covered. I don't think people or entities or persons or other structures should be designed to avoid them. And so we would endorse broader nexus rules, I think, that create a level playing field among all participants in this world. I don't think we would argue for entities migrating to places where there is no reporting and easily do that and circumvent these rules. So I endorse that effort.
Yeah, I would agree with that. That being said, I think we thought that the Nexus rules were pretty broad, and we couldn't think of particular scenarios where they wouldn't be covered, but I think generally we don't want to create a competitive edge for those jurisdictions that do not adopt this, so that companies start moving there. So.
Looking at Erica to see whether she has any follow-up questions on this topic. I have the
I just one, which is if you CRS context and the context of other OECD rules, they have tended to rely upon what I would call perhaps soft means of enforcement, name and shame, blacklists, gray lists, and the like. The question I would ask is whether you think similar mechanisms would be effective here, or whether you think there's something different about these platforms that would mean that those mechanisms would not be adequate to ensure that there's no, there's no haven somewhere where platforms can base themselves and avoid the CARF.
I think you may find this surprising. We endorse all these efforts, and so this is one area where I think we would encourage more than just naming and shaming. I think you need to have a regime. If we're going to have a regime that works, we don't want to have entities incorporate or otherwise exist and thumb their noses at this whole process. We're going to invest sufficient resources to implement this. This is expensive. We also think it's in the interest of the industry itself, but to the extent that there are entities and aspects of persons who don't and locate offshore in places that are not covered, I think that does create asymmetry that I would discourage completely. So I would argue for more harder measures than just soft naming and shaming.
And I would just remind you of how mobile this industry is. They can really kind of set up anywhere. And, you know, there is a little bit of, you know, because the industry is digital, there's a little bit of, you know, some participants say, well, we don't exist anywhere. And so, you know, to Lawrence's point, I think that you may need to be a little stronger with this industry than maybe other endeavors.
Thank you, Lisa and Lawrence. James, do you have any experience?
And to that point, it's implicit in what you're saying, but I'd just like to confirm it. Sorry.
No, go ahead, Erica.
Yeah, I was going to say it's implicit in what you're saying that, for example, the third and fourth nexuses where an entity is managed or where it has a regular place of business would not be sufficient. And I just wanted to confirm that that is in fact what you're saying.
Well, I think, to be clear, I mean, we said in our comments, we could not think of any specific situations where we thought that those nexus definitions were fairly broad and we couldn't think of specific situations. But I know some comments came in and said, well, maybe as a last resort, it's where the customer is located. You know, that might be an option to fill in any gaps. We didn't identify any specific gaps given that we thought the definition was fairly broad to begin with.
Just to follow up on the point about whether or not we can adopt this sort of blacklisting, grey listing approach to jurisdictions with poor standards, I think that that's absolutely something which can take place in the crypto-asset space, because if you're thinking about leaving aside sort of individuals for one moment and you're thinking about exchanges, there are requirements as part of the FATF travel rule that there should be due diligence done on counterparty exchanges or counterparty wallet providers. So there should be, and there is quite a bit of knowledge out there about where these exchanges are located and also what their controls are like. And on top of this, you can use blockchain analytics to identify which addresses are located with which, or associated with which exchanges or wallet providers. And although it is a highly mobile industry, I think particularly when you're looking at companies which are providing exchange services, it shouldn't be too challenging to identify where they're based. It becomes quite a bit tougher when you're talking about individual people. But for companies, you know, you've got companies which do blockchain analytics and cybersecurity, which are quite adept at identifying the strengths and weaknesses of different exchanges and also where they're located. So you could certainly adopt that approach. One challenge obviously might be, you know, working out exactly what you want to do when you identify a jurisdiction or an exchange which you don't think is up to the right standard. And there it obviously becomes more difficult than if you're looking at bank transfers where you've got a closed system like SWIFT that you can kick people off. You know, the blockchain doesn't work like that, so how are you going to enforce against these businesses? But that's a much broader question which we definitely don't have time to answer today.
I think we are slowly getting to the end of this session. I don't know whether there are still any interventions from the room. We did not receive any particular questions, I take it, from the Zoom participants, but I thought it was a really interesting session with very useful input. And I would like to thank all the panelists, Erica, Lawrence participating through Zoom, and James and Lisa here in Paris. Thank you very much. I think it's time for coffee now, and then we will reconvene at 4:30 for the last session on the reporting and due diligence obligations of the CARF. Thank you.
So, welcome back everybody, and last but not least, the fourth panel on the due diligence and reporting requirements under the CARF. We'll try, of course, to be punctual and not hold you up longer than 6:15. That will certainly be a bit of a challenge because we have a lot of items to discuss, but I think they are important items, so also, of course, everybody here in the room and on the Zoom connection, please feel free to send us your input or to raise your hand. Certainly always good when it's as interactive as possible, as we certainly also saw already in the last panel. It's always interesting when a discussion develops about the different subjects that we touch on. So before we launch into the panel, just a brief round of introduction. So my name is Paul Hondius. I am a senior advisor here with the OECD, working on exchange of information policy, and in addition to that also on harmful tax practices, but the work we're doing here today is certainly more under the first and under the second limb, at least technically speaking. Here with me on this last panel of the day, we have 4 persons joining here in Paris and 1 person remotely. Starting with our remote joiner, we have with us Liz Chien, who is the head of Global Tax of Protocol Labs and based on the west coast of the United States. So we certainly are happy that the 9 hours of time difference do not deliver a too crazy time in California. So good to have you with us, Liz. And then here with us in the room, we have here to my right hand side, Lauren Griffin, who is the head of tax transparency with the UK Treasury and also the United Kingdom delegate for WP10. And then also to my right side, we have Corné Ploy, who is a software developer with Bitonic, a Bitcoin exchange, and a very valuable member for this panel, no doubt, for sharing the technical perspective on how this actually works in practice. And then to my left side, we have Andreas Rohrer, a tax specialist in banking with the Swiss Bankers Association. And we will, of course, as part of this panel, also get into the interactions between the CRS and CARF, and that is, of course, something that is particularly relevant for the traditional financial intermediaries that are also involved in crypto markets, because they are, of course, in scope of both initiatives. And then finally, with us also here in Paris is Jameson Sides, blockchain and digital assets tax lead with RSM in Washington, D.C., and certainly one of the very knowledgeable interlocutors that we have had also in our secretariat work on the CARF so far. So very happy that he is with us to share his experience and knowledge about these subjects. What are the topics that we are going to cover as part of this session? There are 4 in total, so we will need to be disciplined to make sure that we don't run out of time, because they're all equally important. The first one relating to the reporting requirements, including the valuation methods that we have reflected in the CARF, in section 2 in particular. There, of course, we will focus on the level of detail that we have included, but also on the more technical rules and whether they are fit for purpose and realistic. After that, we will turn to the notion of reportable retail payment transactions. So these are, as you will know from the CARF, transactions where customers of those providing goods or services in exchange for crypto would need to be reported in certain instances. And of course, there we also want to discuss how that could work in practice and what the complexities are. Then we will have an item covering the reporting of wallet addresses. As you will have seen, we at the moment have a reporting rule for external destination wallets where crypto assets leave the environment of an exchange and go into a wallet that might either be hosted or unhosted. And then finally, as I said, we will have an item covering the interactions between the existing reporting framework under the Common Reporting Standard and the potential new rules under the CARF. Now, without further delay, I will get into the first topic, and there my first question is to Lauren Griffin. And the question is whether you could maybe briefly outline what the CARF says in this respect, and also why we have ended up in a space that does not foresee fully transactional reporting, but also not in a space that is purely aggregate reporting as we currently know it, for instance, under the CRS. So with that, over to you.
Thanks, Paul. Before I outline the reporting approach, I did want to make a few contextual remarks, some of which you'll kind of have heard already today, but I think are really important in outlining why we think this is the right reporting approach and the one that we've proposed. So I wanted to start by kind of reminding everyone of the point of the framework. Of course, what we're looking at is compliance. So just speaking from the UK's perspective, of course, crypto-asset transactions are a taxable event. And because they fall out of the CRS, we have no visibility of them currently. The CARF aims to provide this transparency to aid compliance. However, using this data to calculate tax liabilities is not a central aim of the framework. And so the reporting information requested focuses on identifying risks of tax non-compliance, not kind of at its core calculating tax liabilities. And so that's really where this reporting is focused. The second kind of contextual remark I wanted to make, and I think we've talked about this a lot already, is the difference between crypto and traditional financial services. So it's important to remember that we're dealing with a very different sector to the traditional FS sector, which the CRS covers. Crypto is a digital sector with customer relationships that are primarily online, is transaction-based, unlike, for example, a depository account, a traditional retail banking account, and most importantly is rapidly evolving. And it's necessary that this new framework is bespoke to the sector. So, just emulating CRS reporting really doesn't work. And then finally, and this is what Erica kind of talked a lot to you about in terms of kind of how you define a CASP, we're interested in exchanges. And so, what does that mean for crypto? Well, we're interested in crypto when it's on exchange. And as I noticed, it's transactions in crypto assets that is a taxable event, at least in the UK. And I think the reporting approach follows from that. So kind of moving now to summarise the reporting approach at a high level. So we've taken an aggregate transactional approach to reporting. And by this, I mean we're asking for an aggregate of transactions throughout the reporting year. In practice, this means for each type of crypto asset that has been owned or exchanged by a reportable account holder, CASPs would be required to report the number of disposals and acquisitions within the reporting period, the total value of acquisitions denominated in both crypto and fiat, and the aggregate gross proceeds of disposals denominated in crypto and fiat. So why do we think this is the right approach? Because it is divergent to the CRS. Well, firstly, and going back to my contextual remarks, it's bespoke to the sector. We recognise that this is a different sector to the CRS. It would provide a total from the transactions that occur on the platform through the year, rather than providing a kind of snapshot at the year end, a la the CRS. And this reflects the nature of the sector, being a sector focused on exchange transactions, or at least that's what we're interested in, rather than holding funds, as I outlined earlier. And a CRS approach, frankly, just wouldn't be sufficient for us to assess tax non-compliance risks. And so it's important that we are capturing more than that. We also think it's proportionate to the aims of the framework. WP10 did consider whether we should ask for a transaction-by-transaction approach. So just to kind of bring that to life, I mean like a line-by-line of all the transactions. In the end, we didn't go for this approach because, firstly, the volume of data that this would have been provided would be huge, and actually it would have been very difficult to assess by tax authorities and to kind of use in the sort of risk assessment processes that we have for the CRS. And the second is that we need to keep in mind that we are dealing with data on individuals, what is essentially personal data. And while this is important information for tax purposes, we should also avoid asking for data that is not core to kind of the task at hand. And so really what you've tried to see us do is really balance these things. I also wanted to touch on aggregation because I think that this is really fundamental to the reporting. And actually it's kind of very, very core to it. And in particular, and I know this generated a lot of discussion from the consultation responses, that the aggregated amounts are denominated in both crypto and fiat currency. So why have we asked for this? Having the value both in kind of fiat and crypto is integral to making the information useful. The value of crypto fluctuates, and without the fiat representation, it would be difficult to understand the scale of possible non-reported taxable events in that reporting year. But why do we think it's deliverable? And this was really what I kind of found came out of the consultation responses. Is this actually deliverable? And we did think about this very carefully when we were designing this reporting regime. Liquidating digital assets into fiat currency is relatively straightforward, and many crypto asset exchanges such as Coinbase, Binance, or Kraken already enable users to exchange crypto assets for fiat currency. It then follows that it is reasonable for intermediaries to maintain valuations on the equivalent fiat currency fair market values of crypto assets, or at least have the ability to make this valuation fairly easily. CASPs can use the valuation to assess differences in value between different types of crypto asset. We recognise that the exchange may not record the valuation of all tokens in fiat. However, the valuation for the majority of tokens, and we are unaware of where this isn't possible, can be converted to a major token such as Bitcoin or Ether. And once that's been done, then we imagine that fiat conversion would be achievable. Now, of course, we do recognise that valuation of illiquid tokens might be more challenging, such as, for example, with NFTs. However, where there has been an exchange for an NFT, these would normally be fulfilled in Ether, and this is readily convertible to fiat currency. So hopefully that kind of gives you a flavour of sort of some of the discussions that we've had and why we think this reporting approach is kind of commensurate to the aims, is proportionate and deliverable.
Thank you very much, Lauren. And now, of course, we are very curious to see what business thinks about what we have proposed here. And I would very much like to, of course, get on board the views of our different panelists. But maybe we start with the most distant panelist first to get those views on board. So I would say over to California, over to you, Liz.
Thanks so much, Paul. And, thanks very much for having me on this panel. I'm really honored to be invited to be a part of this discussion. And it's just very sorry that I cannot attend in person in Paris. It's really been, I think we're all ready to sort of start getting back to regular life after 2 years of sort of being locked in our homes. So I would say, to begin with, a couple of sort of high level thoughts. The first is that we understand that something has to be done with respect to transparency and information reporting in the crypto asset sector. And I think, and of course, industry is, eager to participate and collaborate with the OECD and the different governments around the world to come up with a sensible framework and a proportionate, practical framework for that. I think here, what industry is sort of grappling with, and I think you've sort of seen it in the comments, is just that there's a sort of broad sense that what's proposed in the CARF is actually not proportionate, and it's unclear all the information that's being asked to be collected. What will it be used for? It sounds like from Lauren's comments just now that the expectation is that the point of the framework is compliance, and that and the point of the framework is not in calculating taxable gain or loss. But I do think all of those those objectives, I think what hasn't been mentioned yet is that what needs to sort of precede that is really coherence around the actual substantive tax treatment. And I understand that John Nash, his intervention this morning, he had mentioned that Working Party 2 is working on a framework on substantive tax treatment. And so it does seem that, one, there should be coordination with that work stream, and that, two, the reporting rules should not actually precede the framework on substantive tax treatment, because unless you know sort of what's taxable or not in a country, it's hard to know sort of what data would be useful to help assess, whether taxpayers in that jurisdiction are in compliance or not in compliance. So I think, that's an initial comment. And the second comment is that, just based on Lauren's intervention just now, it does seem that there are some overarching assumptions that have been made with respect to, why crypto has to be subject to a, quote, bespoke reporting regime. It does seem that, there are these, there are comments around, well, there's something about crypto that's more transaction focused. It's not really about people holding balances. I mean, I will say that those are, I think, our assumptions. I do think what we see is similar to the financial sector generally. We see people with all sorts of motivations as to why they hold this particular asset. And so I think rather than sort of, it sounds like those assumptions are driving why CARF needs to be different, why crypto needs to be subject to a different regime. And what I would recommend is that maybe we revisit some of those assumptions, because in industry, we're not actually seeing that to be true. So I'll pause there and, give an opportunity for my co-panelists to share their thoughts as well.
Thank you, Liz. And maybe without further delay, a question to Jameson and then Corné about what is technically feasible here, and what would this mean in practice if the requirements that we currently have were to become rules.
Yeah, thank you, Paul, for having me here. I'm honored to be here. And then I also certainly want to commend you and Working Party 10 and the efforts you've done in tackling this. I think it's very useful in driving forward the industry overall. Not something easy to tackle in your, this forum is what is going to develop a cohesive set that's going to work with industry, work with government, and achieve the regulatory goals. So, I really commend your efforts in the process that we're following here. I think it's, to lead off in the statements, right, you fully acknowledge that this is a new industry, right? There are differences with digital assets, and that certainly is true. But a lot of the centralized entities that are operating right now operate like traditional asset, financial services providers. They do similar KYC onboarding, and a lot of the issues that I think that we've heard in the discussion, I think we'll get into more in this panel and in last panel, relate with those fringe assets. What are we doing with DeFi? What are we doing with NFTs and difficult? And I would urge and say, let's not let the perfection be the enemy, of the good here. And we could tackle 95% of the market with looking at these traditional centralized entities operating in a more traditional framework. If it looks like a bank, it's treated like a bank. If it looks like a broker and exchange, we treat it like a broker and exchange. And I think that's where industry is saying, well, if we're going to be doing that, let's look at CRS and consider, because at least from a U.S. perspective, I know other regulatory frameworks around the world are looking at these assets and questioning whether or not they just are in fact securities, or if they are in fact commodities. And if they're going to be regulated as such and defined locally as such, then that raises the question of why the difference between CARF and CRS amendments. Now, obviously, there's the portability issue, and that we'll table that a little bit in the wallet addresses. But even to Erica's point in the last one is why worry about DeFi? Well, DeFi is 20% of the current trading volume. It's hovered between 10 and 20% for the past year. 2 years ago, Liz and I were talking to Treasury and IRS at a summit, and we said, well, don't worry about it. It's 0.1%. And we were very wrong, right? It couldn't have foreseen the growth. But in getting that wallet address, or making sure that outbound wallet address is secured, and records are kept on that and available if upon request, you preserve the ability to see all of those transactions in DeFi. That's the beauty about DeFi. It's a public ledger, and all of the transactions are forever and transaction by transaction written to the blockchain. So you can always come back and get it. And I know a lot of people say, well, I want all the data, I need more data now. And just kind of the last little tidbit from my experiences doing, as we were doing preparation for tax returns and estimates for our client base, I had all the data on NFTs. I worked with the service providers, many of the service providers that have contracts with a lot of the governments. They couldn't do it. Right? It's not something simple. We're still trying to figure out a lot of this, and that doesn't even bring into the variance, different jurisdictions and their ultimate tax treatments. But when the software right now, with perfect data, with all available, all encompassing, still can't give you it's not a click button answer, especially around the NFTs, even liquid NFTs of significant volume. Just given the nature and the myriad of different transactions that can do it. And it's important, right? We've talked about NFTs in the context of collectibles, but it's better to think about them as a technology, right? As Lawrence said in the prior panel, it's not be technology specific or discriminatory here, because the technology is a wrapper, and it's what we put into it. And it's fine if we're putting in, a JPEG or some kind of art, but we've already alluded, you can put in a car title, you can put in a deed, a mortgage. We're also seeing people put in tickets. In, we have very robust secondary ticket markets that aren't subject to reporting. So we have to think about what are the full realm of assets and whether or not you want to allow peer-to-peer exchanges, and if it's a ticket to a concert, a ticket to a convention, minted in the form of an NFT, does that then become a digital asset subject to reporting?
So Jameson, just a quick, I think maybe, I don't know if it's a correction or maybe sort of we should look at the data together, but I just looked at sort of data on Friday, and the size of DeFi, the DeFi markets is currently about 4% in total market size. So, and then even at its highest point, which was November of 2021, it was only at 11%. So I'm not sure where this 20% is coming from. I've certainly never seen numbers that high in terms of the size of DeFi. So I do think we should probably just maybe revisit some of these data sources.
Yeah, let me pull that. I thought I saw that on Glassnode via the block, and it would be the DEX to SEX CEX spot volume.
Yeah, so I look at TradingView. So TradingView actually shows like all of the total market size as well as the DeFi market size. So I'm happy to share the link with everyone here later, so we could all just sort of take a look at the data. But it is I don't think it's even 11%. I was surprised by, but that was at the very height of the market back in November.
I mean, I think it shows the importance of another issue that we discussed earlier today, which is how do you define actively traded and what are market sizes? I think they are certainly, as we can see, complex issues, and it's not, you don't have the same visibility as you would typically have over the FTSE or the New York Stock Exchange in terms of what market sizes are, and it's certainly a challenging issue. But I think from Jameson's intervention, there are for me 2 points that I certainly took away. I think one is if I can summarize it in that manner, a slight skepticism in terms of trying to do reporting by type of asset, because there might be so many variations, and also an issue related to valuation and how do you put a value on certain crypto assets, in particular if they are in the NFT space. So maybe that allows me to hand over to Corné briefly and ask, if we now take our reporting requirements, so reporting by crypto asset type, by type of transaction, and then the valuation in case it's a crypto to crypto transaction or a transfer, how easy or how difficult would it be to do such a reporting in practice if it would need to be delivered?
Well, thank you, Paul, for inviting me to this panel. So the big picture we're looking at here is that we have this CARF proposal, which has all sorts of reporting requirements, and then we have all sorts of comments from the industry about what's going to be difficult about that. And if you look at all the comments, you can sort of order them. Like some comments are comments like, this is impossible, like we don't have that data, we cannot report it. Other comments are something like, this is going to be really harmful in one way or another. And you could also say sometimes it's going to have no benefits. So those sort of comments are there. And when you come to the conclusion that something is impossible, I mean, it stops right there, right? It doesn't matter whether it is beneficial or not. It's just impossible. So that's the first thing we should look at. And then when it is possible, you should check out whether it's desirable based on whether it is harmful or whether it has important benefits. Now, if it is true that there are things in the CARF that are impossible or harmful, the question is, why is it that way? And I think that is because of some misunderstandings of the technology and of what is possible, what is harmful. So I think what we should try to do here is a bit of education, in a sense, of trying to come to an understanding of what how things actually work in cryptographic systems. And yeah, it's going to be challenging because of the scope, the scope that's covered CARV is very broad. It's basically anything that's based on a blockchain, more or less. Not exactly, but yeah. So some things are possible in some crypto assets, and they are impossible in another crypto assets. And well, I'll leave my introduction there.
Could I maybe ask you to give us like 1 or 2 examples of where you think like this is interesting, but is maybe either very, very difficult or just impossible to do, of things that we would have proposed?
Yes, well, one thing that's very difficult, I believe, is when you have a crypto address. For instance, when an exchange sends bitcoins, for instance, to a Bitcoin address, is to figure out the identity information of the entity who holds the keys to that address. Like a Bitcoin address, it is in some way it's kind of similar to a bank account, but in this case that analogy kind of breaks down, because in a bank account the bank account is created by a bank. Or you know what bank manages that bank account. But for a Bitcoin address, you cannot really figure that out. Like it's more similar to, let's say, a lock and a key. If you find a lock on the street or in some public place, you cannot investigate the lock and then figure out who holds the key to that lock. And so, yeah, that actually with Bitonic we've had this same situation in the past where the Dutch central bank actually required us to prove that when we send bitcoins to a Bitcoin address, to prove that that is an address of our customer. And there is actually no way to prove that. You can ask the customer to confirm that it is his address, but then you have to trust your customer on his word. And well, that is an example of something that's impossible.
Thanks to everyone for their contributions. It was really interesting to kind of, it's always interesting to hear the business perspective, because I think it really brings it to life for us. One question I did have, so one of the points that really kind of came out to me or came through in the consultation responses, which I sort of reflected on a little bit in my earlier intervention, was how easy it would be to turn sort of kind of valuations in crypto into valuations in fiat currency. And I talked a little bit about kind of some of the ways that we thought this was possible. So for example, you know, we understood that with some of the major sort of tokens that, you know, that should actually be a readily available technology, and that where there was a token that wasn't, you know, one of the kind of easily converted, shall we say, that could be converted to a token that could then be converted to fiat currency. So, you know, we felt that it was possible to do. I did wonder whether anyone had any reflections on that, or kind of wanted to sort of refute that, or maybe give a little bit more background on why maybe some of that kind of came through in the consultation responses.
I can kick it off and then see if Liz has any other comments as well to add maybe on this. The valuations on Bitcoin and Ethereum are pretty robust, right? Very, the spot markets are very liquid. They operate 24/7. And many of these transactions that you're asking for valuations for are live transactions. They're presumably third party and settled, right? So you have some certainty. I would say that even from our auditors' perspective, they certainly agree with the fact about proving existence of wallets is actually quite difficult. It's like auditing cash, but harder. But the valuation of, you know, when you're saying let's take that snapshot, when it's not a true transaction, is where you really start having some difficulties, because there may be large volumes of lightly traded tokens held on there. There may be large volumes of NFTs that are collectibles in the art space that haven't been liquidated or sold yet. You go on to many of the DeFi-based NFT, and the order book is very thin, oftentimes 20% spreads between the bid and the ask. The spread prices are difficult. So it gets to what is the purpose of the valuation being requested. If the purpose is for principal level tax evasion and not delivery of a tax return with a deficiency notice, then maybe that's a decent approximation, but it has to come with that big asterisk, right? That this is not for tax deficiency purposes, right? Because it's speculative and it does vary. And even, running it back up the chain to the Bitcoins and the Ethereums on the markets, those can change pretty dramatically, depending on which local market you're looking at trading at the time, due to the traditional financial systems delays in moving money. So you can see, sometimes it's not absurd to see a $1,000 price differential in Bitcoin's price across the globe. So the question is, if it's just kind of a loose, we're going to peg it to that purpose for, again, that high level, then I think that is okay, as long as it's not known as a firm price in a real world.
Yeah, and I would just add that I think sometimes it actually, there's a bit of a delay in settlement from, the transfer from sort of a payor to the recipient, right? And so as an example, if the payor sort of pays out of a self-hosted wallet into the recipient's exchange wallet, there could be a bit of a delay, and the payor may actually use an exchange rate that's contractual, or essentially at the time, or they could use an exchange rate based on the time when they sent it out. But it could actually take either a couple minutes and sometimes a couple hours for that transfer to be fully settled, in which case, the price that's then recorded at the exchange could actually be a bit different from a USD or fiat perspective. And so I think this is sort of one reason why, the sort of fiat sort of translation may not actually say very much as to the actual value of a transaction, whereas the reporting of just the quantity itself would probably be a little bit more accurate.
That's really interesting. Thanks both. I mean, I think, again, this kind of comes back to maybe one of those sort of contextual points that I started with, which is really about the sort of utility of the framework as well. I think that, a lot of, if I just maybe speak to our experience with the Common Reporting Standard, the CRS, a lot of what we do with that data is sort of risking kind of the likelihood of non-compliance, right? And it's, it's a huge data set, and obviously that's, that's for many reasons. It has a deterrent effect. There's lots of reasons why we get it. And so I think it's really helpful for us to understand, like particularly at this juncture, what can this information tell us? And I think there is clearly, from what you said, a lot of utility in this kind of conversion to fiat, but we also have to kind of go in with an understanding of what it doesn't tell us as well. But what I've sort of taken from this is that there is still kind of a lot in that sort of risking end that we can really kind of gather from this. But were we to try and maybe use it more broadly, there would need to be sort of a pinch of salt or a kind of a sense that there's a bigger story to tell, I guess, on this.
I would also add in to kind of shed some light on industry's perspective of the privacy here. As we mentioned, a lot of these transactions are on-chain, they're public. You can go into a block explorer and see wallet balances and transactions, and the only thing you don't know is identity. And when that identity is given over, it's, if that were to leak out, it's not like there's a master of Bitcoin that can just hit a reset button and give everyone a new address. Those are permanently and forever compromised, and there's transaction costs associated with moving balances out of those wallets. If that was, a wallet was identity compromised in that manner, and then also with, as I think Lawrence alluded to, potentially having on-chain identity, revalidating future identities with certificates and going through that process on a large scale would be very detrimental, and not even talking the personal privacy concerns and safety concerns around exposure of identity and on-chain activity in that manner. So I think that a special sensitivity should be given to that last little bit, because that's literally the only piece that's missing from the public ledger.
And I would just, if I could quickly add to that, I mean, I think, Jameson, you raise a great point, which is that even if an on-chain wallet address has been compromised, even if the user were to then, the owner were to then transfer it to a different address, that's all public as well, the new address, right, and so on and so forth. So so it almost becomes that if you compromise one wallet, it's that entire thread is compromised, right?
Yeah, I would also like to add that crypto assets are sensitive to theft and robberies. Let's say when, let's suppose somebody got access to your bank account and moved all the funds to his own account, then the identity of the thief would be quickly known and maybe the transaction could be reversed. So it has kind of, the banking system has sort of a protection against theft. But when somebody robs somebody else of his bitcoins, they can take the bitcoins to an address that has no identity attached to it or no known identity. And basically the opportunity for theft is much larger. So when it gets publicly known that a certain person holds a large amount of crypto assets, it's a real risk of violent robberies, for instance. There have been cases of such things happening.
Thank you for those insights, and I think we are already sort of slowly drifting into the wallet address discussion by default, which is not a drama, because of course this should be a free-flowing panel, and we'll surely make up for that time when we go to the wallet address item later on. But before we close on this reporting requirements item, I probably would have two more points that I would like to briefly touch on. The first one, and I think maybe this is one mainly for Jameson and Liz, is a question of if the rules were to provide for a principle that a valuation in fiat needs to be provided, but that there would be a certain exception for cases where it is objectively not possible to put a fiat value on it because there is no reference for doing so and no other means available of readily acquiring that knowledge. Would that be something that would be workable as an approach to reporting to avoid these issues where valuation is a real challenge? And of course acknowledging, I mean, I think we heard that comment clearly, that there might be differences in timing and that might lead to fluctuations. I think that's something that administrations would need to learn to work with, that you cannot take that as the precise value in any case. And then a second question, I think, to Andreas, and that is whether we could get your views on how these differences in level of detail and approaches to reporting requirements on transactions, what that means for banks in particular that are active both in the traditional financial sector and in these crypto markets. So maybe back first to Jameson.
Yeah, I think you know, don't let the perfect be the enemy of the good. Bitcoin and Ethereum operate as the main trading pairs, much like Forex, in like kind of base currency trading. So I would say, to the extent that that was what the trade was against, you could then make a correspondent price pool against what the Bitcoin or Ethereum global average was, right? That's probably readily attainable and pretty easy to do for most centralized exchanges. Becomes a little bit more difficult in the decentralized context, and then it just gets more and more complicated as you start talking your way down NFTs and other decentralized protocols that don't necessarily operate as an exchange, but maybe more of a lending platform, or something else where there's not, you know, different types of staking systems and whatever. And you know, don't hesitate to think that this industry will be creative and come up with new things that make this speech sound, you know, utterly outdated in just a year. So I think, again, the baseline, and you can probably capture 95% of it. In that centralized context with those base, you know, the Bitcoin and the Ethereum readily available information. I think if there is some kind of safe harbor or ability to kind of flag why certain things aren't reported, that would be certainly helpful.
So yeah, so Paul, I think, you know, my view is that, you know, here we should sort of go back to, you know, what is the purpose, right? And I think Lauren did a great job of articulating that the point of this proposed CARF framework is to ensure and promote and encourage tax compliance. And, you know, and so I think, you know, rather than sort of asking the question of like, well, maybe as a starting point, everything should be reported in units and fiat, right, equivalent, and then have some small carve out for tokens where it's difficult to have a fiat equivalent value. I mean, why not then if the purpose of this framework is really just to risk assess whether tax compliance is going on, you don't even really need a fiat equivalent. You just need to know that somebody is holding balances of crypto, and those balances of crypto have changed throughout the course of the year, right? And I think going back to the sort of initial comment of, well, you know, WP2 is working on substantive tax rules, right? Substantive tax treatment rules. And therefore, you know, in certain countries, for example, crypto to crypto transactions are not recognized as taxable transactions. In other places they are. In other places still, capital assets held long term are not taxable, right? And so it's like, the rules vary country to country. So it's almost, it would seem to me that fiat values are not even really necessary to risk assess for tax compliance. You just need to know that somebody has crypto and that those numbers have changed throughout the course of the year.
Thank you. Thank you for having me and for allowing the perspective of traditional finance to come into this discussion. I think the point you made is, for me, the perfect starting point, because in ensuring tax compliance, it's something completely different than calculating the tax liability. And I think what happened here on this panel is that we jumped into the technical discussion, talking about virtual assets where they are structurally different from financial assets as we know them. And I think from the perspective of traditional financial institutions, this is an important discussion. We all, and I think also in the previous panel, we all agreed that that a level playing field is needed, that there is a gap where CRS doesn't apply, and that this gap needs to be filled. This brings me to the other point. A large portion of what virtual assets are and what virtual assets could be in the future could be perfectly covered with CRS. It's a point that was mentioned, that was brought up before, and it's something that I want to emphasize, that CARF should focus on the gap where CRS doesn't apply, where the account holder concept, which is the core of CRS, where this doesn't work. But in many instances, we are convinced that the account holder concept works, where you have a customer relationship, where you have an account where this asset, virtual or traditional, is held, and where what CRS was designed for, identifying the person behind the asset and making it reportable to ensure tax compliance, where this purpose of CRS would apply perfectly. I'm also, to add to the previous statements, I want to add that we are not, the virtual asset sphere is far from mature. It was mentioned in the previous panel that the ultimate use case is still open. And what we see in the traditional financial services industry is that there is a lot of innovation also going on in modernizing traditional financial assets, in modernizing procedures to make them more efficient, to make them better in the back end, but not to bring a new product to the market. So what I'm trying to say is that there are in the future, and there are companies working on that, and there are already use cases out there where a bond or a security is no longer securitized, but it's tokenized. And in the end, it's still a bond, it's still a security, and it could be covered by CRS. It would trigger CARF without being something new with new characteristics. So I leave it with that for the moment. Thank you.
Thanks, everyone. If I could maybe make a sort of further remark just to kind of maybe play in, well, at least the UK sort of perspective from a tax perspective, because I think it's, as I said earlier, it's so important to hear from business and so important to hear about kind of the art of the possible here. But I do think, though, and maybe this kind of comes back to the conceptualization of this framework, that there is a difference, though, between the traditional financial services sector and the crypto sector. And I realise I'm surrounded by experts who are probably going to, refute some of what I say here. But I will say that, you only need to read kind of recent news reports to see the level of volatility in the crypto market, for example. Now, I'm not saying that, if you look at, say, the FTSE 100, you wouldn't see a level of volatility there in sort of share prices. But, it's greater in the crypto market. And I think that, it goes back to a little bit what I said at the start, which is that, when you are looking at actually at least the UK's tax treatment of crypto, whether you're making a gain on a crypto asset, I mean, that could be so different, like week to week, let alone sort of month to month. And so we do need to kind of remember that, I think, and think about sort of the other side of the coin, which is that, we're trying to kind of develop a framework here which is fit for purpose, which works for business, but then also does give us, enough information to assess sort of, tax compliance. And, taking aside these questions about things, things like wallets, like NFTs, retail payment transactions, because I really do accept that they're a little bit different. If you look at the sort of core use case, the centralized exchange of crypto, I think that you would still say that that is very different to, for example, the kind of traditional capital markets. But as I said, I realise I'm kind of surrounded by by experts who might give a different view. But I did think that it was worth kind of adding that sort of tax compliance flavour to the discussion, because I think that does sort of balance out a little bit, some of the views that actually maybe we don't need, a fiat currency conversion. I would argue that probably we do, and that's why we see it in the framework.
I mean, I hate to sort of curtail discussion here, but we have 4 issues on our agenda, and it's of course challenging to. And I promised that you would not get out of this room late, so I'll try my very best to keep my own interventions as short as possible. And I think Lauren has reflected on some of the considerations already. But if it's okay for you, I think we would move on into the reportable retail payment space, because I think that's an important issue to discuss as well. I will not comment any further on what that means and what it is targeting, because I think Lauren can do that much better. So over to you.
Thanks. So maybe just to sort of summarise what the draft rules that we've put out kind of do in regards to retail payment transactions. So the CARF applies to certain instances where a CASP processes payments on behalf of a merchant accepting crypto assets in payment for goods or services. So, in other words, reportable retail payment transactions. In such instances, the CASP is required to also treat the customer of the merchant as its customer, in this sense, like look through, and report with respect to the value of the transactions on that basis. So the CASP would report the aggregated retail payments that the merchant receives from customers, in addition to reporting on any other activity the merchant conducts using the CASP as per the sort of wider reporting requirements that they might fall under. In addition, the crypto-asset user definition specifies that the CASP must also treat the customers that are the counterparty to the merchant for the reportable retail payment transactions as a reportable user. This means the CASP must also report the value of each retail payment transaction against the customer of the merchant that made it. So we've talked a lot about, the different iterations of, the crypto sector, shall we say. And I did want to kind of, in short, reflect that, retail payments are of interest to tax authorities and they are interested for tax purposes. As I said at the outset, we are talking about, and the CARF is really kind of founded on this concept that we're interested in what happens at exchange on exchanges. One important type of exchange is, of course, the exchange of crypto for, I think, particularly, expensive or significant goods or services. But that being said, we also, wanting to keep this a proportionate framework, do not think it would necessarily be desirable to have every retail payment transaction a customer makes reported. The classic example that's come up a lot at WP10 is that we definitely don't want it reported when someone buys a cup of coffee. I don't think that that's particularly interesting from a sort of tax compliance perspective. And I think that will be particularly the case if it does become increasingly more normal for actually transactions, like everyday transactions, to happen in crypto. And so, making sure that, again, we have something which is fit for purpose and takes a middle road between what is interesting from a tax perspective and what is also proportionate for business. And so therefore, we do have a kind of drafted proposed de minimis threshold, kind of recognising that, so that only retail payments above this should be reported. I think the crucial point that I'd want to bring out with this threshold is that, at least how it stands, is that it's not an aggregated threshold, but applies to the value of each individual retail payment. And actually, this is, when we were looking at this, we recognise that this is one area of the crypto sector which feels, very nascent. We get that the whole sector is moving quickly, but this one really does feel like very new. And so, we did actually seek some very specific kind of inputs from the consultation. I'll be really interested to hear what my other panelists kind of have to say on this. I think there were a few areas that I think I was really interested in. Firstly, the sort of relationship with the AML requirements, particularly the travel rule. Also, some of the issues surrounding whether the CASP might not have a relationship with the customer. So sort of this very core question of feasibility that we've talked about a lot. I think we've also, and this is why we included the sort of draft de minimis threshold, have asked if there are any other measures that could be used to kind of reduce compliance burden. And so that would also, be a really interesting reflection. So I'd just be interested to hear what everyone has to say in terms of how we get the information we need from a tax compliance perspective in a deliverable and proportionate way.
Yes, so this is an example where there is a huge issue in whether this is, how on earth are CASPs supposed to do this? Generally speaking, the customer of the merchant is not also a customer of the service of the CASP. So they don't have identity information. Usually what they see is an incoming crypto transaction that is meant for the account of the merchant. That is what the service provider sees. And in some crypto systems, they may see the originating addresses. In some crypto systems, they don't see an originating address. But what they almost never see is identity information of the origin of the transaction. So how are they supposed to get this? One thing you mentioned is the travel rule. So the question is the travel rule feasible? To my knowledge, it has not yet been implemented right now, at least for crypto assets. You cannot normally send metadata, like identifying information, with crypto transactions, so you would have to build some sort of infrastructure next to the transaction infrastructure to communicate this identity information from the source to the destination. Then the question is, how do you establish communication between the source and the destination? The source, let's say, that is either the customer of the merchant or his service provider. They would have to know who to send this information to, and they don't usually know that. And the destination, that is the merchant or his service provider, in this case there's also always a service provider, he doesn't know who to ask for this information. So they sort of have to have this problem of trying to find each other. And you can try to ask around, like, does anybody have this address or something like that? That could be a privacy issue if, let's say, information gets spread around across all of the cooperating service providers. What you could do is ask the customer to fill in, like, I'm sending from here to there, but then it's a usability problem, because then when you are at a merchant, you don't just say pay, but you have to say pay, and then you have to go through a whole procedure of filling in information, something like that. And anyway, when the customer is using a private wallet, which is, I think, very common for merchant payments, there is no service provider who is going to send information. I mean, the customer could send this information himself, but you don't know if you can trust that information. So, yeah, I don't see how this is going to work.
I think that was an unusually clear statement in an OECD meeting room. Any other reactions?
Yeah, I think it's certainly difficult. And what I'd hate to see happen here is regulation being such a high bar that it stifles innovation in new business startups, as well as being used by incumbents to protect their lead. I think that's something to be sensitive of. And you know, to that end, I would say the de minimis threshold is hugely important, but I would add on to enable the parties to contract for any reporting obligation and to shift that burden to the other, I think could help startups to shift that off, because the prices that I've seen per account on KYC in this context cost about $5 to $10 per account. So if you start thinking about the transaction values and where you want to peg that, you're going to see significant erosion of the profit and the ability to scale, especially amongst the startups. I've seen some of the larger payments providers in this space, really struggle with adding this on to the detriment of profits and growth. So that's the one. And why do we not see a lot of people using Bitcoin to buy coffee? It's still, we're really early, right? I think the World Bank chart came out and showed, like, we're in, if you overlay crypto adoption and growth over the internet, we're in 1998 right now. So that's a little bit why. It's also people are holding it for speculative assets. I would say, to the end of what value do you want to put on it, right? From the U.S. perspective, we now see it's called 60/50I to treat digital assets like cash, and the threshold in the U.S. is $10,000. So $5 to $10 to KYC on that is probably not. That doesn't really hurt your bottom line. You can certainly price that in. There are two issues in the U.S. with that, and problems with implementation. One, it's a receipts-based assumption, and in the DeFi and blockchain world, you have non-person payers, and you don't, just like email, you can't say don't send me spam, right? You receive it. So those are the two issues, right? Person-based payers, and it's a receipts-based system. The person-based one was really interesting. There was a European startup that wanted to have autonomous cars that could then go and pay for their own repair through their own blockchain. And I just think that with a certain regulatory environment, depending on the way that it's developed, that could prevent that whole, theory from taking off. And whether that's good or bad, who knows? But if you want that kind of level of innovation and kind of growth of the industry, you want to be real cognizant about the amounts and kind of certain exceptions. And if it is a non-person payer but a smart contract payer, how do you handle that reporting?
They were both very interesting interventions. If I can abuse my status as a panelist to ask a follow-up. This has actually been a question we've been really interested from a UK perspective. I mean, it sounds like, and maybe I'm going to mischaracterize maybe what you said, Jameson, but like, if we are talking about the bigger players in this sort of retail transaction market, so, we've obviously got a sort of draft threshold. Let's say we're talking about players above, I don't know, 10K, right? A transaction sort of those sorts of businesses. Is it conceivable that there could be a technological solution to that problem for this problem of how you get the two sort of exchanges, I guess, to work together? Because I sort of maybe I misunderstood what you were saying, but it sounded like you were intimating there might be a kind of market-based solution to this. But what we need to do is be careful that we're not kind of gathering sort of SMEs and kind of negatively affecting their innovation if we did apply this.
So I think on the payments providers, there's two ways that the contract could be set up. One, it is that the merchant is really out of it. They've enabled a payment processor to deal with their customers when those customers choose to pay. So that's you go to a website and it says pay with Bitcoin, even donate with Bitcoin for certain political parties and campaigns. You're redirected to a white label and you're dealing with a third-party provider there, right? Who then will intermediate. They give you a spot price. They will then go liquidate the digital asset, and the merchant or the recipient has no clue. They get an ACH transfer at the end of the week, or whatever, traditional wire, whatever traditional settlement. The other way that you could do it, and where it kind of becomes difficult in the way that it's currently drafted, is that the merchant could just display a Bitcoin address and say, send money here. And unbeknownst to the customer, that could actually just be their Coinbase, their Kraken, their Binance account. And those could auto-generate. And in that case, that's the perfect situation where the merchant, regardless of the threshold, is the customer of the exchange, and that's the best way to encapsulate that. And that's why I think the contracting flexibility would be useful in that regard.
Thank you. That is very helpful. And I saw in the meantime that our former panelist from this morning, Tahir Sabri of the Electronic Money Association, has a question or a reaction. So over to you, Tahir.
It's very kind of you to let me intervene. I just wanted to add another slight twist to the same point, which is we looked at kind of double coverage by CRS and CAF, but in this case, it's the application of the reportable retail payment requirements to something which looks more like e-money, to a stable coin which can be redeemed for fiat at par. In that case, we then create a slightly unlevel playing field. I take the point if the threshold was set at a sufficiently high level, then it would capture perhaps what you're looking for, which is people trying to capture gain by buying something rather than, or avoid the capture of gain by buying something. But if we're talking about purchases with stable coins of that kind, then effectively we are capturing that information for a stable coin, but we're not capturing it for e-money, we're not capturing it for a bank payment, essentially. And I'm wondering whether that is something that could be addressed as you think through how this would actually work out in practice. That's it. Thank you.
Thank you very much for that suggestion. And I think Liz also may have something to add to this subject. So over to you.
Yeah, so I think, just to, and I think hopefully this might answer Thayer's question, but, I think fundamentally one of the questions I had in my mind is what's being proposed does not actually get to any type of verification as to what is the gain, right? Because here it does seem to me that the underlying sort of objective of having, sort of discussing whether the intermediaries that process a retail payment on behalf of a merchant who has the reporting obligation. Well, it does seem to me that the first question should be, well, how do you actually know what the payor, right? So the buyer's tax basis is, and if the payor is, I think that's a starting point. It's difficult to know unless the payor is actually purchased the crypto asset on the CAF's platform. It's hard, then the payor is really sort of self-reporting or required to sort of self-report what its initial acquisition cost is for that asset. And then subsequently, when the payor uses that asset to pay for goods or services, it's only at that point that you can calculate the gain or loss related to the form of payment. So, and the other comment I wanted to make is that it would seem to me, so I with something like this, I think this is pretty clear to me that it's, sort of the analogous framework to what we call 60/50 Cap I in the US, which is, merchants having to report cash or crypto forms of payment for, goods or services over $10,000. And so, I wholly endorse Jameson's comments earlier around you have to sort of make it make sense from sort of the AML KYC cost versus the actual sort of cost of your sale, because otherwise, the merchant has no reason to even allow its customers to pay using crypto. I mean, why take crypto when, you can just take one of the more traditional forms of payment. And then I think the other is that, outside the US, it would seem to me that something like this, again, if we sort of take a step back and sort of say, okay, well, the purpose of CARF is to really be a tool for tax authorities to risk assess levels of tax compliance. It would seem to me that if the merchants actually know what the form of payment is, right? So even if they outsource or white label the actual processing of the payment to a third party, they'll know whether a customer chose to pay using crypto, whether they, are paying using Visa, MasterCard, cash, etc. So the merchant will know, and there will actually be a sales invoice that's generated and is legally required to be generated outside the US for VAT or GST purposes. With identities, billing addresses, and so forth, that the risk of compliance for something like this seems significantly lower.
And Lauren, you asked a question. You said, is there a technological solution here? And I think it was in the prior panel where Lawrence mentioned the eventuality in the experimentation of on-chain identity. And I think there are ways, right, if you recognize as you're creating regulations for a new system, there's something different. Let's also embrace that difference and leverage its ability to allow the wallet holder to self-identify, right? If I have a certificate written to my Ethereum wallet, I can perhaps come to you and verify that someone on the chain is reporting my activity. And what that ends up looking like isn't necessarily something we have to solve for today, because in these contexts where we're talking about retail payments, we're talking about an on-chain disposition. So if you go to the centralized entities and the ones that look like brokers, so let's regulate them like brokers, and you have them at least preserve the outbound wallet transfer addresses, data analytics, and the public nature of the blockchain and all the transactions, will forever be able to source those back. That is very much how the Colonial Pipeline hackers, the Twitter hackers, the Bitfinex hackers have all been caught, and through that on-chain analytics and summons and the ability to associate that identity. So getting that piece now, or at least preserving that piece now, would create the ability to come. And I know there's a strong sense you only get one bite at the apple and you want to swing for the fences and get as much in as possible. But I think, again, you can go after, not go after, but you can start with the centralized, the easy, the low-hanging fruit, and really secure and ensure tax compliance at a high degree, even without touching on even retail payments or DeFi or any NFTs. You can leave those on the table for future discussion.
I think that was a very interesting discussion, showing some of the challenges with this proposal, and also showing some potential solutions. And thank you, Jameson, for providing the perfect introduction for the next subject, because the word external wallet address was already mentioned. And before handing over to Lauren, why we think that this might potentially be a useful item of the framework, maybe also to say for the benefit of everybody participating, is that, of course, one of the challenges I think that we have seen in Working Party 10 with trying to define this framework is precisely that it is much more difficult to get a reliable picture of holdings compared to the traditional financial sector, whether that's money or securities or any other financial assets you may hold. And one of those reasons is why we look into these more detailed transactional requirements, of course. But with that, if we speak about holdings in the crypto space, we speak about wallets. So over to Lauren to introduce what our current proposal says in that regard.
Yes, so another topic area that's taken a lot of time up at WP10 is indeed wallet addresses. So firstly, speaking to kind of the point which I'll put very simply about why we think this could be valuable, is because it can help tax authorities know when users have transferred their assets onto a non-reporting CASP or a cold wallet. And obviously, as we said, and as we kind of covered in the last session, we have really kind of fundamentally focused on the exchanges. So we haven't, for example, expanded or created a kind of reportable entity category which captures these. But nonetheless, we recognise that there is a lot of activity and a lot of usage of these sorts of things. And so we have considered whether this sort of reporting is helpful. And so, as I said, we kind of considered a lot of different kind of possibilities or variations about how to kind of cut this question of wallet addresses. And so we've ended up with a proposal that focuses on external wallet addresses. To be specific, that the CARF will only bring reporting of wallet addresses where they are not attributed to a CASP in scope, basically. And so while we put this into the draft rules for consultation, we were very interested in what this type of reporting would result in practice. And I think we've also, I'm going to ask questions, or at least say themes, which I think all of the panelists at some point might have said. But I think you know, some of the questions that sort of came to mind for us is you know, what business think wallet address information will tell us, particularly how far we think it will meet the aims I mentioned around the kind of transparency for cold wallets. I think that is something which I think, you know, is important, and I think there's a question about, you know, how do we best meet that aim. The second is whether this would result in a high volume of data that might be, for example, difficult to collect for the CASP or for the tax authority to use or compute. So I think there's a question for me about usability, and I think it's really interesting to kind of hear from the sort of people who deal with this a lot more day in, day out. And then finally, if there are sort of further practical challenges that we haven't envisaged, such as kind of the level of personal data. And that was something that when I read the consultation responses really kind of came through to me, was that this sort of wallet address data was seen as a lot more kind of personal data or identifying data, maybe a step beyond, or at least this is not me advocating a WP10 perspective here, but kind of maybe summarising what I heard in the consultation responses, but maybe a step beyond, say, what the CRS reports. So, you know, I guess, just to briefly summarise, you know, I think we do think that there is, you know, something to be gained from getting this reporting on external wallet addresses. But I think, you know, we've been really interested to hear from business on kind of usability, sort of volume, and other kind of practical challenges.
Thank you, Lauren. And I guess I will first hand over to Liz, and we are going to challenge technology at the end of our meeting because Liz would like to share, I think, 1 or 2 slides with us as part of an initial reaction. I've been told by the support team that that's possible if you push share on Zoom, so we'll see what happens when you do that. Maybe we will lose each other, but we remain hopeful, so over to you.
Thanks so much, Paul. Well, I think the Secretariat, okay, great, the Secretary is entered, so let me share now. So here, you know, I think, you know, just maybe as a starting point, I thought it would be useful just to sort of maybe set the baseline as to what we're talking about here, right? So this is an example. You know, I looked on the internet for sort of publicly available on-chain wallet addresses. And so something that was advertised fairly recently was the sort of the, you know, Ukraine crypto donation. I guess it's, you know, it's a charitable program, and that was sort of pretty widely publicized on Twitter. So this is the Ethereum on-chain wallet address for UK, for the Ukraine crypto donation. And as you see here, so first of all, every blockchain, right, has its own block explorer. So there are programs out there that are effectively search engines for that particular blockchain. And all you need is this on-chain wallet address. And from there, you can see every single transaction since the history of that wallet that has sort of paid into that wallet address or been paid out of that wallet address. So it's not just a matter of sort of getting transparency into the transactions of a particular wallet address. At that point, you actually have access to sort of trace backwards and forwards every other account that has ever paid into or out of that wallet address. And so here's an example here. So here, you know, at the top, I sort of, you know, circled the search box. So that's the box where you would type in this wallet address. And then you can then see in the column, it says from sort of every single wallet that is paid into this wallet address. Now, in this case, you know, the I guess the organizers of the this charitable campaign, they did put a public tag as to what their wallet address is. So they've tagged themselves as Ukraine crypto donation, but underlying that is this alphanumerical wallet address. And so I don't want to, and so I do think, you know, this really does illustrate how much detailed information is here, and not just for a particular snapshot in time, but for all time, right? And not just for that particular wallet address, but for every other wallet address that has ever interacted with this wallet address, right? So with this, you know, once you're able to actually associate an identity with this wallet address, right? And I do think in this case, there are challenges to verifying this identity independently of the wallet owners, but I know that some exchanges do ask, you know, when customers are transferring tokens from the exchange to a self-hosted wallet or off platform to essentially self-identify. And if that self-identification is then linked, so then an identity will be linked to this wallet address, then it is actually very easy for whoever has this information to then construct very detailed interactions of every other sort of wallet address individual that this wallet has ever interacted with. And so I think, you know, this sort of, you know, illustrates that we really do need to weigh the benefits, right, of, you know, essentially encouraging, you know, having transparency, et cetera, onto tax compliance versus the potential harm and danger of providing this level of detailed transactional information. So, and I do think, you know, just as a part of routine tax reporting, right? So again, you know, authorities can follow domestic procedures, whether it's in the event of a tax audit, of a criminal investigation, to obtain this detailed information. But I think what we really need to be sort of very sensitive to is providing this level of, you know, very detailed transactional information just as a part of routine tax reporting that's then shared globally. So here, you know, I didn't want to, again, you know, I actually, you know, played around and I clicked through to a bunch of these different wallet addresses. And some of them I'm like, oh God, like, I don't want to dox anybody here, or like, you know, do this OECD presentation where I'm like talking about somebody's, you know, personal wallet address. So, you know, I actually picked one that hopefully is not controversial, and sorry, Lawrence, but, you know, Coinbase just popped up on the first page. So I will pick the Coinbase 5 address here just to further illustrate. So this Coinbase 5 address, it's again, you know, publicly tagged as Coinbase 5. There is one that is somehow associated with Coinbase, and probably you know, what I think of as like an omnibus account for Coinbase on the Ethereum blockchain. And so then to click, let's see. So here, right? So then I, you know, typed in the Coinbase 5 wallet address, which is this, you know, this wallet address here ending in 511. And then I can again see, right, all the wallet addresses that has ever interacted with this wallet address into and out of this account. So you can see the number of sort of, you know, transactions that were made out of this account to these other accounts, right, that are listed here in the to column. And then I can also see all the other addresses that have ever paid into this Coinbase 5 account. And, you know, in this case, right, the Coinbase account is publicly tagged as a Coinbase account. So you know it's an exchange, right? But you can easily imagine when you know, click through to any one of these wallet addresses, oftentimes you just see transactions between one wallet address and another wallet address without a public identifying tag, right? And I think in those cases, you know, what we now have to envision is that if the wallet addresses are being reported as a part of routine CARF reporting, such that they're then tagged, right, with an identity, right? Then all of a sudden, instead of just seeing numbers, alphanumeric wallet address numbers, you can easily visualize it's one, you know, the identity of one person or organization to another person or organization. And essentially, it's not just that particular snapshot or, you know, even a snapshot in time, but it's for all time.
Thank you, Liz, for that overview. I think that highlights one of the questions that Lauren already put to the surface, like are there any privacy-related issues that we need to be aware of, and what could they mean? And I think also Corné earlier on in the discussion referred to that issue. Maybe on the other issues and to the other panelists. In terms of volume, if one would require the reporting of an external destination wallet address that a customer uses that is active on an exchange, what kind of data volumes would we be looking into for the average interested crypto investor?
If you're going to go with the average, it shouldn't be too much volume. I think it's just that Liz's slides really highlight the security risk here. If you think about, we talk dispositions, tax. No, we're talking about charitable contributions to a geopolitical issue. And if that got into the hands, from politically, if you found out that, someone donates to a specific charity frequently, and then that forever living and being associated. So you hear a lot about in the news from the AML perspective about the use of mixers and privacy features on the blockchain. It's because the industry knows this is an issue. This is not an ideal solution, but it's the only way to have the distributed systems and the trustless nature of the transaction of value as it is right now. So not all uses of mixers in whatever are nefarious, because sometimes people want to provide some anonymity for donation purposes. I'd also say this is, so it is something that the industry and developers around blockchains, so we'll come to you in a second, I think, like what are those solutions? Because the other thing is, this is Ethereum, and this is how Ethereum works. Arguably, this is principally how any other, what's called EVM, Ethereum Virtual Machine compatible blockchain out there works. They're similar in this nature. Bitcoin works differently, and then the layer 2s on top of these, like Lightning, or the different and various Ethereum layer 2 options, bring on a level of complexity where you do have, for privacy concerns, you have changing address features, such that they're not always clearly linked like this. But those are intricacies in terms of like UTXO blockchains and stuff that I think our other panelists do a little better than me.
Yeah, and I would. Oh, go ahead, Corné. Sorry.
Yeah, it's certainly true that the Bitcoin blockchain works slightly different, but the essence is the same. That the transaction history continues to be public information indefinitely. I think this is different from what you're maybe used to in a banking system, where maybe banks have access to a part of the transaction history, but it's certainly not public information. So in terms of privacy, it's almost the opposite. In Bitcoin, the transactions on the blockchain are public, but we very desperately try to keep them disconnected from the identity information. In the banking, the transactions are sort of private, but the identity connected to a bank account it's not so much of an issue that is connected. Yeah, what else? Yeah, you mentioned layer 2, and so in the Lightning network, actually, Lightning transactions are no longer recorded on the blockchain, so they are no longer public information, and that is certainly it is a privacy solution, and I think the consensus within the Bitcoin community is to try to increase privacy by making less data publicly available. That is a good thing. And in the case of Lightning, it also helps in terms of scalability and sustainability because, well, less data sharing is also, it happens to be cheaper.
Can I ask a follow-up question on this? So one of the, and this is, I'm speaking again more from the UK perspective here, when we were considering this issue of wallet addresses, one of the things that, we were thinking about is that it's perfectly conceivable that an individual might, for example, once like they had a crypto asset on a cold wallet, they might transfer it through a number of wallets before it kind of came back onto exchange. And so in that sense, it might be difficult to, say, trace like the asset through the cold wallets. I mean, we've obviously been looking at this very much from a non-expert perspective, at least speaking for myself. I was interested whether that's something that you think kind of rings true from like a kind of practical, in practice perspective, and if you thought that that might impact the usefulness of this particular kind of piece of information.
Maybe yes. I think maybe in terms of the reactions, Corné, maybe you go first, and then I guess I'll hand over to Liz, and then to Jameson, and then I think there's a question from our group here. So over to you.
So when it comes to on-chain transactions, so not the Lightning Network, but the things you see here, it is very common for people to create a new wallet address for every transaction, so that there is less possibility of linking different transactions together. That's also a way of reducing this privacy issue. And actually, wallet software does that automatically for people. So people are just downloaded a wallet. They don't even have to think about it. Their wallet software already creates a new address for every transaction. So that means that what you say is partially true, that when you make a couple of transactions, you're no longer the same address on which you originally received the Bitcoins. And that can make it more difficult for external parties to figure out that you are the owner of the remaining Bitcoins. There is a thing called clustering, where people still analyze the patterns in these transactions, and they figure out, oh, you used that one simultaneously with that one, so you are still the owner of that, and they can sort of cluster together all the addresses. So there's a sort of a technological war going on between the people doing blockchain analysis and clustering, and on the other side, developers of wallets or whatever. Yeah. So I hope that's an answer.
Yeah, and Lauren, I think just also to add on to that, if you're asking sort of like, well, you're concerned about tracing sort of transactions as they go through self-hosted wallets, right? So it may not even just be cold wallets, but it could be self-hosted software wallets, right? And so I think then the question is, well, if the concern really is, again, like ensuring tax compliance and having transparency on tax compliance, typically, the points where people can actually use these assets in any meaningful way, they're all at points that are tasks, right? So they're essentially the points where people on-ramp and off-ramp, right? And so there will be a reporting at that point already. I think it's, like the vast majority of cases, people are not going to be sort of transacting amongst each other via self-hosted wallets, right? So, so I think that should, so again, if we're trying to link it to sort of, the harm, right? The harm versus the benefit of what, CAS is, the CARF regime is trying to do. I think here, the other sort of, concern is that, if enough of the identities, right, is actually linked to certain wallet addresses, through software, you could actually start creating a map of people's social networks and interactions. So you start knowing like, okay, well, person A is associated with this wallet address. We don't know if it's a wallet address that's a merchant, or a self-hosted or that of a relative, but we know that this person that we know the identity of does a lot of interactions with this particular wallet address. And then you can keep sort of like building out on that. And so I do think the harm, right, the potential risk is not, it's a very serious risk, because I think, we're all here, countries that respect democratic values. And I do think, there are many places around the world that could, where this information with, coupled with the right actual software and automation could actually, be used as potentially an instrument of mass surveillance.
So I think,
and actually, and I just want to add, like in my entire career as a tax attorney, I never actually thought I would use the word surveillance and tax like in a single sentence. So the fact that, I think this is sort of what's become apparent to me, and sort of like, digging through and trying to sort of understand the relevance of providing on-chain wallet addresses and the heavy burden that sort of that is. I think it's something we should all keep in mind.
The most direct answer, I think, is it's very easy to trace and affiliate those. That's why you have the industry leader, Chain Analysis, CipherTrace, Elliptic, TRM Labs out there compiling this data. And actually, it was Jonathan Levin was the co-founder of Chain Analysis. He was recently, maybe a month ago, testifying at the U.S. Senate, and in response to a question from Senator Elizabeth Warren on this very issue, she said, well, doesn't it make it harder to trace this and catch the criminals? I said, absolutely not. I said, what about using mixers? No, we can de-anonymize those. So I think the data analytics tools based on this large data set that's out there in the public, very powerful at creating at least a confidence score of who is this. And that's very similar with my experience with the US bank regulators and coming up with, what KYT, know your transaction. You can, unlike with cash, go back several steps and see the source of funds provably on chain. And that has worked its way into the new risk scoring analysis for BSA.
Very interesting points exchanged here. I think we had a question from another of our former panelists, Andres Knobel of Tax Justice Network, so over to you.
Thanks a lot. Just because I feel like it's mostly the private sector speaking here, except for the authorities, is that, I understand that for the private sector, of course, regulation is bad. You just want to keep businesses and don't preventing that. And I understand that it's still for the tax perspective, it's maybe not as easy to see it. I think like maybe from a money laundering perspective, you do see the value of actually being able to tell how much money any person has and then being able to determine whether they have acquired that legally or not. And I know that for now, this should only be for tax purposes, but at the same time, tax authorities and tax is actually pretty better resourced than AML and FIUs, and there's not so much exchange of information in the FIU world as it is with the tax. So my question is, would it be possible for authorities, even without, because when you go and ask for an exchange just to tell me who the identity of this wallet is, then you already have a suspicion on that wallet and you want to know about that one specifically. But can you do that preventively without knowing that? So could you just simply say, I want to know if anyone that I know doesn't have any declared income still has tons of Bitcoins or other types of assets? Could I know that without having the identity of the wallet that you are in a way saying we shouldn't have that? And is it so different from SWIFT? In a way, SWIFT, which deals about banking transactions, they do centralize these, and even the US has access to that also for terrorism purposes. So it's not like it's so strange and we're only asking this for crypto and nothing else is being asked for traditional finance. Is it really that different, or is it really a way that without giving this identity in the CARF, authorities could still use this preventively? Because I understand that they can ask for it once they know what to ask for, whose wallet to ask for, but could they use it preventively otherwise? So that's a bit of the question. Thanks.
Perhaps I can speak from a tax perspective. I think it's a really interesting question. I think the first remark I would make is that we need to remember that the work we do to combat tax evasion is fundamentally different than the work we do to combat AML. The system is different and it deals with kind of different risk levels, type of economic activity, those sorts of things. I would say that, again, the other thing that I think is important to recall here is that we're talking about automatic exchange of information. And we will be talking about, if we think about this kind of being, for example, a kind of global information exchange that is done on an automatic basis, the volume of returns that we would receive would be enormous. And so I think the question I think the UK always asks itself whenever we're dealing with anything like this is the data sort of inherently critical to being able to sort of assess kind of tax evasion, compliance risks and things like that? Or is it in the space of that it would be helpful, but not kind of pivotal, if that makes sense? Because I do think that we have to kind of balance, for example, how much individuals' data are we talking about from a data privacy perspective, because I think that's absolutely important, and respecting that right that we all kind of have in our own laws is important. What is the burden that we're placing on business, and what are the compliance benefits? And so, I think I guess we've been talking around those three themes when we deal with this, but I did kind of want to make clear that I do think we're talking about something quite fundamentally different from AML. So my perspective is that sort of judging what would be useful there is quite different. I guess the final remark I'd make is that there, of course, are already systems in place for kind of tax authorities to request additional information where that's helpful. And I think it's always a challenge for us to consider what should operate on an exchange on request system versus what should be automatically exchanged. And I think, again, the bar on those two has to be quite different, because we're talking about exchanges of bulk data. So I realise that doesn't fully answer your question, and I'll defer to kind of experts to see if they have more to say on that.
I thank you, Lauren, for setting out a bit sort of the kind of the dimensions that we're struggling with. I mean, I think that in the sort of the good sort of football spirit, I can go 5 to 6, maybe 7 minutes overtime. Depends on how much unruly behavior there was during the match. So we can certainly try to stretch that. I see that Keith is already laughing as a good Tottenham Hotspur supporter. But nonetheless, I think we really should get into the last issue, because I think it's also an important one, the one relating to interaction between the CRS and the CARV. I think to allow the maximum amount of time still for discussion in the panel, we should probably focus on the timing and due diligence related aspects. I think in particular Andreas already said something about the reporting requirements and the challenges of the differences there between the two frameworks, so that we can probably leave that one largely to the side for now. Also, I don't want to prevent anybody from intervening, of course, but maybe Lauren, in 2 minutes or so, a brief introduction of why we have made some differences on how customers get documented in this space, and then some room for discussion, of course.
I'll try to be very quick. So I guess the first point to make is that the due diligence procedures for CARF are inspired by the CRS. They're tried and tested. We know they work, and they build on AML due diligence requirements. But I'm going to come back to one of my central themes here when I say that it's important to WP10 that these were also bespoke to the crypto sector. And it's, recognising the specific challenges and opportunities around the different customer relationship in the crypto sector as compared to the traditional financial services sector. And so I think that there are two areas that I intended to highlight here. I think first, the treatment of pre-existing accounts and self-certification. So whilst the CRS does not require self-certification to be obtained for pre-existing account holders, the CARF does require certification to be collected for both pre-existing and new users. And, this is because self-certifications are essential for reliably determining tax residence. And it was kind of understandable that traditional banks may have problems with collecting a self-certification from somebody who would set up an account 50 years ago, before the CRS was adopted. But given the crypto asset sector is still very nascent, it was considered that CAS could more readily collect this information for all of their users. The second area I wanted to highlight was the procedure for confirming the self-certification is correct. So CASPs are required to treat the crypto asset user as tax resident in each jurisdiction indicated in the self-certification, provided the reasonableness of the information in the self-certification is confirmed by cross-checking against the information obtained through the applicable AML KYC procedures. The information already gathered under AML KYC procedures covers much of the same information as will be required under the CARF. This has the double benefit of reducing the compliance burden while ensuring that the information can be cross-checked and verified. For individual users, noting that circumstances can regularly change, there will be a requirement to update information where a relevant transaction takes place, or 36 months after the last update. And we envisage actually kind of, again, coming back to this sort of bespoke to the crypto sector, that this update might be able to be provided for in general by a push notification. This has the benefit of not being overly burdensome, and businesses will be able to use the existing technology they have and incorporate the update into their systems. I think, again, this also reflects the fact that the customer relationship is much more distant than with traditional FIs, and so there might need to be sort of innovative solutions or different mechanisms considered.
Thank you, Lauren. And I guess with that, I hand over to Andreas for initial reactions on how this could all play together.
Thank you. Yes, we were now spending a lot of time talking about how the crypto world is different and what is unique there. But when it comes to the due diligence, this is really it's nothing spectacular. It's how to document the person behind the asset, and it's in the daily business. It's where the majority of the effort goes. So I think the experience of financial institutions that are subject to CRS is important here. And if we, I try to bring over my general point and also answer your questions or react to your rationale.
if we look at the CARF again from the perspective of a financial institution that is also subject to CRS, which is in our view a case that cannot be just ignored. There will be an overlap if there is not. We were talking about the line and where to put it, also in previous panels. If there is an overlap, it's essential that a financial institution that has documented the person behind the asset and has identified the tax residency, the controlling person of an entity, all these essential things that are at the core of CRS, it is hard to imagine that an additional regime with the same goal but slightly different procedures will come to a substantially better conclusion. It's with regard to the self-certification or the determination of the status of the account holder or of the crypto user. We made the experience that the self-certification, so it's a known concept to fill out. The self-certification, it's banks, it's part of the daily business now. Bankers know how to ask those questions, clients know how to answer them, so it's really an established procedure which I think has proven to be quite well. It worked quite well, and it's established practice in more than 100 jurisdictions. So we think it's essential that an FI that is subject to CRS can also follow those procedures without applying something that is substantially similar. And the validity or the monitoring part, I think the rules for CRS, I mean, I've not been part of all those discussions, but there were, I think, years of deliberation how this solution was developed, and I think it's a mix between the processes that happen within the FI and the interaction with the client, and it's based on a client relationship. Obviously, it's not just a one-off transaction where you need to effectuate the transaction and then you're gone. It's part of a client relationship. So again, here I think it's if you have this criteria, if this criteria is met that you have an ongoing client relationship, this recertification element is obsolete if you already have an existing procedure in place to make sure that information is up to date. And why I'm underlying this is that we are if we had in the morning session we had the comment that 2 minutes per e-money user in Europe equals so many dozens of years. And if we talk about collecting something from each and every user that we already have, it's not a nice to have, is not something that can be enough. So there needs to be a test as to whether this is worth the effort. And a last comment that I want to make is the missing of default rules. So the statement that you cannot effectuate anything if you don't have a self-certification, that sounds reasonable. I fully agree with that. But again, if you look at it from the client relationship perspective, if you are the custodian of assets, you need to have a fallback procedure. It's not just if someone puts assets in an account that is maintained by an FI, refusing service is different than just saying, no, I'm not fulfilling that transaction for you. So here I also think that CRS has with the default rules that if you don't have, you have two defaults, you have the default to report in doubt. So this is already something to address the tax risk aspect. And the other thing is that you treat the entity as a passive NFE and report the controlling persons if you cannot establish the status that this treatment would not be necessary. So trying to sum up, we have the due diligence procedures with CRS. They are established, they are broadly known, and I think it's
it's not realistic to expect an outcome that goes beyond that if we're talking about CRS financial institutions.
I take that as a strong statement to not reinvent the wheel, and we'll of course take that to heart. Any further reactions on this particular point, or indeed also questions of timing? What time would be needed before this can be successfully implemented? For instance, assuming that we would agree this tomorrow, what is a realistic timeline to bring this into effect? I don't know if there's anything you would like to briefly share with us on that particular point, because that's of course also very important and interesting for us to know, so that we don't impose something which is already objectively impossible. Maybe as a last item, to see if there are any reactions on that, phasing in times for these kind of rules.
So Paul, I can...
Go ahead, Liz.
Yeah, I was just going to, thanks, Jameson. I was just going to say that, I think on the phase-in and the timing of implementation of the rules, it would make sense to actually look at the size of the business. I think, as many industry speakers have said throughout the course of today, this is still a very nascent industry. There's still a number of different, participants coming into the industry, whether it's infrastructure providers, technical infrastructure, markets infrastructure, custodial infrastructure, providers coming into the industry, or just sort of other participants. A number of those providers, they're already regulated under local rules. For example, whether it's sort of as a money transmitter, as a qualified custodian, et cetera. And those regulations oftentimes require the pledging or the keeping of reserves. And so I do think that, we've all, we've put a number already. Was it like $5, Jameson? I think you said it was like $5 or $10, right, per customer. So I think we've put a number already to the cost of having to comply with something like this. And so if you're a smaller sized company that is just entering the market, and every extra dollar you have, you're thinking about pledging that, right, as your reserve in order to maintain your license, I do think then it becomes very, very difficult for, a lot of those, earlier stage intermediaries to be able to, either pledge the reserve or to, pay an external software provider to be, fully compliant with these rules. And this, I think this sort of goes back to, again, compliance is 100%, something that the industry realizes, is has to be done. And but the question, I think, what we've been talking about throughout the course of today is how much and what's actually considered proportional, and how much information is actually sort of reasonable, and instead of sort of asking for, just more rather than less, to maybe ask for something that is actually proportional for the stated goals, right? Which I heard today to be transparency and compliance, and sort of risk assessment to ensure taxpayers are compliant.
Yeah, I think I would echo Liz's thoughts on that, and I think it's important to think about the timing and phase-in two ways. One is the introduction of the framework for the existing industry, and the timeline until the announced framework, has to have some level of compliance, right? And then also an ongoing kind of phase-in that would enable small and medium, middle market businesses to enter into the segment without being unduly and unreasonably burdened. Now, that is cognizant of the fact that you have to weigh safety and soundness with innovation. In figuring out where that mix is what you would then kind of come in terms of that timeline. So I think those two factors in terms of timing and phased-in implementation. And then also kind of the last thing comment would be saying, this is a unique industry, this is a unique regulatory framework, and I would kind of challenge people to accept a unique solution, such as allowing time for on-chain identity to solve some of these self-certifications, allow reliance on a third-party self-certification written to a wallet address. There are some innovative solutions that can adapt and utilize the technology, and I think that comes in and could provide, could provide a lot of the solutions with a lower cost lift down the road. So it's about ring fencing right now, ensuring that we have enough compliance and kind of start closing it in and making sure you have these principles, the fiat on-ramps and off-ramps of the more traditional centralized exchanges, to me seems like the reasonable place to start.
Yeah. On the costs versus benefits side, I remember one of the consultation responses had a back of the envelope calculation where they argued that putting a tax burden on a fast-growing small industry is probably not beneficial, because initially you're going to have some increase in taxation, but the decreasing growth in the industry quickly makes it unprofitable compared to if you left it growing faster than right. I don't know exactly which consultation that was, but and another thing, I think maybe you could look outside of the box in a sense that, like right now, another disadvantage besides just costs is that you are sort of imposing a whole surveillance system, right? And you could ask, well, what if we didn't do that? Maybe the disadvantage would be that capital gains tax and wealth tax would be harder to enforce. But then you could step outside the box and think, well, could we redesign the taxation system so that that isn't that much of an issue anymore? That's just a final thought I would like to give.
I could get into all kind of broad discussions about direct versus indirect tax now, and I would feel very tempted, but of course we would not have time for that now. But thank you to all my panelists for this interesting discussion. I think a lot of food for thought.
Paul, could I make one more intervention before we? Sorry, is that all right?
Sure. You see, I was so proud of my 7 minutes of extra time that I exactly announced, but I'm ready to go to 9. Over to you.
Thanks, Paul. So, I think, I think it just sounds like there are a lot of assumptions that have been that have driven the design and sort of the CAR framework. And I do think, it could be useful to really re-examine some of those assumptions, because, I heard Lauren say earlier that a lot of the CARF was really, crypto is different somehow because the relationship between the user and the intermediaries is more distant than traditional FIs. And I actually don't agree with that, right? If we essentially look at the data, if 96% of all market transactions are still through centralized exchanges, the relationship that one has with a centralized exchange is the equivalent of the relationship one has with their securities broker, right? Or their, their whichever platform they're using to trade stocks. So I think that that's something that, I think some of these assumptions, it may be useful to sort of take a fresh look at them. And, we're very happy in industry to sort of share what we know, as well as what we're seeing on the front lines to support that. And Paul, I think, if it's useful, like, the slides that, we've prepared, as well as, we've put together also a brief write-up on, crypto assets that would fall under the definition but are currently not being used for payment or investment purposes. We're happy to share, these materials with the delegates if it's useful, and to just generally be available for, further consultation as a resource.
Thank you very much, Liz, and that gives me the perfect opportunity to thank everybody for participating in this panel and for having such an interesting discussion. I think many aspects to reflect on as we continue our work on these proposals. And of course, needless to say that we will of course take that what was said here to close to our heart and take it on board for our further work. Now, before actually closing the consultation, which would of course not be something for me to do as a mere moderator of a panel, but we will go back to our co-chair for Working Party 10 for that. But before we do that, I already briefly referred to Keith, our chair of the Business Advisory Group. and big fan of Tottenham Hotspur. That allowed me to do an analogy as part of our panel. I think Keith also would like to share some reflections on the day that we had together today and on the next steps from the business perspective. So first over to you, Keith.
I just want to thank the Secretariat and the WP10 delegates, both that are in the room, which I desperately would have liked to have been given the hour at which I was up this morning. And also those like Erica who were in early from the US, to thank them for all of their hard work and to let them know that the Business Advisory Group will reconvene and talk a little bit further over the next few weeks about the discussions that we've had today with you, the questions that you've asked, and try to make sure that we get some additional information to you in advance of the next meeting of Working Party 10, and that that we're prepared to respond to any questions that you have at that time or thereafter. So with that, I will, I guess, turn it over to Monica. But thank you very much again for all of your time today. It's been a very interesting conversation.
Thank you very much, Keith, for that. Indeed, as you said, it's been a very interesting discussion today, and we come to an end of a very, very productive day. I think the discussions were really meaningful, and the whole public consultation process was really well attended. And the discussions have been very robust, both on the updates to the CRS as well as the new CARF. And it has thrown up several interesting perspectives and also flagged and highlighted a lot of challenges that we're going to face ahead as we finalize both of these frameworks. I want to thank the Secretariat and the technical team because I think the experiment of the hybrid model of consultation has worked quite well, and it has also enabled a much wider participation from across the world. And so that's one success that is there. I want to thank very much today's panelists. I think the discussions were very lucid, and the explanations and the context that was provided was really very, very useful. And I would also like to thank all the viewers from around the world who have woken up at different times and have provided their inputs today. Now, these lively discussions have provided a lot more context for the comments that have already been received by the Secretariat during the public consultation process, and has highlighted what a range of stakeholders considered to be key issues to be addressed as part of both the CRS review and in developing the CARF. Of course, given that over 560 pages of comments were received, we were not able to touch all the stakeholder input today. And in this respect, and consistent with what the opening remarks was made by John, my co-chair of Working Party 10, I can reaffirm that any other items that were not raised today haven't been forgotten about, and these will be given due consideration at the level of WP10. So outlining the next steps, the Secretariat will take stock of all the input that has been received in writing, and also all of the perspectives and inputs that we have seen during the discussions today. In the next months, the Working Party 10 will continue its engagement with the Business Advisory Group in the process of refining proposals. I believe that a joint meeting of the Business Advisory Group as well as the Working Party 10 session has been scheduled for June, where the business representatives will have another opportunity to interact with the WP10 delegates. Thereafter, WP10 will continue its work throughout summer and after that. And the aim is to present the final CARF and the CRS amendments to the Indonesian presidency of the G20 during the fourth quarter of this year. So thank you very much once again to everyone who's participated, everyone who sent in their comments, to the Secretariat, to the panelists, and I think it's over to the Secretariat and Working Party 10 to go over all of the range of comments that have been received and take them into account during the deliberations in the coming months. Thank you again. And to those who are present in Paris, have a good evening. And to everyone else, good morning, good afternoon, good evening, good night, wherever you are. Thank you.
Thank you, everyone, and bonne soirée.